All right. Good morning, folks. I declare open this hearing of the Senate Select Committee on the operation of the capital gains tax discount. I want to acknowledge that we're gathered on the land of the Ngunnawal and Ngambri people, the traditional custodians of this place. Pay my respect and the committee's respect to elders past and present, and extend that respect to Aboriginal and Torres Strait Islander peoples here today. The committee will be conducting today's hearing in person and via video and teleconference. These are public proceedings being streamed live via the Parliament's website, and a Hansard transcript is being made. I remind senators of their obligations under the Behaviour Code for Australian parliamentarians to treat witnesses with dignity, courtesy, fairness and respect. I remind all witnesses that in giving evidence to the committee, they are protected by parliamentary privilege. It is unlawful for anyone to threaten or disadvantage a witness on account of evidence given to a committee, and such action may be treated by the Senate as a contempt. It is also a contempt to give false or misleading evidence. Witnesses have a right to request to be heard in camera. If a witness objects to answering a question, they should state the ground upon which the objection is made, and the committee will determine whether it will insist on an answer having regard to the ground which is claimed. If the committee determines to insist on an answer, a witness may request that the answer be given in camera. I remind any committee members or witnesses who are appearing via video or teleconference to please mute your microphones when you are not speaking. I now welcome representatives from the Tax and Transfer Policy Institute. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please state your full name and the capacity in which you appear?
So, Robert Brunig, I'm the Director of the Tax and Transfer Policy Institute at the Crawford School of Public Policy at the Australian National University.
Thank you, Dr. Brunig. I invite you, if you wish, to make an opening statement, after which we'll have some questions for you.
Okay, thank you. First of all, thank you, Senator McKim, for the invitation. Thank you to the other senators who are here listening in. I appreciate that you're taking your time to think about what I think is a very important issue. Maybe I'll just make a brief statement, and then we can sort of take the discussion where you'd like to go, because I think there are a lot of different elements here that you've been talking about yesterday and that you'll talk about today and tomorrow, and I'm happy to kind of help provide some insights about how I would think about those things as someone who is a professor of economics, who I guess is an expert in tax policy and public finance, and bringing some of that economic lens to tax policy, recognizing that there are other lenses, legal lenses and accounting lenses, which are important too, and you'll aggregate all of that up. I guess if you had called me in and said, what is the problem with the way we tax savings in Australia? So I'm stepping back. Capital gains tax is just one way that we tax savings. But if you framed the question differently to me and said, you know, what is the problem with the way we tax savings in Australia? I would say it's that we're just all over the shop. I've given you two pieces of paper. The first one is a graphic from a report that we did at the Tax and Transfer Policy Institute in 2020 about the taxation of savings in Australia. That report makes for fantastic weekend reading with lots of fun recommendations in it. But the one thing I want to point out in this graph is that what we've done here is we've graphed the tax rate that taxpayers pay on different savings vehicles. If you look at this graph, the sixth item over from the left is investment properties and the capital gains part of investment properties. It does not stick out in this graph as something that is particularly undertaxed. And I think that is a misunderstanding. I think people somehow think that investment properties are undertaxed, or that the capital gains from investment properties are undertaxed. And if you actually look at this graph compared to other ways of savings, they are not. In fact, the rental income from investment property is the most highly taxed thing in our system. What jumps out here are the two things that are really undertaxed. One of them is owner-occupied housing, and the other is superannuation. Now, superannuation, there have been some changes since we drew this graph, which have actually made some of this undertaxation less severe, but this still remains a kind of basic fact of the system. So we're going to talk about capital gains taxation. If you started out by saying to me, you know, what would you do about the taxation of savings in general in Australia? I'm going to want to be in a world where we're taxing all these savings vehicles equally. so that we don't distort the way that people save their money, but instead that people save their money based on their own preferences for risk and the time horizon they have.
All right. Thanks very much, Dr. Brenning. Would you be happy for the committee to accept these papers you provided us as tabled, which would mean they'd become public documents?
Yes. I will refer to the second one later, but for the moment, that's just the first one, yeah.
No worries, thank you. Have you completed your opening remarks?
I have, thank you.
All right, thanks. Well, I might start with a couple of questions, and I'm sure my colleagues will likewise have some questions for you. I want to just sort of start at a pretty high level and ask that, make the observation that it seems like the economic orthodoxy is that savings should be taxed more lightly than income, and make the observation that this orthodoxy was developed in a time where policymakers were trying to encourage an increase in national savings. Is that, would you agree with that? I guess the first question, if you do, is it as important now to increase national savings as it was then, and do you still think, or do you think that it is still the orthodoxy that going to work every day should be taxed more heavily than earning income from selling asset classes?
That's a great question. It's the sort of question I could assign as I think an exam question for students in a master's class, because it's in economics we always say the questions never change, but the answers change over time. So I think if you went back 100 years, we sort of said $1 of income is $1 of income. We should be taxing it identically no matter where it comes from, and in many ways that's the benchmark of the Australian tax system, even though we vary from that substantially in practice. But if you think about something like the tax expenditure and variations statement, that is all calculated from a benchmark that every dollar of income should be taxed at the same rate. That, since you've invited me to be high level, I guess came under critique in the 60s and 70s through research that basically said that the optimal tax rate on savings is actually 0. And where that comes from is a model that says all savings is being invested in productive outcome for the economy. And so any tax on that is just a tax on the labor income of workers in the future. That theory itself has come under critique because there's a lot of investment that's not in productive capacity, and there's a lot of investment that's simply getting rents, if you will. And housing is perhaps a good example, right? I buy a house, that house goes up in value not because of any hard work that I do, but because of government zoning laws, because of infrastructure that government builds to contribute to that housing. I should be finding a way to tax that. That should not be untaxed. So I think in that sense, that's come under criticism. So I think the orthodoxy today is probably that savings should not be taxed at 0, but it should be taxed at a lower rate than labor income. Partly the reason for that is that savings are held for a long period of time. And with any inflation, if you hold an asset sufficiently long period of time, you end up having a 100% tax rate. The reason we don't want a 0 tax rate on savings is first that the rental income that I've just evoked, and I mean rents in the broad sense. And the second reason is that we worry about people reclassifying labor income as savings income. And if I can reclassify my income from something that's highly taxed to something that's not taxed, that presents a lot of compliance problems in the system. So I think the optimal today would be tax it lower than labor income, but not at 0. And then there's a big debate about what that proper rate is, and you hear numbers thrown around anywhere from 5% to 30%. So.
Thank you. We've received a lot of submissions from a lot of people, obviously. There's a range of views, as they say, about the capital gains tax discount in particular, and acknowledging that it is, one part of a very complex tax code that we have in Australia. Do you think the current rate of discount is too high? All other things being equal.
That's a good question. Part of the problem, I guess, in assessing that, so I don't feel like it's egregiously high. if you only think about it as a scheme to avoid taxing the inflationary component of returns, then it has been too high relative to the inflation rate. And I think a lot of the people that make the claim that it's too high, that's what they have in mind. But instead, if you have a broader theory about what is the right level of taxation of savings, and you want to use the capital gains discount to lower the tax rate on savings relative to income, then maybe it's not at the wrong level. And there's quite a, it's quite comparable to the capital gains discounts that are provided in other countries. Christian Gillitzer wrote a nice op-ed in the AFR last week, sort of arguing that our capital gains tax discount probably was not overly generous, that it was in line with a lot of other countries.
All right, thank you. Your submission says that if there were to be a move to lower the CGT discount, we should avoid grandfathering provisions, which would therefore avoid lock-in effects that grandfathering would be likely to generate. Could you just talk us through your concerns there and why you've reached that position?
Yeah, one of the things that we do worry about with changing tax rates on things and grandfathering things is that people who are benefited from the grandfathering now will not change their behavior. A lot of tax policy is trying to get people to change behavior. And in fact, the behavioral change here will go the opposite direction. So now I'm saying if you already have an investment property, I'm going to give you the 50% capital gains tax discount. That provides a strong disincentive not to sell if what I might do is sell my investment property, buy a different investment property, and now I get a lower capital gains tax discount. And we want to encourage people to buy and sell housing. We want to encourage people, if they're holding an asset that's not appropriate for them, we want to encourage them to sell that. We want people to be able to buy assets that make sense for their portfolio and for their risk appetite. And so this would basically lock in those owners, and you would get less sales going forward. Again, if the change were relatively small, that effect is going to be small. If the change were relatively big, that effect is going to be big. I think an even broader point about grandfathering that perhaps we didn't bring out sufficiently in our submission is the degree to which it actually goes in the opposite direction of doing something about intergenerational equity. So by grandfathering, what I'm basically saying is, Senator McKim, you're an old guy, you've already got your investment property, you can keep that 50% discount. Senator Dowling, you're a young, aspirational guy. When you try to do the same thing as Senator McKim, we're actually going to tax you a lot more for that. So if I sort of feel that young people are paying too much tax and carrying too much of the burden of our debt and old people aren't carrying enough, that's actually going in the wrong direction. And I think that's actually a serious concern. So, I'm not going to stand up here and say, here's Bruning's policy and you should do what I say, but I do want to be able to help you think about the trade-offs involved in some of these policies, and I think there's a clear trade-off here. So if you said to me, we really want to lower the capital gains tax discount, we think it's too generous, I would prefer a smaller reduction in that discount, but that's not grandfathered, to a large deduction that is grandfathered for those two reasons.
Thank you. You talk about how tax can change behaviour and influence people's behaviour, and obviously that's true. This may be slightly outside your area of expertise, but I'll ask it anyway, and if you think it's an unfair question to you, please say so. But if the CGT discount were to be reduced, do you think that would change the ownership mix of the housing stock in Australia? In other words, would it result in more of the stock being owned by owner-occupiers and less by investors?
I think it would, but I think the effect would be pretty small. Most of the models that I've seen, so this is something that I haven't directly researched myself, but obviously an important question. It's one that I've informed myself about. So, my informed opinion of reading other people's work and trying to assess the quality of those models is that we're talking about a 1% to 2% change. We're talking about a pretty small compositional change. So and again, this is just thinking about the costs and benefits for people. So now I've made it less beneficial to own an investment property. You're going to get less demand for investment property. You're also going to lower, and what you are going to do is you're going to sort of lower the benefit or raise the cost of having an investment property, and it's very likely that will pass through to rents. So I think the other compelling thing that models suggest is that anything that you do that reduces the concessions on investor property would probably bring more owners into the system, but probably increase rents. Because now I'm able to make less profit, so I'm going to pass part of that cost on to my renters. Similar arguments would hold for changes to negative gearing.
Thanks. On rents, we've heard some evidence that if you did change the mix in the housing stock, therefore more people who are currently renting would end up as owner-occupiers, thereby reducing demand in the rental market. Do you think that would offset any concerns that you had in regards to the rise in rents?
I still think it's going to flow through to increased rents based on the modeling I've seen. And again, because at the end of the day, and you know this, housing affordability is really about the number of houses, right? And this isn't really doing anything about the number of houses. It's really just kind of rearranging the deck chairs. So,
okay. I've got I'm just going to sort of try and cherry pick my questions here because I've got quite a few for you, and I know my colleagues will have some. Your paper on the taxation of savings in Australia recommended a dual income tax system. The majority of OECD countries do have a dual income tax system. Why don't we have one in Australia, and what are the policy or political barriers to the establishment of such a system in Australia?
I think partly we don't have one because of our attachment to this idea of taxing comprehensive income. And a lot of things in our system reflect that. So if you think about how we do franking credits with corporate tax, we treat corporate tax as a withholding from your personal income tax, and then you rectify that when you file your tax return, and you either get a refund or you pay extra tax on that based on your marginal tax rate. So I think that has kept a lot of path dependence in our system, where we have most countries, when they've brought in the dual income tax, they've gotten rid of their franking credit system. So you'd have to kind of modify those two things at the same time, and that system is very strongly preferred in Australia. People really like that franking credit system. Our superannuation system, where most of our savings takes place, and owner-occupied housing are taxed very lightly. And so in some sense, we don't need a different tax rate for those things compared to labor income. We've just sort of done an ad hoc dual tax system. But now we've ended up in this world where we have these really kind of crazy tax rate differentials across different savings types. I think those are the two main reasons why, and those would be the political barriers. I think it's a hard thing to fix without actually thinking hard about things like franking credits and imputation and other bits of our tax system.
All right, thank you. Just two more quick ones from me. You've published a paper tracking taxation sort of across generations, a very interesting piece of work. I've asked another witness this, and it's a little bit esoteric, but I'm going to have a crack at it. So back in feudal times, your opportunities in life were determined in large part by the relationship your parents had with land, with real estate. Is your research kind of saying we're heading back to some kind of neo-feudal society where the opportunities that you have in life are determined significantly by the relationship that your parents have with real estate and with land and property?
That is the trajectory that we are on. I don't think we're back to pre-French Revolution times, but I'm worried about that. And in many ways, that's the big punchline of our report. We often frame the equality problem as an intergenerational kind of old versus young problem, which it's not really. It's if you're a young person and your parents have a lot of assets, those assets will eventually come to you. And more what we see in the data is that they're coming to you even before your parents pass away, in the form of intra vivos transfers to buy housing, et cetera. And so the real inequality is between people within the same generation, those who have assets and those who don't. And that's going to lead me, Senator McKim, to refer to the second piece of paper which I gave you, which is, in fact, a picture from that paper. And what that shows, the lines in this graph, age is along the horizontal axis, and and total after-tax and transfer income is on the vertical axis, and what it's shown is that incomes for older people have risen much, much more sharply than incomes for younger people from 1993 until today. So data allows us to do this for about 20 years. And that's almost exclusively driven by asset prices and asset growth. So that would suggest that we're undertaxing those assets, again, which we would suggest from our savings report. But it's not that we should be punishing old people or taking money away from old people, right? We all want to live in a country where old people are rich, right? We should incentivize people working hard, saving during their lifetime. We want people to have comfortable retirements. We have lots of things in our system that do that, like superannuation and stuff. But the other thing we have in our system, and this would be nice to have further inquiry about, is that it used to be that being old meant you were poor. And so we have a lot of money that we transfer to older people simply because they're old. But a lot of old people aren't poor anymore. And we're still transferring money to them as if they were poor. So this idea of old being a tag for poverty, I think we need to move beyond. And now we need to say, let's target assistance to those people who really need it.
Thank you. And last question from me. This Parliament does, in its makeup, does present a pretty unique opportunity for significant tax reform. As long as that reform is progressive. The numbers are there in both houses to deliver progressive tax reform. What are the, and please don't limit your answer to the capital gains tax discount, but what are some of the big progressive tax reforms that you would like to see this Parliament progress? And particularly I'm sort of interested in your views on negative gearing, which is obviously interrelates with the capital gains tax discount, the way we deal with trusts, superannuation you've already mentioned. Here's your chance, Dr. Brunig. You're a tax expert. What would you say to the Parliament? What would you say to the Treasurer? Because he said he'll be listening to this inquiry closely.
So I remain very convinced by the idea of a dual tax, of a dual income tax. So we separate out a scheduler system where we tax savings separately from income. If we're going to do that, I think it is absolutely crucial that we include owner-occupied housing in that one way or another. The simplest way to do that would just be through a broad-based property tax on the unimproved value of land, similar to what the ACT government has introduced. That is a very, very difficult political reform. But if you look at the increasing wealth inequality, if you look at where the undertaxation of savings is, that is clearly an area that we need to do something about. So the other advantages of that is that if we had a dual income tax, I would just tax every bit of savings income at, pick your number, let's say 20%, then it would eliminate all the game playing that we see around trusts and a lot of the game playing around small businesses. If you got the dividend, you'd pay 20 cents. If your 18-year-old child who had a zero tax rate got the dividend, they would pay 20 cents. It would eliminate a lot of the things we worry about wealthy, self-funded retirees getting franking credit refunds. All of those things that are really symptoms of a deeper problem would be eliminated. So I remain very attached to that simply because I think it is a comprehensive solution to the problem. I think the second place I would be looking at means testing. I think we need to do a better job of means testing, things like the old age pension, and we need to do a better job. We've made improvements, but we still need to do a better job of having people pay for aged care. The government needs to remain the insurer of last resort. People need to not worry about being plunged into poverty if something bad happens to them. But we need to also expect that people who've accumulated all this savings during their lifetime, that they're going to spend that. And then simultaneously, I think we need to bring down labor income taxes, which fall very heavily on young people and on working people. That, at the end of the day, is really the intergenerational piece. It's not just about raising new taxes, but it's about shifting the tax mix. And there's also an opportunity here to do something about productivity. We need to tax those productive activities like labor income less and tax unproductive activities like just sitting on your house while the value goes up a bit more.
All right, thanks, Dr.
That's an ambitious program. But you opened the door for me to say ambitious things, so I did.
I'm not sure this Parliament's going to be able to deliver all of those things. But thank you very much for that response. Senator Dowling.
Thank you, Chair, and thanks, Dr. Brunig, for your evidence. I think it's clear that a lot of this debate is really being framed through that intergenerational equity lens, and I know you've done a lot of work on that. So I sort of just, it's something anecdotally people understand, implicitly they understand it, but just actually how we define intergenerational equity. I know that I did read your paper, and older Australians today, particularly those born in the 1950s and earlier, are net beneficiaries of the tax and transfer system over their lifetime. Younger Australians, particularly those born after 1990, are net contributors. Could you just expand on that and actually help us understand what intergenerational equity actually means in a technical sense?
In a technical sense, I think what it means is that each generation should be sharing the costs and benefits of being a citizen of Australia equally. That, of course, is incredibly hard to measure because I sort of can't say anything about it until kind of the generation has passed and people have died, and I can look back and say, oh yeah, you know, that generation that was born in 1850 was better off than that generation that was born in 1830. We can get a bit of a snapshot by looking at it in terms of, is the current generation living as well as their parents did? And there are lots of ways in which the current generation is living much better than their parents did. And a lot of that stuff doesn't necessarily come through in economic figures. A lot of it comes through in things like the quality of education, the quality of healthcare, all the technology that people have access to, all of the consumption goods that people have access to that they didn't have access to in the past. So I'm suspicious of arguments that say sort of the current generation isn't as well off as the current generation is not as well off as the past generation. I think there's a lot of evidence that that's actually not true. Another thing that we look at is intergenerational mobility. So is being born in a rich family or a poor family sort of determining your destiny in life? And Australia actually, in terms of mobility, still does quite well compared to the US, certainly, and compared to most other OECD countries. So Nathan Deutscher, who's associated with the Tax and Transfer Policy Institute, has written a few different papers about this, and he shows that our rates of intergenerational mobility remain quite high relative to the US. So again, that suggests that our education system, our social safety net, are all giving people what they need to create opportunity and move up in the world.
Yeah, because it's often said we have in Australia one of the most well-targeted tax and transfer systems, particularly that takes from the wealthiest cohorts and distributes to the lower income cohorts. Is that your?
I think that's been the strength of Australia in the last 20 years. And when you look at what we've managed to do, that we've managed to have relatively low tax rates relative to a lot of European countries, and yet we have a very strong social safety net. A lot of that is about targeting. But I worry that we've actually moved away from that a bit. The NDIS is not means tested, obviously is a very huge impost on the budget. And we've made that program universal rather than targeting it to those who are most in need or those who are not able to solve that problem themselves. And I think with some other programs, with childcare subsidies, for example, as well, we're kind of moving away from that targeting. And that's going to have budgetary consequences.
Is there a trade-off, though, when you say you means test a program versus a universality program, that you actually increase effective marginal tax rates? So if it's not universal and you're means testing it, the effective marginal tax rates can actually become more extreme.
Yeah, look, all these things are trade-offs, right? And, you know, people don't like economists because we always say, well, you know, on the one hand and on the other hand, right? But there's certainly a trade-off there with effective marginal tax rates. But it doesn't, if you look in the data, I don't think we don't have particularly low levels of labor force participation. We don't have low levels of people transitioning from payments into labor force participation relative to other countries. So while those effective marginal tax rates can be sort of high on paper in very narrow zones of the income distribution, the empirical evidence suggests that people jump over those things a lot. So they don't, you know, it may not be worth it doing one extra day of work, but it becomes worth it if you do 3 or 4 days of extra work, and then you think about the trajectory that puts you on for your career. So I personally think lower tax rates, more targeted assistance, and putting up with those high effective marginal tax rates is the right decision. You know, a lot of European countries, what they do is they have universality, but then they have very, very high taxes, and a lot of it's gathered through goods and services taxation, where a lot of countries would have 25% GST instead of a 10% GST. And so this just ends up being paid by the middle of the income distribution. And, you know, I guess I prefer to err on the side of saying to people, we're going to let you keep more of your own money and you can decide how to spend it, and then we'll target assistance to those who really need it. But those are, you know, now I'm giving you my personal opinion. Those are choices that the political system has to make.
No, and certainly this government's had a focus particularly on addressing intergenerational equity through 3 rounds of personal income tax cuts, reducing student debt, and trying to increase home ownership for younger people and first home buyers. There's been a lot of sort of speculation from witnesses earlier about if there was hypothetically revenue from changing the capital gains tax discount, it would need to be directed to a certain use to improve intergenerational equity. What use would you suggest?
Again, I think young people are paying too high of labor income taxes, so I think that's an obvious place to do it. I think the second thing is if you can, it's difficult to make this happen because there are federal state issues, but if you can turn it into more housing, you know, the main thing that would make housing more affordable is simply to have more housing. So I think those are the 2 main things that I would want to do with it.
And just finally, do you see any, you've just presented a series of trade-offs, and I think back to sort of Adam Smith's 4 canons of taxation, is it worth actually, in terms of predictability, simplicity, looking at just one measure in the tax system, or should we be thinking more broadly?
I guess I would encourage you to think more broadly. I think but you can also make changes to systems that take small steps in the right direction. And I think, you know, there are a variety of things that you know, that governments can do to take steps in the right direction. But I think it's important to have that kind of pole star that you're going toward, which is this sort of optimal tax system. I also think it's worth thinking a bit about what the process might be that would get us there. A lot of countries, when they've reformed their tax systems, they've done it through sort of bipartisan agreement, external to government, setting up some expert committee that can recommend a redesign of the tax system, having all the major parties commit to that process in advance. And that could be so it's worth thinking a little bit about what is the process if we wanted to do big ticket reform, because big ticket reform is really hard. There are always going to be winners and losers. The winners, the amounts are often small. The losers are small in number, but the amounts are big. And that creates a political economy problem. So overcoming that through bipartisanship and through some kind of process of tax reform, I think, is actually quite important.
Thanks, Dr. Brunig. Thanks, Chair.
Thanks, Senator Dowling. We've got Senator Bragg joining us online, and I'm aware that he has some questions for you. So, Senator Bragg.
Thanks, Chair. Thanks, Dr. Bruning. Just a couple of quick ones from me. So, effectively, you're saying that investment properties are already heavily taxed compared to other vehicles. I assume here you're talking about superannuation and other unoccupied houses, are you?
And even domestic shares, which are taxed at quite low rates.
Yeah, so it's already reasonably heavily taxed. So if there was more tax or a reduced discount, what do you think that might do to supply?
Again, I think, all the models that I've seen suggest that the effects on supply are going to be pretty small. So I think what happens is you make owning an investment property somewhat less beneficial. You get fewer investors. You have more people who are currently renting who buy into the market, but all those changes are of the order of 1 or 2%. They don't look like very large changes to me.
Okay, so it sounds like you agree with the Peter Tulips and others of this world that say that, even if you fiddled around with negative gearing and CGT, it would have a minor impact on pricing.
That is my view, yeah.
Yeah, and is that because, I'm probably quite a bad accountant, certainly not a distinguished economist like you, but is that basically because of the scale of the system, and the value of the overall property system is so high that these are effectively sort of deck chairs in the Titanic?
Well, so I think it's for two reasons. One is that at the end of the day, it's the underlying supply and demand that's going to determine the availability and price of housing. And then you can shift the cost forward in the future If you took away stamp duty and replaced it with land tax, you'd be shifting the cost from today until spreading it out over the life of the house, but you're not creating more houses. I think the other thing that's really important here that I don't know if anyone's mentioned is, banking system practices here matter a lot. Banks view lending for housing as incredibly low risk. If I go to the bank and I say, I want to buy $1 million of shares, the bank will basically lend me $600,000. If I go to the bank and say, I want to buy $1 million investment property, the bank will lend me $1.2 million. And say, here's some extra money to pay the stamp duty and for some renovations. And so the reality is then I can actually make pretty low rates of return on that property and still be better off because I'm borrowing, I'm using someone else's money, essentially. And so I think changing the capital gains discount would lower that rate of return a little bit, but it would still be positive. And given that interaction with lending practices, I think people would still want to do it. So that's why I think the changes wouldn't be massive.
Yeah, okay. So for the people who sort of hold this out to be the way to solve the housing system, I mean, effectively they're engaging in pretty fraudulent sort of public statements, I would have thought. Wouldn't you agree?
I think if you want to change the housing situation, you need to find a way to build more houses, right? And part of that could be linked to tax reform, but I think part of it's really just there's also a big regulatory story there, and there's a big story of NIMBYism, right? So,
but I mean, it strikes me as very strange if you go through and you read all these submissions to this inquiry that so few people have mentioned supply. I mean, I get that the terms of reference are tight. But, I mean, surely the impact of having a collapsing supply agenda over the last few years, when you've gone from sort of an average of 200,000 dwellings a year down to 170,000 in the last couple of years, surely that's had an impact.
Yeah, no, I think it has. I don't think supply has kept up with demand. That's clearly part of the problem. But I actually think we're making progress on that. I think the government does have a big focus on regulatory reform, particularly around construction. And I also see some of the cities in Australia, and Melbourne and Sydney both, and again, this is not my main area of research, but according to things I've read and from other people I've talked to, making progress on allowing for more infill and more at least medium density housing, and that should help. The problem is these things take time, right? There's a pipeline, and it's hard to fix this overnight. Yeah.
Okay, so finally, I just wanted to nail you down on this point about supply. So if there was a reduction in the discount, wouldn't that mean that there would be less supply and ultimately higher rents?
Yeah, so I think what it might have I'm not sure. I haven't actually looked in detail at the question of whether it would have a big effect on supply of housing. I'm just thinking more about the distribution of the current stock of housing. And I think there you would see slightly fewer investors, slightly more owners, and higher rents for those people who are renting. And I'm pretty convinced by the models that claim that, yeah.
Okay, thank you very much. Thank you, Chair.
Thank you.
Thanks, Senator Bragg. Senator Pocock.
Thank you, Chair. Thank you for your time. Great to have some local expertise in the room. One of the things witnesses and yourself have spoken a lot about is intergenerational inequity, and you say that reducing the CGT discount would represent a small step towards restoring intergenerational balance in the tax and transfer system. How important is it that this reform is undertaken in achieving that, and then I guess the broader picture of all the little things we should be doing?
Yeah, let me maybe explain the basis for that sentence, because I said earlier, and I just want to be clear that I don't think there's a contradiction here. I said earlier that lowering the CGT discount and grandfathering it actually exacerbates intergenerational equity, because now you're taking away something from the younger generation that the older generation had access to. But I guess with reference to the intergenerational equality work that I've done with reference to the very large increase in asset prices that we've seen in Australia, we are not effectively taxing that growth in wealth, and this would increase by a small margin the tax on that growth in wealth. And that's the sense in which it would be making a step towards intergenerational equity. But I worry about the inequity in our failure to tax owner-occupied housing. I worry about what I think is continued excessive generosity in our superannuation system. And so I think those are much bigger things that we need to cope with. So it is a very small step, but yeah, it's a small one.
Okay, thank you. I guess on that point of taxing wealth, not work, I wanted to see if you could clarify something in your submission. You say that at high taxable income levels, negatively geared properties are taxed at rates comparable to those applying to domestic shares and lower than those rates applying to international shares or domestic savings accounts. Given the level of capital gain most properties in Australia have seen over the past few decades, how does that factor into your calculation if you're looking at how much they've actually appreciated in value?
So, yeah.
I guess looking at it in terms of how much people are profiting rather
Right.
than just how much they're being taxed.
Right. No, I think that's a good question. And I think we have seen, right, so that calculation is different. So that calculation is based on earning the same rate of return off of the various assets.
Yeah.
Now, in reality, over the last 20 years, the returns on housing have been bigger.
Yeah.
And so then the tax that people are actually paying has changed. And that would be another argument to maybe rein in the CGT tax discount. And
do you have concerns that we've essentially distorted where people are investing their money? They're putting them into unproductive assets, and you're seeing people who have money to invest just parking it in housing in Australia at the expense of investing in startups, in companies.
Yep. I totally worry about that. I worry about it even more with the owner-occupied housing than I do with the investor property housing. I have colleagues who are 60 years old. They're borrowing $1 million from the bank to renovate their house, to turn their house into a palace. Why is the bank willing to do that? Well, because when they retire, they can pay off that loan with their superannuation. And that's all going to be tax-free. They're just massively increasing the value of that asset. They're going to pass that on to their children entirely unencumbered, and so I worry about it in a wide range of areas in our system. Absolutely, and that again would be an argument to have more equal taxation across these different savings vehicles.
Okay, thank you. And given that growing inequality in Australia is a far bigger problem in relation to wealth than it is to income, how can it make sense that the tax rates on asset gains or unearned income are so much lower than those on earned income? Why are we taxing work so much more than wealth?
So there's sort of two questions there, I guess. One is why are we doing what we're doing? And I think partly what we're doing is because the average voter is a homeowner and has seen a big wealth increase and doesn't feel like they should have to share any of that with the governments. It's probably a question about democracy, I think. I guess if you're asking me the theoretical question about why do we think labor income should be taxed at higher rates than savings income, I guess it comes from the idea that a lot of that savings income goes into productive capital, and that productive capital then generates productivity increases, which translates to wages for workers. Now, if that money's going into non-productive assets, then that rationale no longer makes sense. But there is still a lot of savings in Australia that's going into productive investment, right? A lot of superannuation, a lot of shareholding. It's just that we are undertaxing housing. And again, really, I want to stress owner-occupied housing, which is where I think the egregious undertaxation is. And that is generating a lot of unproductive behavior.
I guess I'm keen to, I don't know, I'm running up on time, but dig into this discrepancy that I hear where we hear from economists and experts that, and you said earlier that we want to tax savings equally so we don't distort the way people save their money. But surely we do actually want to distort the way people save their money and not be investing in a second, third, fourth, fifth, sixth, seventh, eighth, ninth investment property, and actually be putting that into shares. So isn't there a policy argument to use a concession like CGT to do exactly that, to incentivise own occupiers, because we know the economic benefits of someone retiring when they own their own home, as opposed to people building large property portfolios?
I think that question has to be asked in the broader context of lending practices and other elements of the design of the tax system, which are really driving people to do that. I think those other elements of how we tax super are really important when we think about this. A lot of the property holdings are in self-managed super funds. So CGT is one tool that you could do that. And yeah, we can use tax policy to create incentives for people to do the things we want them to do instead of the things they don't. I think here the problem runs much deeper than the CGT discount.
But you don't think that removing the capital gains tax discount on investment properties would incentivize people to invest in more productive?
I think there'd be a small shift. I mean, it would depend. If you completely got rid of it altogether, I think you would remove a lot of the incentive for people to invest in investment properties.
And do you think if you provided a CGT discount on new supply, you take away the argument that this is going to kill new supply?
Yeah, again, I haven't studied the supply side that well. My understanding of the supply side is there's a lot of different things going on. It's not just about tax. It's also about regulation and zoning and land release. Okay. So, yeah.
Thank you very much. Thank you, Chair.
Yeah.
All right,
yeah.
Thanks, Senator Pocock. I'm just going to exercise Chair's prerogative here and just bowl up a couple of further quick ones to Dr. Brunig. Look, firstly, the amount of the percentage of the benefit of the capital gains tax discount going to the top 1% of income earners has increased sharply over time. So it's gone from 39% in 2009 to 59% today. Why is that?
I don't know. I imagine it's because there's been a concentration of, there's been a larger increase in wealth for that group than there has for other people. It would seem like a mechanical consequence of that, but I haven't actually looked at that number. Yeah, sorry.
Okay, no, that's fine. And look, finally, we heard from Associate Professor Catherine James yesterday, who argued that OECD countries that have implemented a dual tax system have seen economic inequality grow and a high percentage of capital gains continue to flow to wealthy people in those societies. Have you looked into that at all, and do you think implementing a dual income tax system would improve economic inequality in Australia?
You know, what we've seen, I guess, around the world is global inequality has reduced dramatically. So poor people in poor countries have gotten rich much more quickly than rich people in rich countries. Simultaneously, in wealthy countries, we've seen relatively small increases in inequality within countries. Australia's actually had less of that than many of our peer countries in the OECD. I think the design of your dual income tax matters a lot for inequality. And you know, we are in a world where there is a big return to being a superstar. And part of this inequality is that, you know, it used to be that if you had a good idea, you sold it to the, you know, if you were American, you sold it to the 300 million people in your country. Now you have a good idea, you sell it to 8 billion people in the world. And so partly this growth in inequality is that the returns to being really good for those people at the very top have gotten much higher. That's a global phenomena. I'm not sure what we can do about that, but I think making, you know, our overall tax system fairer and better probably is a no regrets kind of thing that we can do.
All right, thanks very much, Dr.
Can I make one other observation, actually? And this is perhaps in response to Senator Pocock as well, is that I think in Australia we also have kind of gotten used to the idea that property is always going to inflate at a higher rate than other things. And that is not generally true around the world. We have seen lots of times when property prices have fallen or have not grown as fast as other assets. And so partly I worry about anything that's based upon an assumption that property is always going to grow faster than other assets. I'd rather have a tax system that's kind of robust to that changing. I'm just thinking about some of your arguments about why we would only put CGT, why we would only take CGT off investor properties would be sort of based on a premise that that's where the rents are always going to be accumulating. And that may not be true. So I would worry about that.
But you don't think in a country where we have a rising population and incentives to invest in investment properties where you get a capital gains tax discount and you can negatively gear it on your way to that CGT discount, clearly, like, surely it's only upwards for property prices while that's the case.
I think a lot of it will be determined by if population growth changes, that could change. If we suddenly change laws that bring on a lot more supply, that could change. So, certainly the U.S., in spite of population growth, had big periods where property prices actually fell. So it can happen.
Thank you.
All right, thanks very much, Dr. Brenning. On behalf of the Senate and the committee, thanks for taking the time to come in and share your expertise with us today. Appreciate it very much. I now welcome via video conference representatives from the Organisation for Economic Cooperation and Development and Mr. Cathal Leslie. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please state your full names and the capacities in which you appear today? And we'll start with the OECD representative, please.
Thank you, Chair, and good morning. My name is Diana Harani, and I'm representing the Organisation for Economic Cooperation and Development, or the OECD.
Hi there, my name's Cathal Leslie, and I'm appearing in a personal capacity.
All right, thanks very much and welcome to the hearing. I invite each of you, if you wish, to make an opening statement to the committee.
Sure. Would you like me to go first?
Yes, please. Thank you.
So thank you, Chair and members of the committee, for this invitation. I'm happy to be participating in today's hearing. At the OECD, we've been doing a lot of work on the taxation of capital. In the last few years, we've released reports on the taxation of household savings, inheritances, housing, and wealth. We've also recently published 2 working papers directly relevant to the taxation of capital gains. One paper comparing the taxation of labour and capital income across OECD countries, and another exploring country experiences and challenges in taxing capital gains. In general, our work has found that reforming the taxation of capital could raise additional revenue, enhance efficiency, and reduce inequalities. Recently, many countries have seen renewed interest in the taxation of capital gains, due in part to evidence of high concentration of gains among the wealthiest households, which have been documented in academic studies from different countries. Progress on the international tax transparency may also be seen as an important opportunity for reform. The recent developments have increased tax administration's visibility over taxpayers' foreign assets and income, making them much better equipped to tax capital effectively. I'd like to share a few facts about how OECD countries tax capital gains and briefly touch on some recent questions and debates surrounding capital gains taxation. In general, across the OECD, countries tax capital gains on a realization basis, meaning when assets are sold rather than when the gain accrues. Most OECD countries also tax capital gains on a nominal rather than real basis. Many OECD countries tax capital gains at lower statutory and effective tax rates than other forms of income. This may be through lower flat taxes or by taxing capital gains with other forms of income, but granting special relief for gains, as is the case in Australia. Specific assets may also benefit from further relief or full exemptions. For instance, main residences are often exempt from capital gains taxes in the majority of OECD countries, while some countries also provide special exemptions to sales of small or closely held businesses under certain conditions. Different arguments have been used to justify preferential capital gains tax treatment, although some are more backed by evidence than others. For example, there's little evidence to support relief aimed at increasing aggregate savings, domestic investment, or broad-based entrepreneurship. On the other hand, there's stronger justifications for relief that relate to mitigating double taxation or taxing inflationary gains, although these objectives could also be addressed through targeted measures rather than broad capital gains tax relief. What we know with more certainty is that the way capital gains are currently taxed in OECD countries can lead to tax minimization strategies, revenue foregone, and may create horizontal and vertical inequities. Recently, there have been some proposals to reform the design of capital gains tax in different countries. For example, there have been renewed discussions about explicit inflation indexing, which is in place in some OECD countries, or approaches to smoothing capital gains over time, which are designed to mitigate the increase in an individual's liability due to large one-time capital gains. However, many reforms come with practical challenges for tax authorities to bear in mind. These are some of the issues that we have observed in recent years, and I look forward to discussing them further with you. Thank you.
Thank you, Ms. Harani. Mr. Leslie, do you wish to make an opening statement?
Yes. Thank you for the opportunity to appear today. My submission argues that Australia's capital gains tax discount is poorly targeted, it's regressive, and contributes to capital misallocation, particularly by encouraging speculative investment in existing houses at the expense of more productive uses of capital. The key point is not all capital gains are created equal. Most capital gains on residential property do not reflect productive investment or risk-taking. They largely reflect windfall gains on underlying land values, driven by population growth, planning decisions, and public investment in infrastructure. Yet these gains receive the same or sometimes more generous tax treatment as genuinely productive investments or work. The interaction of the CGT discount with full interest deductibility, light land taxation, and easy access to credit makes leveraged investment especially attractive on a after-tax basis. In effect, the CGT discount kind of completes the circuit for housing speculation. Losses are deducted against labour income, while gains are taxed lightly on exit. So by taxing land uplift less, we must tax other things more. And this diverts capital away from more productive business investment and also weakens our productivity growth. The distributional consequences are significant. So assets subject to the CGT discount are disproportionately held by older and wealthier households, and therefore it contributes to both wealth inequality and intergenerational inequality. My submission recommends reducing the CGT discount for residential investment property while considering reforms in the broader tax ecosystem, including the interaction of negative gearing, stamp duty, and land tax. My submission also highlights two other additional distortions. First, the way CGT rules discourage older owner-occupiers from renting out spare bedrooms, contributing to the underutilisation of our housing stock. And second, the way CGT rules penalise in-life gifting while allowing large unrealised gains to pass untaxed at death, encouraging capital lock-in and avoidance strategies. Taken together, the reform direction is straightforward. We should be taxing land windfalls more. We should be ending indefinite deferral. We should reduce the CGT wedge between owner-occupiers and investors where appropriate. And lastly, we should be cutting taxes on workers and businesses. Thank you.
Thanks very much, Mr. Leslie, and I'm sure that we all have quite a few questions for you both. And Dr. Harani, could I thank you for staying up late? I understand you're in Europe, so we very much appreciate you. I think it might be about midnight where you are, so thanks for taking the time to stay up for us. And can I say your paper last year on capital gains tax discounts has been very helpful to the committee, and it's great to have comparisons with a range of other countries. Could I ask, in comparing OECD countries, have you done any work around which countries have the smallest gap between the taxation of capital income as opposed to the taxation of labour income?
Yes. So we actually have two recent working papers. One is the one that you have just referred to, which is about the taxation of capital gains specifically. But about 4 years ago now, we released a working paper called about the taxation of labour and capital income. And in that paper, we calculate effective tax rates on different types of incomes. One is labour income, so we calculate effective tax rates on wage incomes for individuals across the income distribution and across different OECD countries. And we compare those effective tax rates to the taxation of dividend income, and the same thing for capital gains. And so what that paper broadly finds is that almost universally capital is taxed more favourably than labour, although there are some important caveats to that. I mean, when we compare the effective tax rate of labour income that is received by an individual at an individual level, we find that in almost all countries, labour is taxed more heavily than capital. But then we also take into account the firm level taxes. So we say, well, what if we said, what is the total tax burden on a particular type of income? And we look at labour and we compare that to the taxation of dividends, just as an example, and we take the firm level taxes, so that's the corporate income tax rate and the employer's social security contributions in countries where they exist, because I know Australia is a bit different. We see a similar story that, in fact, in many countries, Australia included, that even after you account for those taxes, capital is taxed more favourably than labour. But that said, the wedge between the two does shrink. And then on the other, in minority of countries, there is a different result. That said, that result really attaches to dividend income. If you were to do a similar analysis for capital gains, I think it would be a much more difficult story to tell, purely because trying to come up with a pure effective tax rate that incorporates the individual level and the firm level when you are talking about capital gains is actually not an easy exercise, which is not why we didn't do it. But suffice to say that we think it would be a similar result.
Okay, thanks. That's helpful. Your report states that in 2022, 41% of the benefit of capital gains tax discounts went to the richest 1% of taxpayers in the UK. In the same year, 54% went to Australia's top 1%, and that's climbed to 59% now. The UK is generally more unequal than Australia in income and wealth terms. So are you able to explain those numbers in that context? Is that just our sort of national obsession with housing in Australia, or is there something else going on there?
I mean, there could be a number of things going on there. We didn't directly look at why there are those differences between the two countries. I mean, it could simply be, what are the particular assets that were realised in the years that those figures were compiled. I mean, I wouldn't be able to comment on exactly like why it would differ in that regard. No, that's fine. Thank you. We've heard evidence, and I think there's some truth in this, that figures like the percentage of the value of the capital gains tax discount that go to the top 1% are in part explainable because in the year that people realise their capital gain, that bumps their income up into a higher bracket. Have you done any work that would allow us to understand whether, even leaving that particular effect aside, the capital gains tax discount would benefit higher income or higher wealth people in our society? I mean, I think that you probably have heard a great deal about this over the course of this hearing, but I mean, what we see in the data, and this is consistent across a lot of countries, is just the concentration of wealth at the top. So when we look at the figures of what we call realised capital gains, we see the outsized share of those realised capital gains accruing to top income, where individuals with high incomes and wealth. Now, when it's not necessarily a housing story, because when you actually, in some studies where they've taken out housing wealth, that inequality is even starker. So, and that's down to the fact that where we have seen empirical results from countries, we've seen that actually there is a very high concentration of business wealth at the very top of the income distribution. And this is particularly stark, not just when we're talking about the top 10%, but really like the top 1% and the 0.1%. That's when we look at realized capital gains. Then when we look at unrealized capital gains, for where we have really even less data, because this is the type of thing that's not very easily observable by authorities, but there is evidence of really significant concentration of wealth at the very top when we talk about unrealized gains. And a lot of this is business assets.
All right, thank you. That's helpful. And then I've just got one more question for you, Dr. Hirani, and then I have some questions for Mr. Leslie. But in the OECD's latest economic survey of Australia, it said removing some of the favourable tax treatment of residential property ownership, including capital gains tax concessions and negative gearing, would help cool demand and could help mitigate upward pressure on house prices. Could you just talk us through the effect of that and how you arrived at that conclusion?
So in fact, that study was done by the economics department. So I can't personally speak to the findings of the colleagues who put together that survey. I mean, I think that we can say that with probably more certainty that there is an interaction between the capital gains tax concessions and inequality. The effects for the property market is something that is not my area for me to comment on. That said, I think that when we are talking about the impacts of taxation on a choice of investment vehicle, I think it's really important for us to bear in mind the total tax burden over the lifetime of an asset. So when we talk about, say, taxation on residential property, we really need to take into account the cumulative effect of taxation, say, on rents, stamp duties, transaction taxes, any property taxes, and capital gains at the same time. Because that's really what factors into a decision of an investor to invest in one type of asset over another. And in fact, when we did our report on the taxation of household savings, that's the kind of lens that we used to analyze this question. It's to say, well, if we're going to look at what is the effective marginal tax rate of the next dollar that I invest, as an investor, I would want to look at the lifetime of that asset and see what is, say, the tax rate on that asset would be. And that differs based on an individual's income level, and it can differ, for example, based on the holding period. So when we did this work, and now it's quite dated, my understanding is that the capital gains tax component of that total tax burden was smaller than the other taxes. But I will leave it at that, because I think that this is one of those questions that I'm not best placed to answer.
All right, sure. Thank you. And just in that answer that you just gave, you referred to the relationship between the capital gains tax discount and inequality. To be clear, is it your position that if the capital gains tax discount was reduced or abolished, that would reduce economic inequality in Australia?
I think it would get at one of the drivers of inequality. So not only does a favourable tax treatment of capital gains tend to accrue more towards high-income individuals, because they're the ones that hold the assets that benefit from the gain more so. We also know that people choose the types of tax minimization strategies that people employ sometimes also have this in mind. So we know that people respond to differences in tax rates. For example, if I'm an individual that makes labor income, we have seen empirical evidence of individuals who would face an incentive to incorporate, for example, receive that income as dividends instead of labor, or even retain earnings within a company and choose to take that income as a capital gain later later on down the track. That is also a source of inequality. That is a source of horizontal inequality in that two people, one who would make their income as a labor income and another who earns their income as a capital gain, potentially in this doing a very similar thing, facing an inequality that is tax driven.
Thanks, that's helpful. And Dr. Hirani, I'm sure my colleagues will have some further questions for you, so if you could stick with us, that'd be much appreciated. But Mr. Leslie, I wanted to thank you for your submission, because it really put up in lights the distinction between land and productive economic activity. Can I just start by asking, how much do you think our sort of national obsession with property, which I guess you'd characterise as an obsession with land appreciation, how much does that obsession suck Australia's productive potential into its orbit, and how is and how much is the capital gains tax discount feeding that beast?
So, in terms of quantifying it, I think one way to look at it is, we need tax to fund different things in the economy. Australia has quite high rates of tax on, like our PRT rate's quite high, our corporate tax rate's quite high. So to the extent that we have this preferential treatment to land windfalls, that's negatively impacting our investment or the ability to invest in other sectors of the economy, simply because our CRT rate is so high, workers are disincentivized from working. Yeah.
All right, thanks. The general thrust of your submission was that we need to shift the tax system away from encouraging unproductive speculative investments into productive parts of the economy. Actually, is that a fair summary to start with?
Yes, that's fair.
Yeah. You've said that the combined effect is that the CGT discount turns publicly created increases in land values from infrastructure development, migration planning rules into private, lightly taxed windfalls. Land taxes are the obvious way for the state to recapture at least some of those private windfalls. That would require fairly, as we say in this building, bold political ambition to deliver. In the absence of that bold political ambition, are there any alternatives to address that problem?
Yeah, so I very much see treating different CGT assets differently, I don't think is a perfect solution to this problem. Like you said, to increase land taxes is administratively it's difficult. It's not necessarily popular. A second best in my head would be to split out buildings from land, and it's very rarely done internationally. I think Spain does it on a subnational level, and Taiwan also does it. And basically, if there's uplift in the land value appreciates, that's taxed at a separate higher rate every time there's a sale. So it's kind of like a CGT that's just on the underlying land. But again, it's not common internationally, which makes me think we're kind of in this third best world.
All right, thank you. And last question from me for now. You say that the capital gains tax discount widens the wealth gap between owners and renters and helps explain why Australians are entering home ownership later in life, if ever. The property industry would dispute that and does dispute that. Why would you say the property industry is wrong when they take issue with that statement?
Well, I mean, it's to some extent, if housing is somewhat rival, you're either a renter or an owner-occupier. And from the modelling that I've seen, once you take away the CGT discount, on net, investors sell their assets to owner-occupiers. So I think there was one study, I forget the name of it now, but about 1 in 8 renters would move from renting to the owner-occupying. So I found that compelling. I think the impact of both negative gearing and the CGT discount makes it very attractive. The ability to borrow large sums of money to invest in property can often put investors at a better footing than a potential owner-occupier, especially someone who's quite young.
All right, thanks, Mr. Leslie. Senator Whittaker.
Thank you. Thanks very much to both Mr. Leslie and Ms. Houdani for appearing before us today. Dr. Houdani, I really appreciate your time. I have some questions. I'll go to Mr. Leslie first. And much like the Chair said, the submission was really useful, I guess, in stepping out some of the impacts that the CGT discount has on the economy. And I'm particularly interested, and we've heard a lot in hearings yesterday about, the investment in unproductive assets that's encouraged by a discount on capital gains tax versus investment in productive assets. I'm interested if you can talk us through what benefit investment in productive assets would have on the economy more broadly, but then also in particular what benefit that might bring to low and middle income earners.
Yeah, so let's say we have greater business investment. So let's say we took this money from these land windfalls, basically, in the housing sector, and we reallocated that to incentives to invest in the productive sector. Greater investment in capital would increase the marginal productivity of labour. So studies have shown that increased investment typically leads to larger wages. So even for people who don't necessarily hold capital assets, through greater investment in the economy, they would benefit from that. So, yeah, it would spread.
Mm-hmm. And, what kind of productive investments would you envision benefiting from the removal of this kind of discount, encouraging investment in housing?
Yeah, so I think it very much needs to. Just taking away from housing, I think the money does need to be reorientated somewhere else to encourage investment. In terms of what that specifically would look like, I wouldn't necessarily, it could be the education sector, it could be technology sector, or the medical sector. It would just depend on what current activities are not feasible because of a high, let's say, corporate tax rate, and if that came down, what would suddenly be possible.
Mm-hmm. The current CGT discount, of course, replaced the indexation arrangements. Do you have a view on one versus the other?
So on indexation, I note that I think it's only 3 or 4 countries do that, and I know that it was removed one of the reasons why it was removed was for administrative complexity. My understanding is that it would be easier now to implement the process just because there's these new, new technologies. I still just wonder whether, given that it's so unpopular internationally, whether it's a good idea. But that's probably the extent of my thinking on that. I think Diana will probably have a better idea.
Yep. Okay. One of the things that I think your submission very helpfully sets out is the impact of the CGT discount on effective marginal tax rates in comparison with a dual income tax system. Can you just talk us through that analysis a little bit?
Yeah, so I had a particular piece in there showing the interaction between negative gearing and the CGT discount. It was a very stylized example, but basically it just showed how if you have, let's say you're a top labour income earner, you're able to deduct at 47 cents your costs. And then if you make a capital gain, that's being taxed at 23.5%. So you're kind of able to arbitrage from your labour to your capital. In a dual income tax system, you're not able to do that deduction process against your labour income. Any costs that you have would be deducted only at the rate in your capital income section. So that's 23.5% in the capital income account. It's kind of flat throughout. Your deductions are deducted at the same rate as what you'd be earning.
Mm-hmm. Could you talk a bit more about some of the ways the capital gains tax arrangements interact with other parts of the tax system?
Yeah, so one particular issue I see is the wedge between owner-occupied housing and investment properties. So right now there's a lot of almost vacant homes in very well-located areas. These are particularly what were once family homes. The children have left, and now it might just be one or two of the parents. If a parent chooses to, or makes the decision to rent out part of their house, their spare bedrooms, suddenly they lose some of the CGT exemption. So it goes from being a 100% exempt to it's like a quasi discount based on the length of time that you're renting out the spare bedrooms and how much of your house you're renting out. So when someone's making the decision on whether to rent out those spare bedrooms, they have to weigh up, okay, I'm getting more rental income, but I'm losing this CGT benefit, as well as I'm gaining this huge administrative complexity late in life. I have to fill out a tax return. And for some people, it may just not be worth renting out those spare bedrooms. So there's so that kind of, that difference between owner-occupied and investment properties is also kind of contributing to underutilisation of housing. And so perhaps just to be really explicit here, what impact might that have on the rental market? Yeah, so this would reduce the supply of rental properties in the housing market. So if we were able to better use our existing properties, it would help reduce rents in the market. Australia has some of the largest homes. It has, I think there was a stat, it's 85% of properties have a spare bedroom. So there's a lot of slack out there. It's just not being used. And of course, people have spare bedrooms for all kinds of reasons. But if we could just utilise some of that, it would make a big dent in our housing crisis.
Thank you, Mr. Leslie. I could keep going, but I'll move on to Ms. Houdini just for some Ms. Hirani for some questions. Thank you for your evidence so far. One of the things I'm interested in is whether you've done any work on the analysis of the impact that CGT and like discounts around the world has on both housing prices and on the rates of home ownership.
I can't say that we've looked at this in great detail. I think that when it comes to house prices, there are so many different drivers of housing market trends. I mean, tax is one of the many potential drivers. I think that you would have already heard. I mean, what it comes down to often is also supply and what's driving supply. And I mean, tax can be one of them, but I think that there are many other factors. And for me to say that purely we would attribute a certain share of house price growth to tax, I think would be a big undertaking for us to do for every OECD country. So
Sure.
Unfortunately, we haven't done that.
Yeah, no, that
not yet
makes sense. one of the, in the paper that the OECD released on CGT, it talked about one of the better justifications to this kind of discount is relief to taxing on inflationary gains. I guess, can you talk to how our system here in Australia sits in relation to that kind of specific concept?
Yeah, so I mean, Australia is not unusual in its tax treatment of capital gains in that there is some kind of relief for taxation. So, I mean, it's countries around the world all refer to some of the different common justifications for taxing capital gains more favorably than other forms of income. And so one of the quite common justifications is this concept of not wanting to tax the inflationary component of that capital gain. And countries provide that compensation in different ways. So, but in most cases, it's a broad form of relief. So in Australia, we have the 50% discount. There are other countries that also have a percentage discount, whereas some countries do have this dual income tax system, which, for example, has a flat rate for capital income and a progressive rate for labour income. But what we call these are all broad-based forms of relief in the sense that they try and kind of capture different rationales in one measure. That said, I mean, it's when you referred specifically to the inflationary component of gains. I mean, there is evidence out there that analyzes this, that says that often these broad forms of relief overcompensate individuals for the inflationary component of gains. So when we look at the international scene, a lot of countries have other justifications. So it's not just that they don't want to tax the inflationary component of gains. There's also common arguments which are, for example, wanting to support domestic savings and investment, entrepreneurship and so on. But as I mentioned also in my opening statement, that when we actually drill into these justifications for tax relief, often they are not as supported. Some of them are more supported by evidence than others. And I mean, we could talk for at great length about which ones kind of hold more water.
I guess to that final point, in your view, where does Australia's system sit against that kind of a test?
Do you mean in terms of whether we're justified in providing a 50% exemption?
Yeah.
I'm sure you can appreciate that I can't, in this context, provide a policy recommendation.
Of course, yeah.
But what I can say is that in our analysis of all the different countries, that Australia is not unique in having a really robust discussion about the taxation of capital versus labour at the moment. I think that many countries are talking about whether or not the broad-based relief is more than what is needed compared to the justifications. And one of those justifications is, for example, the inflationary component of gains. There are people that are advocating for things like having an explicit inflation adjustment to the capital, to the final capital gains payable, while there are other advocates for, say, things like having a compensation for the risk-free rate of return. There are some that think that there needs to be a little bit more than an inflation adjustment to be able to support entrepreneurship in a country. But as I said, like there are basically different approaches, and whether this kind of broad-based relief, something like a 50% discount or a lower flat rate, is something that is the subject of an ongoing discussion in many countries.
Mm-hmm. Just a final question from me. Based on your analysis and the work you did particularly on your paper on this, what impact does a CGT discount have on intergenerational equity?
We haven't done specific empirical research on intergenerational the intergenerational impacts of a capital gains tax discount. But that said, what we know is that, so we did do a separate report on the taxation of inheritances. And one thing that we know is that basically there is a lot of concentration of wealth at the top, and a lot of that is intergenerational. Now, when we look at the international context, there are some countries out there that don't tax capital gains that are inherited in the same way that Australia taxes capital gains that are inherited. So basically, in some countries, there is what we call a resetting of the cost base of capital gains. So if I inherited the assets, I would only pay the capital gains from the moment that I inherited it, as opposed to the moment that that asset was purchased by the person by the benefactor, basically. Australia is not in that situation. Ultimately, if a gain is realised, it will be realised on the entire term, the holding period of the asset. That said, there are a minority of countries that tax capital gains at the point of death. They treat that, they call that a deeming event. And so in that regard, when you have an event where it is taxed at the point of death, that can have the effect of reducing intergenerational inequality, but at least Australia is in a situation where we don't reset the cost basis at the point of inheritance.
Okay, thank you, Chair.
Thanks, Senator Whittaker. Senator Bragg.
Look, thanks very much for being there. I guess my main question is, what do you think about the supply dynamics in Australia? Isn't that an important part of the housing debate?
Senator Bragg, I'm just checking you're asking that question to Dr. Harani.
Of course.
Yep.
As I think I've already mentioned, there are a lot of different factors that come into play when it comes to the supply of housing. I think that the tax treatment of housing is one factor,
Sure.
But when it comes to comparing the contribution of the taxation of housing compared to the many different other factors that determined house prices, I think we personally haven't done that comparison, but I believe that you've received evidence, I think, during the course of this inquiry, and I wouldn't want to particularly question any of those evidence or provide a comment on them at this stage.
So you work in the OECD, but you both, you're in Europe and Mr. Leslie's in Australia, is that right?
No, I used to work with Diana. I still live in Paris, but yeah,
Okay,
I'm
so
not at the
you're both in
OECD
Europe.
anymore.
Fine.
Mm-hmm.
Okay. But I mean, you perform analysis of OECD member countries, right? I mean, you do all sorts
It's
of different...
me? Sorry, I don't know.
Well, sorry, I mean, aren't you both working at the OECD?
No. No, I'm
Sorry, I
no,
misunderstood you.
representing
Sorry. Where are you,
Yeah.
Mr. Leslie?
I'm just working freelance, but I am
You're
based
freelance,
in
okay,
Paris.
well, that's fine.
Yeah,
Well, look, I guess my question is for you, Dr. Harani, then. So, I mean, in terms of the OECD's positions on these things, I mean, you must look at the overall housing supply figures as part of your analysis of Australia. I mean, why don't you think we're able, I mean, are there any particular reasons why we haven't been able to make any traction on supply?
I think that this is just quite simply not my area. So just to clarify that my expertise is in taxation, so capital gains taxation, the taxation of capital. And I think that that you may wish to be in touch with some of my colleagues who work on housing dynamics, and I'm happy to provide those contact details for you at a later point if that's of interest to you. That's
fine. But I mean, we're obviously looking at what the OECD is presenting to a parliamentary committee in Australia. Now, what you're saying is you're submitting something which is quite narrow in focus. You're focusing on the taxation component.
Yeah.
Okay. Well, I mean, obviously, as policymakers, we don't get to just separate one thing out from everything else. I mean, we have to look at everything. So I think it's worth noting for the record that your work then to the Senate, you haven't considered the supply dynamic. Is that right?
Not me personally, no.
Is that right?
That's right. I personally have not, that is not my area of research. No.
Okay, so therefore, if there were changes to the CGT arrangements, those would in some way affect supply, though, wouldn't they?
It's possible, but to put an order of magnitude on that is not something that I would be comfortable doing in this session.
No, I understand that, but I guess the point I'm trying to make is that it's, you know, it's all well and good for people to have opinions about different components, but as policy makers, we need to look at all of the implications of making a judgment. So by coming forward and saying that, you know, there are implications of changing taxes without looking at the supply side, I think it tends to make for a fairly one-dimensional debate, for want of a better expression. So, okay, so you haven't taken into account the supply components, but effectively your research is focused solely on the CGT discount in terms of what exactly is your scope of work then?
So our work has really been focusing on tax policies, questions of tax policy, and our recent area of work has been really about questions of the taxation of capital. We've done a lot of work focusing on the taxation at the top end of the income distributions, and the implications of different approaches to taxing capital and labour and on overall inequality, for instance.
Tax, and so you've looked at the impact of tax on capital and labour.
Yes.
Okay. But this is a inquiry into the capital gains tax discount, which if it was changed would have an impact on the supply side and potentially the demand side. So do you have anything to say about that?
I wouldn't have anything further to say about the supply of housing. I wouldn't want to mislead the committee.
Okay, all right, thank you. Thank you, Chair.
Thanks very much, Senator Bragg. Senator Pocock.
Thank you, Chair. Thank you for your time this morning here. Dr. Hirani, in your research looking at OECD countries' approaches to taxing capital gains, have you examined any examples where countries have used CGT concessions as a way to incentivise new housing supply?
I believe that there are countries that do that. I think that it's a different question whether countries have actually undertaken an evaluation of the merits of those policies and whether they've achieved those objectives. And I'm not familiar with anything that's like linked specifically to something like the capital gains tax discount.
Okay, and so I guess looking at it more broadly, relative to other OECD countries, how favourable is Australia's tax treatment of investment properties?
So it's not unusual for countries to have some kind of favourable tax treatment for investment properties. So there are other countries, there's some countries that fully exempt them. It's a minority. There's other countries, some that tax them completely like other kinds of income, and some that are somewhere in the middle, which is like Australia. But I think that it's really important when we do these kinds of international comparisons is not just to look at taxing at a particular point in time, which is the taxation at realisation and the capital gains and the comparison of the capital gains tax treatment. Because when we talk about the incentive for someone to invest, for example, countries vary vastly in terms of the cumulative taxes that are levied on housing. So where, for example, Australia may have a 50% discount on capital gains, but say negative gearing on is allowed for against their rental income, another country may have a higher tax rate on capital gains, but no opportunity to deduct mortgage interest. So I think that it actually makes more sense to, when we do cross-country comparisons, to look at the full tax burden basically over the lifetime of the asset.
Okay, thank you. And are you aware of any examples where winding back capital gains tax discounts has reduced housing supply?
I'm really reluctant to get into the question about housing supply in this context, and I think that I haven't seen a lot of evidence that makes that link.
Okay, thank you. Maybe just finally, Mr. Leslie, a lot of the concerns raised through this committee have been how in Australia we tax work a lot more than we tax wealth, and just interested in your view in trying to tackle the growing inequality we're seeing in Australia when it comes to wealth, how important you think dealing with the capital gains tax discount on investment properties is in the scheme of things.
Yeah, so I think particularly with investment properties, it's kind of because so much of it is generated from these windfalls, I think it's somewhat of a low-hanging fruit. But I would also say in the grand scheme of things, even if you were to reduce the discount, it wouldn't be like that much money. I think there needs to be a much broader discussion about tax reform in this country. I think questions around, what we do with our GST needs to change. We need to make greater use of land taxes as well. I think we need to take, right now, the burden on personal income tax and corporate tax, I think, is too high. And I think there really needs to be a shift away from those taxes.
Thank you very much. Thanks, Chair.
All right, thank you. Just because we've got a couple of minutes left, Mr. Leslie, your submission suggests reducing the discount rate on residential property investment, I believe, and complementing any capital gains tax discount changes with broader tax reform, which you've just mentioned. I just invite you, if you're willing, to inform the committee sort of what scale of reduction you would suggest, and could you also please reflect on the interaction between the capital gains tax discount and negative gearing, and whether you think reform in both of those areas would be beneficial?
Yeah, so I think in terms of if we were to change the investment property discount, I think broadly to maybe 25 or 30%, roughly equivalent to what the long run average for inflation has been, is probably a reasonable place to go. In terms of negative gearing, I think that should be ring fenced. I don't think it should be applied to labour income. I think we should treat our savings income separately. Right now, the practice of negative gearing is very regressive. I think it's contributing to inequality in this country. So I think that's another thing that could be curtailed, and we could use that to fund tax cuts elsewhere in the system.
All right, thanks very much. And on behalf of the committee and the Senate, thank you sincerely to both of you for giving us your time at potentially inconvenient parts of the planet that you are on. So we thank you very much for sharing your expertise and for giving evidence today. Thank you very much.
Thank you.
Thank you for the opportunity to appear.
The committee will stand adjourned for 15 minutes. and the committee will recommence with Mr Bernie Fraser. Mr Fraser, I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please state your full name and the capacity in which you appear today?
Bernard William Fraser. I'm just here as an independent citizen.
Thank you very much. I invite you, if you wish, to make a short opening statement to the committee, following which the committee will have some questions for you.
Well, in short, I'm not a fan of the discount on the capital gains tax that was introduced by the Howard government at the end of 1999. I would like to see ordinary Australians, all Australians, including Australians of modest means, have a reasonable opportunity to own homes and live in homes and raise families in homes, and to get hold of decent housing at an affordable price is something that is not that dream of doing that, getting a decent, affordable home, has disappeared for many of those people of average means, and we all know what an explosion in house prices has occurred in the last 20 odd years or so, and that has had the effect of making the dreams of all Australians, but particularly those on modest incomes, seen those dreams fade away. They're just not affordable the way prices have developed. And it's not just those people that are out there in the housing markets now and are feeling the disappointment, but there are all those other generations of people, young home buyers or prospective dreamers of home buyers, that are watching what's going on in the marketplace from the sidelines, but they must be watching with awful dismay. So until we can get a more affordable housing situation, the opportunity for all Australians to access decent housing and own a house and live in a house and raise families in the houses, and there are positive benefits for people in owning their houses, and it's that sort of the benefits of owning a house, the security and the other things, the quality of life that can be improved by owning a house, is what really motivates me to express that opening comment that I'm not a fan of that discount, because that has been one of many factors that have contributed to the blowout in prices of houses and the rendering of unaffordability in respect of houses for so many people of average incomes and the generations of prospective owners that are watching from the sidelines. Now, an awful lot of things have to happen to bring back a reasonable degree of affordability to the housing market that ordinary Australians can benefit from, because there are so many factors that have contributed to the explosion in house prices, and so many things have to be done on both the demand and the supply sides to get back to that sort of situation, if we can ever get back. It's not going to be easy, and there's so much that has to be done, and there's not a great deal of indication that there's a lot of support to get on with dealing with these demand and supply problems and dealing with the difficulties on those fronts that have contributed to the prices explosion. But there is, in my view, an observation, I think, that there's more talk about doing things on the supply side than there is on the demand side. And I suspect that that's a throwback to the fact that a lot of politicians in particular find handling tax changes is a bit sort of toxic and would rather avoid it. But having said that, I still and I believe it's true that there are some sectors of the community. There is, in fact, what Alan Collett called a cartel of people who are against changing the tax, dealing with the tax changes, because he says this cartel, which comprises existing homeowners, property developers, and not least lots of politicians who like to see house prices rise and go on rising because there are votes in it. There are for politicians, and some see it that way. There's profits in it for banks and for developers, and the people who own the houses benefit from their wealth goes up as the prices go up. So despite that sort of toxic approach to tax changes, I think that a case can be made for doing away with the discount on the capital gains tax, abolishing it altogether, and I believe that that would be a useful step, one of many steps that are required to moving back to an affordable housing market for all Australians. Now, there's not a lot of enthusiasm for that, and it's not going to be easy. But I think it's worth working on the Labor Party, and the Greens seem to be that way inclined to make this sort of change. It's not going to be easy to do, but our present Prime Minister likes to declare that Australia is the best place in the world for Australians to live. Well, he's a bit premature. It might be, and it could be, but it's not at the present time. But the desire to do that, to get to that sort of situation, would benefit from doing away with this contributor to house inflation prices, and provide an opportunity to take a step closer to Australia being a better place to live in. But you can't keep saying those sorts of things when you look at the housing situation and not do anything about it. So I think it would be worth persevering with that argument and putting pressure on, particularly on Labor Party people, to do something about this situation. And I would think that's one thing that could be pursued on the solution side, on the demand side, and of course all these other things on other demand side, migration and population growth, and all the supply things, not enough land, not enough skilled workers, and all those kinds of contributors to the supply problems. They have to be tackled too in some way or another. But we're talking today about the discount on the capital gains tax, and I think that's a worthy target to get politicians to think about and to do something about.
Thanks for that really strong opening statement. I just want to put something to you and ask for your reflection on it. And this is my submission. Like, right now is a historic opportunity for Australia to right the wrong of the capital gains tax discount. It's a moment in time, a political moment in time, that's there to be seized if we have enough political courage in this parliament. This parliament is made up of a House of Representatives where Labor has a comfortable majority, and a Senate where Labor plus the Greens equals enough numbers to get any piece of legislation through. Is this a time, in your opinion, for political courage? Is this a time for a tax reform package that is progressive and of genuine ambition?
I think it is a time for people, politicians, policymakers to dig up that necessary courage to do something like doing away with the discount altogether, in my view, because we have the what I've been talking about, the unaffordability of the housing market, but that's a very important part of leading to a fairer and better living condition for all Australians. It's also a way of tackling the ongoing inequitable distribution of property and wealth in Australia, and that is important. And I think looking down the track and the way so many things are developing in other areas, I think one could also say that if the present arrangements were to continue and that wealthy people did well out of buying houses and having more than one house, while the people on average means are being forced out of the market and not being able to own a house or to gain ownership and the benefits that go with ownership, and that could well contribute to further divisions in the Australian community, Australian society. So you've got the approach of doing something about the affordability, getting that back to a more realistic level, doing something about the ongoing inequitable distribution of property and wealth in Australia, and heading off divisions between the have houses and not have houses, and which are not good for developing a united society. So for politicians and policymakers and other relevant players in this game, this is a very timely a time to be thinking very seriously about taking this sort of first step on the tax front on this particular discount measure, as difficult as that might be given some of the past history, and even the Labor Party that I see is holding out the most chance for responding positively to some action on this front. They were burned, of course, by these sorts of tax measures, in recent times, and but they have to, particularly if they want to, if the Prime Minister wants to deliver this dream of making Australia the best country in the world for all Australians to live in, he has to face these difficulties and get the courage to take these steps. And it's worth trying to generate and put the pressure on them to generate this courage and get on with things. But as I say, there are lots of other things would have to be done too, but this would be one helpful first step to be taken.
Thank you. You've said, you've said publicly in relation to the capital gains tax discount, from day one I've argued against the bloody thing. You've been very clear today that you think it should be abolished in its entirety. Have you turned your mind to whether there should be any phase out or grandfathering provisions in terms of policy setting?
I'd be more inclined to wipe it out, and wipe out the discount altogether. It's come to life in a circumstance where the whole environment has been very conducive towards encouraging people, wealthy people, to invest in houses and to see house ownership as wealth creation measures. And it's not just the capital gains tax, but concession, but the interest arrangements have also boosted those benefits, and the whole tax environment has been conducive to people going and viewing housing as a wealthy asset to be pursuing, and at the expense of housing for people to live in and to raise families in and so on. So I think there needs to be some significant cutback in that whole environment that generates this view of housing as a primary investment asset for wealthy people, and revert more to the basic purpose of housing, which are there to live in and grow up in and die in even, but something substantial needs to be done, and the tax concessions would, I know we're only talking about the capital gains discount at the moment, but there are these other, the interest, the arrangements there on that front that also provide an extra benefit for investors in housing on top of the current discount. So it's something I think has to be done in the interests of returning housing to a place to live in and to raise families in, and because there are benefits in owning a house and being able to do these things, the security and better living styles and standards and so on, and they're important things, I think, and it'd be nice to break this present view and pursued by wealthy investors to make a go of housing to the expense of the more basic purpose for ordinary people to use houses for.
Thank you. I just want to take a step back and talk about tax a little bit more broadly for a moment and ask for your reflections on this. I mean, we've got a situation in Australia where if you go to work for a living and you're a nurse or a cleaner or a bartender or a plumber, like you are paying significantly more tax than someone who earns the same amount of money sitting on a couch or sitting behind a desk flipping investment properties for a living. Is that fair in your view, and should we be doing something about that?
No, it's not fair, and it's one of those. You know, my whole sort of view about this stems from a feeling that to do something about these tax concessions is a matter of fairness and of living a better life, you know, and for all Australians, not just for the people that can view housing as an investment opportunity, and it's these other people that don't and aren't interested and not capable of pursuing that opportunity. They should, as part of the fairness and avoiding these other problems like the haves and the have-nots, need to be pursued and acted upon.
Thank you. You referred in one of your earlier answers to wealth inequality in Australia. So to be clear, is it your view that reducing or, as you would argue, removing the capital gains tax discount would help mitigate against wealth inequality? In other words, would it make Australia a more equal society?
At the margin it would. There are a whole lot of things that need to be done, but this would be a helpful start in that direction because at the present time house ownership is a very profitable investment opportunity and a wealth creating business for people that can afford it, but it has the effect of driving houses away from the dreams of ordinary, more modest income people. And that is widening the gap and the inequality, and that, as I say, is something that I wouldn't like to see to go on, but would hope that the courage will come from some of these policy makers somewhere to do something about that. And even though we're only talking about the discount on the capital gains tax here, but maybe enough courage will somewhere be generated to do something about these other tax concessions on housing, particularly the interest arrangements. What do you call the? I've forgotten.
A negative gearing.
And the negative gearing, of course. You know, so the people that are pursuing houses by wealthy people investing in them get the benefit of the negative gearing arrangement. If they rent them out, and when they sell them, they get the extra bonus, and that's going to encourage these people to continue to see housing as an investment and to go after it, to demand more and more of these houses, to be prepared to pay big prices for them. make the market unaffordable, houses unaffordable for the people on the average incomes, and that's, to me, doesn't sound like a good outlook for Australian society, and it doesn't line up with the declaration that I referred to earlier on that I've heard several times from our Prime Minister that Australia is the greatest country in the world for all Australians to live in. That's not the state of play, but it could be made better for all Australians. But I think you have to be prepared to make these kinds of changes to the tax arrangements, and in so many other areas as well. On the demand side, what are you going to do about migration and population growth? But then there are all the supply side things, access to appropriate land and labour and all those things. They have to be addressed too. But this tax thing would be a good start in my view.
Thank you. It is open to the committee to make recommendations on other parts of the tax system more broad than just the capital gains tax discount. You referred to negative gearing in your answer. To be clear, are you arguing for a reining in of the generosity of the current negative gearing arrangements?
Not specifically. I'm just saying that the negative gearing arrangements along with the capital gains discount, add up to a very attractive arrangement for prospective wealthy investors in housing. It makes it a very attractive target to invest in and to go on investing in. And particularly the other part of the total picture, of course, is the absence of any inheritance or wealth tax. And so it's there for the taking from these people, but it's for a privileged section of the community. And I think something like 60% of the houses are owned by people these days. The rest 66 or something are owned by occupied houses, and the rest are rented. So, and I think that is a trend that's been occurring more and more over time, and it'll go on developing, I suspect, if the wealthy people can continue to buy up the houses and invest in them, and the more average people have to just watch that happen and pursue rental accommodation or other arrangements. And I know the negative gearing arrangements were intended, when they were put in place, were intended to help generate more wealth, more renting accommodation houses, but they haven't delivered, as we've seen. And so I wouldn't be concerned if that too were thrown into a package of tax measures to make it the market more affordable and more open to people, for all Australians, including people of modest means.
So last question from me for now, and I know my colleagues have some questions for you, but you were head of Treasury when Treasurer Keating, under Prime Minister Hawke, introduced the capital gains tax in 1985. Could you talk us through what the rationale was for the introduction of the tax? And secondly, did the subsequent introduction of the 50% discount by Prime Minister Howard and Treasurer Costello take the original tax away from its founding purpose?
I'm not sure. I was in Treasury when that happened on the capital gains. I wasn't.
Okay.
I was when the negative gearing arranged. Well, they'd come in, and I had. When I was in Treasury, I remember very clearly that I'd argued with Paul Keating that no, we don't really need this negative gearing thing. We should get rid of it, and he did. And he's never forgiven me, because there was such an outcry when the negative gearing arrangements were withdrawn by Keating and Hawke. There was a terrible outbreak all around the capital cities by developers and so on, that there'll be no houses built, there'll be no rental properties and so on. And Keating had and Hawkey had to go back and reinstate this, and it was a bit embarrassing for the then Treasurer, who still hasn't forgiven me for bringing that embarrassment about in a way. But the capital gains tax, I know there have been different arrangements. I think when it was first put in place, it was it had there was a deduction for inflation in the tax and so on. But that occurred before my time as Secretary of the Treasury.
Would you, sorry, just a follow-up quickly, do you think the arrangements for inflation would be worthwhile considering today, or would you just simply abolish the discount in its entirety?
I think it's better to get the tax concession right out of the picture, rather than messing around with adjustments for inflation, which go up and down, and you can't be sure what's going to happen. But the investors, I think, would be confident that inflation in the housing market would be, well, I don't know, I was going to say it might be more substantial or more volatile, and that might affect their interest in investment in housing and so on. But I wouldn't have thought so, because the housing market, in compared to other markets, is more stable, and it is not subject to those great big jumps you see in stock markets and so on. So I think it would be unnecessary to be going back to something like that. It wouldn't do much to diminish the interest of wealthy investors in going into housing, and therefore helping to press up the demand for housing and the price of housing to the detriment of lesser well-off people wanting to buy houses and own houses.
Thank you. Senator Dowling.
Thanks, Chair. Thanks, Mr. Fraser. I think my memory was also the same as the Chair's, that I thought you were Secretary of Treasury from 84 to 89. Does that sound about right?
Yeah.
Yeah, and I think the discount came in 1985.
Yeah. It doesn't ring any great bell with me.
Yeah, no, well, I'm not going to push you too hard on it. I'll just, because there's a lot of suggestion that maybe the indexation method is quite fair, as in, I think since 1971, CPI in Australia has averaged about 5.1%. So it wouldn't take too long for an asset appreciation to be, for inflationary gains to basically remove a discount entirely. But you don't think there's any case for any discount for inflationary gains?
Oh, I think it would be more significant in terms of helping to return to a more affordable housing market, to scrap the discount altogether and just apply the capital gains tax.
So we really saw a huge acceleration in housing prices in the early 2000s, and people have linked that to the change in 1999 to the 50% discount. But in that period, we also saw a massive acceleration in other parts of the world, New Zealand, Canada, United States, UK, and they also accelerated up and to the right, and they didn't have the same change. So do you think there's other effects such as monetary policy and credit conditions contributed to that acceleration of house prices?
Well, interest rate reductions can lead to make house prices increase the demand for investing in houses, and through that increased demand, they can add to price pressures. And I think there's been a bit of that at times, but the interest rate changes go up and down, so there are pluses and minuses at different points in time. But I don't see a lot of value in trying to make the capital, make acceptable adjustments to the capital gains tax on houses that people buy and sell that would have a pronounced effect on diminishing the enthusiasm for wealthy investors to continue to chase these assets compared to other assets, and they would have the same kinds of pressure on the demand side from this particular tax arrangement, to perhaps less so than now, but still have the pressure there pointing in the direction of pursuing and making investments in houses, and thereby driving up their prices to the detriment of the others in the market, but aren't able to invest in that way.
I think some of the economic literature that's been presented suggests that removing the discount might only improve house price affordability by 1, 2, 3%. So in terms of the hierarchy, if housing affordability was the key, was the objective, how high would you sit removing the capital gains tax discount versus other measures on the supply side or other tax measures you could consider?
Yeah, I know there are different views about the impact of the discount and the removal of the discount would be on house prices, and the Reserve Bank has come up with the sort of number that you've referred to. I find it hard to accept that if we create through taxation concessions a housing market that is very attractive to investors, that there won't be a big surge in investment in that particular asset, which would be more attractive than shares and certain other things. And when you combine that kind of demand, increased demand, the prices will go up. And if it so happens that there are problems on the supply side, that'll further reduce the supply of houses. It's going to, make those price increases pretty attractive to investors. So there needs to, all these things on supply and demand side need to happen to be pursued and developed. But I just don't. I saw I think it was Reserve Bank people that came up with the sort of very modest contribution that doing away with the discount would contribute, but I can't believe that the kind of housing market we've got out there and the way wealthy people are investing in it and are likely to continue to invest in it, that its abolition wouldn't be as small as that. I think that it'd be much more pronounced than that. That's why I think it would be a useful first step to make. It would be significant, and it would be a step in the right direction, and a sort of kick-off for pursuing all the other changes that need to be made in policy to get affordability down to past levels.
Okay. And would you see, given you're really zooming in on the housing affordability piece, would you look at having a differential discount or no discount for different classes of assets versus housing?
No, I wouldn't. I think the people that, the business people that went around and I thought contributed to this notion of the discount on the capital gains on housing also envisaged that a similar sort of discount arrangement might also apply to other assets like shares, that the people who made these recommendations were quite wealthy businessmen that would have benefited from from discount on the gains on shares, even though it didn't come up, it wasn't accepted that, and I don't think that was a good thing. But I just think it complete the picture of the housing discount was also wiped out.
Okay, thank you.
It doesn't seem to be necessary to be having to provide discounts to make people want to buy houses, and whereas, that was part of the notion behind the recommendations from the 3 business people who made these recommendations at the time. They wanted to see the discount applied to shares so that they'd get more people buying shares, and that would help in their capitalisation of their businesses and so on. But
sorry, just actually follow up on that then. Some of the evidence has also suggested we want to deliberately be trying to skew investment more away from housing into other sectors of the economy for productivity reasons. So do you see other capital forms of investment as potentially a productivity enhancing, and therefore maybe you would want a differential rate on different asset classes?
Productivity is a complicated, difficult, tricky thing, and there are lots of things that can be done including by way of tax concessions to businesses and entrepreneurs. They're the people who really have to lead the change to a better productivity arrangement, and one could contemplate specific targeted tax measures for that, but I wouldn't see the parallels with the kinds of the discount that exists for the housing market as something to model such a concession or an inducement to see actions taken by businesses to improve productivity. They're different ball games. Houses are there for people to live in and so on. Investments, businesses are there to make money, and productivity is part of that. But I don't know who was. These recommendations from the 3 business people that were appointed, I thought by the Liberal government at the time to come up with things, they put a lot of work into extending the similar sort of discount to investments in shares, but that wasn't picked up.
Okay, thank you.
Thanks, Senator Dowling. Senator Pocock.
Thanks, Chair. Mr. Fraser, thank you very much for your time this morning. I just had just a couple of questions. So one of the things we keep hearing from economists is that this is just an asset class. Housing is an asset class. I'm just wondering, should we be changing the way that we think about what housing is actually for? Exactly. It strikes me as when you're treating it as an asset class, you just start talking about tax treatments and keeping them the same. But given where we are in the housing situation, how would you think that we should be talking and treating housing in terms of our tax system?
No, well, I'm very much entirely of that view, and all the things I've been talking about so far today are geared towards trying to change that mindset to get people and politicians and policymakers and banks and developers and so on to view houses as not as business opportunities, as investment opportunities, and provide all sorts of benefits for them by way of tax and other things, but to see housing primarily as something for families to grow up, live, and grow people to buy and to grow up and to live in, and in that way make for a better society, a fairer society, with trying to avoid the divisions that we've got in our societies already in so many ways, of creating another one by having even more pronounced haves and nots in the housing industry, by allowing or encouraging and supporting and promoting these people, wealthy people, to go out and to invest in housing and to take them away from the more basic and objective and purpose of housing, somewhere to live in. And that's why I'm sort of expressed the view about taking the whole of the discount out and avoiding other things like corrections for inflation and the and some of the other tax concessions that are out there for investment in housing, the negative gearing arrangement, all those things would be part of the plan to make housing something for all Australians to view and to have the opportunity to enjoy the benefits of owning a house and raising them, living in it, raising their families in it, and without having and the security of it, without having the sort of having it as a right to be able to get these things rather than a privilege of the wealthy people to have these. And that's where we're heading at the moment, as the more wealthy people are investing and are likely to go on investing while all the incentives are there. And that's at the expense of making houses unaffordable for lots of ordinary people who would like to have a house and have the security that goes with owning a house and the other benefits that go with, raising your kids, your family in your house that you own and those sort of things. But they're going to disappear for a lot of people, if more and more of the focus remains on or goes on to housing as an investment opportunity, a wealth maker.
And just finally, you know how governments work, you know how this building works. In the context of rising inequality when it comes to wealth in this country, we're now facing a situation where you talk to younger Australians, and if they don't have wealthy parents, if you talk to younger Australians, if they don't have wealthy parents, they're very unlikely to be able to own a home, to have somewhere secure like that. How urgent do you think this sort of reform is on the pathway to trying to address this housing system that just isn't working for us?
I think it's very urgent to start making steps and seeing the affordability of housing become more realistic for all Australians, including the people that are in the market now and can't cope, but also all these waves of new generations of prospective home buyers that are sitting on the sidelines but are coming up to the situation where, they're going to get access to decent housing at an affordable price, or they're not. And if they don't, the society's not going to be improved. Distribution of wealth is not going to be made more equitable, and we're not going to be, as our Prime Minister says, that Australia is the best country in the world to live in.
Thank you very much. Thank you, Chair.
Thanks, Senator Pocock. Senator Bragg.
Thanks very much, Mr. Fraser. Just a couple of questions from me. So, firstly, in relation to supply, do you have any concerns that if the concession was removed or abolished, as you would like to see, do you think that would have any impact on the supply side of the market?
Not in itself. I think the supply problems, and there are plenty of them there, but they need to tackle urgently too, and at the same time, but having shortages of suitable land and shortages of skilled tradesmen to build houses, I don't myself see how doing away with the discount on the tax side would affect the supply, those supply factors much, really. Other solutions have to be found to find more suitable land and get more skilled tradespeople to build houses. And there are lots of ideas floating around, and there are all sorts of things being suggested, but some workable ones have to be hit upon, because until the discount came in, and in the last 20 odd years prior to that, 15 years before year 2000, there were times when houses were in demand and prices were up and down, but the supply kept up at that time, and prior to 2000, both the supply of housing and the price increases in housing were much the same. They both sort of increased prices. House prices increased about 3% a year. The supply increased by about 3% a year, but that's totally different now. That since 2000, and for a lot of factors, it's not just the discount, but for a lot of factors, prices have gone up on average about 6% a year since 2000, over the last 20 odd years. Supply's gone up by about 3% a year. So there's been that big gap, and that has to be attacked by action on the supply side in so many ways too. And there are all sorts of suggestions that are being raised. People talk about having faster trains and revisiting growth centres, setting up growth centres in areas where there's vacant land, and providing all the facilities that people like about cities. Housing facilities, hospitals, and those sorts of things, and encouraging people to go to those things. But the infrastructure costs of all those are pretty frightening. But having fast trains is pretty expensive. But there has to be things, and I don't know what you do about reducing migrants or reducing population growth. You want to get the skilled workers in from overseas to help build the supply, but if you get one skilled builder in from overseas and he helps to build a house, he's like, he could have, and this was the case in these days, as against to after the Second World War. I can remember as a kid how so many people came to Junee from overseas in 48, 49, and many of them were builders, and they built houses everywhere. But they came as sort of sole migrants. But if migrants come and they can help build some houses, but then if they've got big families to follow and relations and so on, you also have to find schools and hospitals and all sorts of other things as well. So sure. It's not quite as clear-cut as it used to be, I think. But there have to be other solutions found that will work to add to supply.
Sure. So I guess in the context of supply being reduced over the last few years, we're currently averaging about 180,000 houses over the course of the last few years. There's been 1.6 million people come to the country over the last 4 years. So, last decade we averaged 200,000 houses. So the supply side appears to be under major pressure, despite all the initiatives and all the talk. We're going backwards. So surely there would be some risk that changes to these tax settings could reduce supply, isn't there?
I don't see how the suppliers, a shortage of suppliers, would be helped by the present tax, the discount that we're talking about here today, doing away with that. But there might be other tax concessions that are targeting increases in supply and providing more materials or more training, and things are being done to make for more training of tradesmen and so on. But I think they're fairly distinct approaches, things that have to be tackled. The action that I've been talking about on the demand side is to reduce the pursuit of houses by investors and forcing up the demand and the price of houses. No, that's been happening in a way for decades and decades. It's as a kid I can remember people talking about housing as a good investment for when you retire. But up until about the year 2000, those people exercise that desire to not only live in a house but to invest in their house because of it's a good asset to have when you retire. But supply kept up with that demand in those days, and it wasn't really a lot of additional demand. It was sort of part of the same thing. You know, we want a house to build it to raise the kids and so on, but we also want to have an asset when we retire, you know, or die or pass on to the kids, you know. But what's happened in the last 20 odd years is very different from that, you know. So many people are out there chasing houses because they've been made in part by the government very attractive, tax encouraged investments, and that's forced up the demand for houses by those kinds of people who have been prepared to pay more money, but beyond the affordability of lots of other people, and that's the dichotomy there, I think.
Okay, well, finally from me then, Chair, so I just wanted to then ask you, so it sounds like you don't think it's a good idea for individuals to be investing into rental stock. I assume you have the same opinion about institutions also doing the same. I assume you don't think that major fund managers and the like should be investing into residential housing either.
I think there's been some discussion about this. It's the interest, what do you call it? The negative gearing arrangements apply to individuals, and they welcome those. But the big investors have been encouraged or asked to invest in rental houses, and super funds have been asked and so on. But at the present time, those sort of institutions wouldn't be eligible for the arrangements that individuals get. And I think that's a bit of a stalemate there, although I'm not up to date with what's going on on that front. But I've often had a fair bit to do with some super funds in earlier times, and have often questioned some of my former colleagues about why the super funds haven't been more active in building blocks of houses for rental, you know, and so on. And they haven't really. A couple of them have tried and haven't done much good. But they haven't had the benefit of the arrangements on the tax side, the negative gearing benefits, which individuals get. I think if those negative gearing benefits became available for the corporations and super funds, they might be more interested, but I don't know. I haven't talked to anyone from that area for a while. But I know that they haven't been terribly interested in recent times when they've looked at doing it. Getting land's a problem, and there are so many different levels of government involved, local governments and state governments and federal governments, and there's so many vested interests, and they found it a bit too hard for them, particularly without any negative gearing or any other sort of benefits. So I think, to get these things, some of these things to happen, there will have to be some targeted tax benefits of some kind or another, but in some of these things, on both the supply and the demand side.
Thank you.
All right, thanks, Senator Bragg. Mr Fraser, we are a little bit over time, but I'm just going to exercise the Chair's prerogative and ask you just one or two brief questions, if I might. Look. Firstly, we heard from Bill Kelty yesterday. He described our current tax system as obscene and cruel, largely because of what he characterised as an unfairness towards young people. Yeah. Almost none of the benefit of the capital gains tax discount goes to young people. It's overwhelmingly biased, quite logically, towards older people. Would abolishing the capital gains tax discount, as you suggest, mean that we would go some way towards making our tax system fairer for younger people and giving younger people a fairer go in Australia?
Oh, yeah. No, I agree entirely with, as I often have with Bill, on his observations there, because, as I said, there are coming generations of young people that in lots of ways are missing out and are going to continue to miss out, including, importantly, in the housing sector, if the tax concessions remain there to encourage wealthy people to continue to get out there and invest in housing and force up their prices. It's just going to be a no-go for younger generations, and that's going to add to the disadvantage of those people and create more divisions between different generations and more inequity in the distribution of wealth and property in the country. Not something to be encouraged, I wouldn't have thought.
Thank you.
And it requires courage to do something about it.
My word it does. And finally, Australia's in a productivity slump at the moment. Do you think the capital gains tax discount has played a role in driving investment out of productive parts of the economy into unproductive parts of the economy? And I guess the corollary of the question would be, do you think removing the capital gains tax discount would assist in addressing the productivity challenges currently facing Australia?
No, I think they're separate matters. As I said, the people that the three businessmen that were put together to come up with certain changes and came up with the discount for housing investors, those three businessmen who are very active in the profitable businesses and wealthy businesses hoped that the same arrangement would apply to shares and that would make it easier for them to raise more capital. They talked, as I recall it, those people, business people, talked in terms of getting the same sort of concession for business, for profit reasons, not for productivity. And well, they didn't get it for profit reasons either, but I think productivity has to be driven by business entrepreneurs, business leaders and entrepreneurs, and it is driven by the profits that can come by making businesses more productive, improving productivity, lowering costs and improving productivity and products and so on. And but I don't see the parallel with the housing market and sector.
Okay.
Because, you don't need to, you don't buy shares to have a better living or that, what you want, how you want housing to do that. You want housing for that, but not shares, and shares are much more volatile anyhow. But the productivity thing is something that needs addressing too, and maybe, as in many areas, there is scope for very targeted tax measures to do things that will lead to the kinds of responses that you want from the players, whether they're business people and leaders of businesses, and they're the ones who have to take the lead on productivity improvements. But it's a different business, building houses, and I think it's different. And buying houses particularly, I've already said what I believe on that. I've sort of been still motivated really by feelings of fairness and living conditions in motivating some of these things. But I think they are important to creating a better, more cohesive society and getting closer to the Prime Minister's goal, which I'd like to see pursued, that is for all Australians to find Australia the best country to live in.
Well, thanks, Mr. Fraser. You've obviously made an extremely significant contribution to public policy in this country. So on behalf of the committee and on behalf of the Senate, thanks for continuing that by coming in to give your evidence today. We really appreciate it. Thank you.
Pleasure.
I now welcome and invite to the table representatives from the Department of the Treasury and the Australian Taxation Office.
You got some Treasury people, tax people coming, eh? Oh, that'll be interesting.
Hi folks, thanks very much for coming in today, and I welcome the representatives from the Department of the Treasury and the Australian Taxation Office. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. The Senate has resolved that an officer of a department of the Commonwealth or of a state shall not be asked to give opinions on matters of policy and shall be given reasonable opportunity to refer questions asked of the officer to superior officers or to a minister. This resolution does not preclude questions asking for explanations of policies or factual questions about when and how policies were adopted. Commonwealth officers appearing today are also reminded of the Senate order specifying the process by which a claim of public interest immunity should be raised. If you require it, a copy of the order is available from the Secretariat. For the Hansard record, could you please state your full names and the capacities in which you appear today? And I'm agnostic in terms of who goes first. So, Dr. Johnson, maybe we'll just run along the table and that would be the simplest way.
Shane Johnson, First Assistant Secretary, Tax Analysis Division.
Thank you.
Laura Berger-Thompson, First Assistant Secretary, Personal Tax, Indirect Tax and Charities Division.
Thank you.
Will Day, Deputy Commissioner of Taxation for Policy Analysis and Legislation.
Casey McFarlane, Assistant Commissioner in Private Wealth at the Australian Tax Office.
Sandra Roussel, Assistant Commissioner, Revenue Analysis Branch.
Well, thank you all for that. I invite any or all of you to make a short opening statement if you wish, at the conclusion of which we will have some questions for you. Does anyone wish to make an opening statement?
We'll go straight to questions.
Mr. Day?
No, thank you, Chair.
You're good?
Happy to go straight to questions.
Everyone's good? Refreshing. Thank you. That's terrific. Sorry, I'll get myself organised here. Question for Treasurer to start with. When Treasurer Costello introduced the capital gains tax discount, I'm sorry, here we go. Sorry, technology's just getting the better of me slightly here. When Treasurer Costello introduced capital gains tax discount changes, Treasury said it would raise $210 million over the estimates, and the view from both Treasury and Mr Ralph was the change would be budget neutral over time. What happened there? Because it's costing the budget an absolute mozza now. So do you have any reflections on the forecasts that were made at the time, and how is it blown out from raising money over the estimates to budget neutral over time to the situation we've got now where it's costing us over $20 billion a year?
I think one way to look at this is that the previous model allowed for indexation. The current model allows for a 50% discount. The estimates that you have referred to, the ones from the tax expenditure statement, they're not, so they're estimates of like a revenue forgone given a benchmark. That benchmark does not include indexation. That benchmark is essentially full taxation of the nominal gain. So to compare, so it's not actually suggesting that it has, like you indicated, that it's costed significantly more than what was originally anticipated, because it's actually measuring something different. And so to do that properly, you would need to measure an indexation arrangement versus the 50% discount to see how much different. Now, that would depend on the ratio of inflation to normal gains that have occurred over the period. And now, to the extent that if they were close to 50%, then the two would have balanced out. Now, the costing that was done during the review of business tax, it had a number of elements in it as well. It also had, so it was done in 2 stages. And should I go through, or is it in the report, but I can quickly step through if that helps?
If you can do it briefly, Dr.
Yeah, I'll do it really quickly.
Thank you.
So since he was done in 2 steps, and I wasn't there at the time, but the first stage was looking at a static costing, so no behavioural responses. It looked at removing indexation provisions and then removing the indexation as well, and then applying a 50% discount. That had a cost to revenue. They then assumed that there would be a behavioural response, that people would increase realisation. From memory, I think one thing they were looking at is that there was a view that people investing in shares would take more capital gains and less in dividends, and that behavioural response ended up raising some revenue. But to go to your original point, it's just we're looking at the tax expenditure statement is looking at a very different benchmark compared to the one that was in place before the CG discount was put in place.
All right, thank you. Based on Treasury analysis, in 2009, 39% of the benefit of the CGT discount went to the top 1% income earners in the country. In December, Treasury reported that 54% ends up in the pockets of the top 1%. The Parliamentary Budget Office is saying that's going even higher now. Can you just step the committee through why you think that is the case, why it is the case that over time the benefits of the capital gains tax discount are concentrating to even higher levels in the pockets of the top 1% income earners in the country?
Yeah, I'm happy to take that if you like.
Thank you.
So one, I'll just note that I think those numbers that you said, they seem right. So the one was done in AFS and the other one was done in our most recent tax expenditure statement. Look, there can be methodological changes and things that can impact things over time, but notwithstanding anything that there is there, that trend is certainly something that we're seeing. So and it is quite strong. Now that can reflect a number of things. In particular, so we're going from a system that exempted past gains, and so we're coming to a more mature system. So the more mature the system, the higher the gains, and given that higher income individuals were tended to have capital income and capital gains, that you expect that more of the benefit will go there. But a more predominant factor, I think, is that so CGT, as you know, operates on a realisation basis. So gains accumulate each year, and so it doesn't add to your taxable income until you decide to realise that asset. And at that time you realise the asset, then it adds to your capital gain. And so with the longer you hold on to the asset, the greater your gain will be, all else equal, if you're under rates of return. And then if you've got strong asset price growth, again, the larger your gain. So what is happening is that individuals are being moved up into that top 1%, largely because they are realising significant gains, because they've been holding on to either assets for a long period or because there's been significant asset price accumulation. So they'd be the two primary drivers.
All right.
If that helps.
So just so I understand you, Dr. Johnson, what you're saying is that part of the basic architecture of the capital gains tax discount, given an environment of high property price growth that we've all been living in for the last few decades, it's almost inevitable that that the benefits would concentrate more into the pockets of highest income earners over time.
So what I think it happens is that because you hold on to assets for so long and you don't, the taxation doesn't occur until you decide to sell the asset. That an individual who may otherwise be in a lower percentile can get brought up into the top percentile in the year they realise. Because, so for example, we could go through a little example. So maybe they're kind of sitting in somewhere else in the top decile, for example, for their normal income. All of a sudden they realise an asset and and because it's a significant gain, that will push them up temporarily into the top percentile. And so that's why the top percentile will actually grow over time.
But that was the case in 2009 as well as last year, right? I mean, so that effect that you describe, where someone realises an asset which bumps them up into a higher income bracket, like that's been the case right through, hasn't it?
Yes, but the difference is it depends on the time, how long it is you hold on to the asset for. And so in 2009, the most I could hold on to an asset under the 50% discount would have been 9 years, right? And it would have been less on average, right? Now I can have held on to the asset for effectively 25 years. And so, because it's compounding all the time and the return will be getting high. Now if I realise an asset now that I've been holding for a long period of time, just naturally because of normal growth in values, and I'm going to have a higher gain. So that's what's bringing people into that top percentile. That helps.
All right, thank you. Treasury's advised the committee that the average time an investment property is held is 9 years. If you were to take the middle of the RBA's target band, 2.5%, that would be inflation of 22.5% over 9 years. But the 50% discount is obviously a much more generous discount than if you'd linked it to inflation. And even over the past 9 years, which has been a relatively high period of inflation, total inflation's been 31%. I mean, isn't the 50% discount overcompensating? I mean, I won't ask you your opinion, but it's true, isn't it, that the discount is far more generous set at 50% than it would be if it was tagged to inflation?
So again, I think when we talk about generosity and elements like that, I think it's useful to take a step back and just think about taxation of savings and other things more generally. But just to go to your point, that to the extent that inflationary gains, the proportion of inflationary gains compared to the real return is higher than 50-50 split, then yes, that would be the case. But when we're thinking of taxing savings, I think there are a number of factors. It's very complex, and there are a number of factors that we want to consider when thinking about the underlying reasons for taxing savings, and how you might tax them relative to other forms of income. And those things are, there's a number of. So, for example, one of the key things that we think about when we're thinking about taxing capital gains is the potential for lock-in effect. So, capital gains is taxed on a realisation basis. It can create an incentive for people to hold on to the asset longer. In fact, it can even incentivise people to hold on to assets that are underperforming. And you can probably see, I'm not sure, the OECD have written papers on, these are the complex trade-offs that we're trying to deal with when designing corporate savings tax policy.
All right, thank you. Just on another topic now, and I'm going to offer these both to Treasury and to the ATO. Self-managed super funds that hold investment properties worth $2 million or less can sell them in the retirement phase of that fund and not pay a cent in tax. I mean, whether that's capital gains tax or otherwise, I mean, leaving aside what I would regard as the outrageous situation that represents, there doesn't appear to be data held by either of you to understand how often that occurs or how much revenue is foregone. Is either Treasury or the ATO able to give us any insights into that phenomenon? I mean, do we have the data sets to give us any sort of visual on revenue foregone by that, or how often that scenario happens?
I might ask Ms Rizal from our Revenue Analysis Branch from the ATO side of things.
Senator, we can tell you about the amount of capital gain realised by a superannuation fund versus an individual versus another entity, company, which is very little. What we can't tell you is about the amount of CGT discount, because that's not what's available on the CGT schedule form. But we know that real estate is a very small proportion of the amount that super funds are holding. So we can show over time, and I can provide that on notice, what superannuation funds are realising for real estate.
Are you able to break that down into SMSFs versus other forms of superannuation funds?
I'd have to come back to you on that. What I have is definitely super funds.
Yeah.
Whether I can break that down, I can take that on notice.
I appreciate it if you take notice. Is Treasury able to assist in any way there? I'm happy if you want to take that on notice.
Yeah, we can have a look.
Yeah,
not that we have with us.
Yeah. All right, thanks. Are either Treasury or the ATO able to apportion how much of the $22 billion in foregone revenue that the capital gains tax discount costs the budget is occurring inside trusts, and how much is being accrued by individuals? Are we able to break that down?
Chair, I can certainly draw your attention to our brief written submission, and then I might turn to Ms McFarlane and Ms Rizal in terms of any of the data we might hold. We find that whilst a discretionary trust, a non-fixed trust, can apply the CGT discount, in the majority of cases, trusts will generally not pay tax on capital gains they make. Instead, the trustee of the trust will resolve to distribute the gains to the trust beneficiaries, and then tax will be paid on the gains at the beneficiary level. And maybe Ms McFarlane can just take us through how that's sort of grossed up as part of that process.
Yes, so thank you, Mr Day. And as Mr Day has said, so the capital gains ordinarily get distributed by the trustee to the beneficiary. To avoid double dipping, so to speak, of the CGT discount that might already have been applied by the trustee in the hands of the beneficiary is required to gross up that amount distributed to them to effectively eliminate the benefit of the beneficiary, the discount applied at the trust level, and then calculate and determine the level of discount based on their own circumstances at that time in calculating their capital gains.
And similar to my last answer, Senator, I can give you, take on notice, the amount of, the number of entities and the amount of money in capital gains that are distributed from a trust to either a company, which is very little, largely individuals, and also to funds. But I can't break that down for you by the amount of capital gains discount.
I appreciate that, thanks. Is Treasury able to provide any insights there?
Probably not more than what the ATO provided. I mean, in terms of the percentage for different assets, I think our understanding is it's around for individuals, real estate's about 36%, trusts, and then the rest is from trusts and from shares. When we kind of we kind of distribute that across different asset types, it's about 45% goes to real estate for individuals and 36% for shares when we include the trust distribution as well. Some of that helps as well, but just...
All right, thank you. And I've just got a couple of questions specifically for the ATO. There was more than 1 million trust tax returns lodged last year. Is that trending upwards? Do you know? And do you have numbers on that available that you could take on notice? And particularly I'm interested maybe in just the last 5 years and whether that's heading upwards.
So we've, if I've got the question correct, what I do have is the amount of lodge, because the schedule is lodged by individuals, funds and companies, I can see the growth in that and the distributions within there from trusts, and we can see that the number of lodges with distributions from trust has increased, as has the value of that amount over time.
Can you quantify?
And it is lumpy, so it's up and down.
Thank you. Can you quantify that?
So for the latest public year for 22-23, we can see that the number of individuals who have lodged a capital gains tax schedule and received a distribution from a trust is 284,000-ish, with about 110,000 from funds and only 12,000 from companies.
All right, thanks. Could you, on notice, just step us back a few years just so we can get an idea of the trends? And is that the latest year that you've got data for?
We will soon be publishing the 23-24, so publicly we go up to 22-23 under tax stats.
If you could step us back a few years on notice, please, that'd be appreciated. The Board of Taxation has observed an increasing prevalence of bucket companies being established to skirt around immediate distribution requirements. Is that something that's of concern to the ATO?
I might ask Ms McFarlane from a compliance perspective.
So, yes, certainly when we refer to bucket companies, what we're referring to is a beneficiary that is a company that receives distributions from a trust, and within the current tax legal framework that is available to trustees to do that. And the corporate beneficiary then pays tax on that amount at the corporate rate. Now, in terms of the CGT discount, of course, companies largely in the main, except for some very limited exceptions, are not entitled to the CGT discount. So any capital gains distributed to corporate beneficiaries would be grossed up, and the corporate beneficiary would not be able to then claim the discount in relation to that gain.
All right, thank you. Academics who are going to appear later today have made the case that trusts should not be eligible to claim and pass through the CGT discount in the same way that companies can't in the main. Definitely not asking you for an opinion on that, but are there any policy or technical challenges to a change like that being implemented? Like, could we do that? Could you do that for us?
So, Senator, what I would say is that as the administrator, the ATO administers the law as enacted by Parliament. So we would, of course, work with Treasury and Government to implement that law and undertake our role as administrator to provide guidance to taxpayers to help them with managing their obligations under those laws.
Are there any technical challenges that jump into mind now in terms of implementing such a change? I'm happy if you want to take that on notice, by the way. I'm not trying to catch anyone out here.
I think
I'm genuinely interested.
A little bit hard to answer without knowing the detail of that. Yeah.
All right, no worries. All right, we are a little bit short of time. I do have some other questions, so I'm going to, in the interest of equity, throw to you, Senator Dowling.
Thank you, Chair, for your equity. Just going back again to the historic situation of the capital gains tax, moving away from that indexation arrangement through to the 50% discount, maybe for the Treasury, can you just talk through how that was done in policy and legal change? Because I understand there was a decision where for a period of time you could actually access either or, and what was the thinking around that, and then when that expired, and maybe for the ATO, how those changes were actually implemented, because it was often claimed, one of the stated rationale for the policy change was it was easier to administer a simple discount of 50% rather than the indexation method. So I'm interested in how that was, if that is actually the case internally from an administrative perspective.
So I'm happy to start. So it's actually still the case that for assets that were purchased between 1985 and 1999, you have a choice as to which tax regime you use. So you can either use the indexation, but the indexation will be capped at the 1999 level. So it's a kind of paused, if you like, the indexation, and then it's kind of taxed at almost as if it was in the old regime, except that averaging does not apply. So there was an averaging regime that was in place prior to 1999. So you can still make that choice, but given the nature of that choice, I would imagine that for the vast majority of assets, you would probably be better off to choose the 50% discount method.
Okay, thank you.
Obviously, for assets purchased following 1999, then all of those assets are in the new regime.
Yes.
And from a tax office perspective, Deputy Chair, obviously, as Ms Berger-Thompson has explained, there is a dual regime depending on when the asset was purchased. Obviously, we publish a wide range of guidance in terms of CGT and the discount itself, from rulings through to website material and other guidance. I would have thought that administration is relatively straightforward in relation to that discount, but obviously we need to administer depending on the age of the asset and discretion of the taxpayer.
For either method, whether it's indexation or whether it's the 50%.
From an administration perspective, I think it's straightforward from both perspectives, yes.
Right.
Yeah, as Mr Day said, we would provide guidance and a range of calculators and things to taxpayers to assist with that. I suppose with indexation it does depend on when you acquired the asset and the particular date, so that may require taxpayers to maintain additional records.
Maybe you could just speak to and also the sophistication of the tax office operations now, since that, 1999 to today. I mean, you've got a lot more technology involved, and just even through COVID, for example, we saw how quickly the HO was able to administer payments versus other jurisdictions. So I guess your capability in terms of dealing with tax changes is a lot more sophisticated than in the past.
Oh, absolutely, I'd accept that, Deputy Chair.
And do you think from an education perspective, is it well understood the rules around discounts for capital gains for individuals, for trusts more broadly? Do you think it's something or is it something you put more effort into educating around that?
I think it obviously our approaches will differ from market to market, individuals versus small businesses, for example. Obviously, we rely heavily on intermediaries in the tax system as well, registered tax agents and so on. And as I say, we have a range of materials, including through actual lodgement, electronic lodgement and so on. But I think it's not an area that we think is of great misunderstanding in the community.
So, as part of our routine compliance activities, we do look at elements of CGT discount. I would say that the vast majority of those issues that we do see in a small number of cases are what we'd call inadvertent type errors, so people miscalculating the discount, perhaps not applying the 12-month holding rule correctly, or in a small number of cases, companies not understanding that they're not entitled. But certainly we've got a big focus on education and tools available to taxpayers to assist.
Yeah, because your compliance and enforcement capability obviously also, for example, if you buy shares or bank interest or cryptocurrency, normally now you put your tax file number in, so I assume it's a lot easier for you to operate compliance and enforcement because it's tracked.
There's certainly a range of verified third-party data that we would that we have access to, including from property registration, etc. So that's absolutely right, Senator.
Thank you. Just back to the Treasury, there's a lot of discussion around the revenue impacts of the capital gains tax discount, but I think maybe if you could just explain how the tax expenditure statement actually works and what it is and what it isn't, because people often go to the number in the tax expenditure statement and say it's costing the budget X amount, but that doesn't mean if you remove that tax expenditure, you would get that back in the budget necessarily, does it?
No, that's right. So the tax expenditure statement, what we try and do is it's designed to look at the existing treatment relative to a particular benchmark. Now, the most common benchmark, and that is it's called Hague-Simons, but essentially a comprehensive income. So you tax, on the personal side, you're taxing all income, and you're taxing it at a particular rate or at the progressive rate scale. That's essentially the benchmark that we use. We look at taxing all income against the progressive rate scale. And that kind of benchmark is pretty common globally when thinking about it. It is just one of many benchmarks though, that you could use. You could use a consumption benchmark. You could use taxing some kind of rent benchmark. There are a range of different ones, but this one is relatively common. But it is important to kind of think of those things when thinking about what it's trying to do. And so essentially what it does then is it says this is the benefit relative of the existing system, all of the cost, depending on the way the provision goes, relative to that particular benchmark. Now, relative to a costing, so if we were doing a costing, we would try and factor in a behavioural change. Because if we went, so for example, if we went, and this is purely hypothetical, but if we went from the existing treatment to the benchmark treatment in the test, that would be a pretty significant change, and there'd be potentially a behavioural change, and then we would try and factor in the behavioural change, and that would mean there'd be a difference in the revenue, in the actual, the cost of the measure. So they're not always useful in terms of looking at what the benefit might, well, the dollar benefit might be from removing one of these, because there will be other interactions and other effects that are going on. So they typically you would tend to overstate.
Yeah. So you would caution people not to look at those numbers and say that's money that's foregone.
That's
in
right.
that sense. It's not the way to look at
it's not
tax
money foregone. No. So for example, like if we went, to pick a different one. So. An example, you might provide a particular concession in the tax system. We would measure that concession based on the benchmark. If you remove that, people might just go and use a different concession that might be available. So you're not going to get the full benefit of that. So yes, their estimates, they're not the revenue gain that you would get. That they're more an estimate of the revenue foregone relative to a benchmark.
Yes, because with any, not capital gains specifically, but with any tax change, there's a whole bunch of behavioural responses, and presumably people seek to pay as efficient, minimal tax as legally possible.
That's right, yep.
Yeah, okay. Thank you, Chair.
Thanks, Senator Dowling. Senator Bragg.
Well, look, thanks very much for being there. I guess, so from the Treasury, which division are you from?
So I'm Shane Johnson. I'm from the Tax Analysis Division.
And Laura Burger-Thompson. I'm here from the Personal and Indirect Tax and Charities Division.
Okay, so you're in Revenue Group?
Yes, we are, yep. Both of us are from Revenue Group, yes.
Okay, because it's hearing about the CGT discount.
Yes, that's right.
That's why you're here.
Yep,
because you're from the Revenue Group, okay.
Yep.
But I mean, as you know, I mean, you all very good and very experienced officials that you spend lots of time at estimates, so you know that we have to consider a lot of different factors when we make policy. So, I mean, if you play around with this discount, it will have an impact on housing supply, won't it?
I think, I guess let's start off with, so the impacts of any policy would depend on the policy itself. So what you're deciding to change. So first of all, it depends what you're looking to do. So if you want to go through, some kind of example policy but it will depend on the nature of the change and what's going on. In terms of the discount itself, there's been a number of researchers that have looked into this. There's quite a bit of research that's available, and these studies typically suggest that changes to the CGT discount in the range of things that I think a lot of the submissions have indicated would typically have a relatively small impact on the housing market.
Okay. So if it was cut in half to 25% or it was abolished, you think it would have a minor effect on housing supply, do you?
So, housing supply, the underlying demand for housing, the underlying demand of housing is not really changing here. So, and what I mean by that is that there's a number of elements, right? But we don't want housing. I think it was a good point that was made before. We don't want housing just for housing sake. We want housing as a place for people to live. So, and that desire to have a place for people to live, that's not changing. We're not, so the changing the CGT is not going to change the. I think the Secretary Kennedy may have, it actually may have been a question at Senator from yourself actually, but he talked about that the number of people per household, isn't changing, and you wouldn't expect it to change from a change in CGT. So underlying demand is not changing. What may change is the ownership mix of one of these changes. So you may start looking, so if you did one of these changes, the demand's still there, so which would support the supply. What may change is the ownership mix. And I think that's, when you look at those studies that have been done, that seems to be the effect. Like you have very, very small changes in the housing market, but potentially changes in the ownership mix.
Can I also add, on supply, there's a range of really significant factors that affect supply, and tax is only one of those. There's a lot of analysis on this, including from the State of the Housing Market, from the Housing Supply and Affordability Council, which just talks about the kind of the full range of issues, in relation to the supply of housing.
Okay, so I guess let's go to what the former Secretary Kennedy said to Senate estimates. I think it was actually a question from Senator McKim, the chair, today, back in November 2024. So, I mean, he just said that, it wouldn't make much difference. Really, the main game is supply. And so that's what he said, that the Treasury was focused on supply. So, I mean, but
so that's right.
I guess my question is, I guess my question is, I mean, if we played around with these things, right? Let's say we did what some people have suggested, which is to reduce it or to abolish it altogether. Would that help supply?
So I think, like Ms. Berger-Thompson said, if we want to try and help supply, supply is defended by a number of factors, and I think things around like the zoning and planning and other things that are land release, they're more pertinent to improving supply.
So this wouldn't help supply.
I think most of the modelling suggests that it's probably more around the ownership mix, so it probably provides an opportunity for essentially first homeowners to have a house, as opposed to increasing supply.
Okay, so building is the most important. Building new homes is the most important thing. Is that right?
In terms of a supply response, yes.
Okay, so it wouldn't matter whether you're grandfather or not grandfather, or whether you make it 50% for new builds, or it wouldn't matter. It's either way. The Treasury's view is it's a small beer when it comes to the supply challenge.
I think so. I don't want to put a Treasury view. I think, like I said, when we look at the research that's been done on this, looking at changes in the capital gains discount and other things and other related policies that are in line with many of the recommendations or suggestions that have come through the submissions to the inquiry, the impact on the housing market seems to be relatively small, but there is where you're likely to see more of an effect is around the ownership mix. These things are very complex.
I understand it's complex, but Kennedy was quite clear that this wouldn't help supply, therefore the government wasn't focused on it. The government was focused on supply. So that's still the view, right? That this wouldn't, if you cut the discount, it wouldn't help supply, so it's not on the agenda.
I mean, that's a matter for government, or what's on the agenda. That's not a matter for Treasury.
Well, the question is, would cutting the discount help build more houses? That's the question. You're the economist.
Like I said...
Well, I was just going to say, I think Mr Johnson has answered this question to say that the empirical literature says that the impacts of these things on the housing market are quite small.
Okay. So effectively, you're saying that the price impact is small, the supply figure is small if you play around with negative gearing or CGT.
So, like I said, like the research that we've seen seems to indicate that that's right. Yes.
Yeah. Okay. Fine. Well, I mean, this is the same research which is cited by, Peter Chulip, who was a former RBA official. He says it's 1 to 3%. So it sounds like you don't massively disagree with that.
No, I mean, Peter Chulip, very good. So.
It's not our place to make an opinion.
No, I'm not trying.
On. We're just telling you what the research says.
No, I understand that. So okay, fine. So I'll take from that what Stephen Kennedy, the Secretary of the Treasury, the then Secretary, said in the end of 24, that the focus is supply, and changing these tax settings wouldn't help with supply, is still the view that you are. It's still the evidence that you're presenting today.
I don't think that's right. I think.
Okay, why don't you tell me what you're saying then?
So the evidence, we've responded to your questions on what we think the impact would be on supply, or at least what the literature indicates that the impact would be on supply. And, we're not making any statements about what the government's agenda is in this area.
Yeah, which is the same thing that Kennedy said.
I don't have what Dr. Kennedy said in front of me, sorry. Senator Bragg, but...
Okay, well, let me ask you about, I think the Chair mentioned at the start of the questions to the Treasury and the ATO that I think there were some projections done about revenue from the Ralph review. Is that right?
Yes, yep.
Yeah, so, I mean, that would have been, I imagine, taking into account second round effects, was it?
It was, yeah, so I think so the way the costing was done, I'll just go through it quickly. The first part of the costing, we looked at the direct effect without any behavioural change. So we looked at the impact of removing averaging and removing the indexation provisions and then introducing a 50% discount. They then looked at a range of research to see what the potential behavioural responses might be. I think from memory, and I wasn't involved in these costings, but my memory is that the main behavioural responses were increased realisation, and it was potentially related to shares, where they thought that people would take more capital gains and less in dividends. Okay. And so that offset some of the cost.
Okay, fine. So that took into account a second round impact behavioural response. Now, when you look at the tax expenditure statement and you look at the figures in there about foregone revenue, that doesn't take into account any other. That's just an initial, review, isn't it?
That's right, and that's what that's exactly right, Senator Bragg. I mentioned that before. That's why it's not. We don't really want to compare that as being the revenue. The revenue that has been lost from the change, because the previous arrangements had indexation and averaging in them. That's not in this benchmark. And I think I mentioned to Senator Dowling before that, the tax expenditure statement doesn't include behavioural responses. It's purely assessed on a particular benchmark. In this case, the benchmark is a Haig-Simons benchmark. Sure. Yeah. Sorry.
Sure. And so, but the reason that the tax concessions accrue to wealthier people is because these people pay more income tax.
That is so. There's a couple of reasons. They pay more income tax, more likely to hold a capital, more likely to have savings because they are higher income, and more likely well, they're probably the two main, that they are paying more tax and that they are more likely to have savings.
Okay. Final question. I just want to get this right, just for the purposes of this hearing. So, is there any formulation of a reduction in tax concessions here in relation to the CGT discount that could be deployed that would boost housing supply?
I think you're asking for an opinion, Senator Bragg.
Okay, well, let me ask you again then. So I'm trying to be careful so we do it all within the rules. I'm just trying to get you on the record on this in the appropriate way. So does the research show any scenario where an increase in tax or a reduction in the CGT discount could provide more houses?
So there are many ways you can look at changing the tax system with exclusions, inclusions. I'm not aware of that. And to be honest, if we start going through there, I would really start providing opinions on policy. So. Okay,
so let me just, I'm just trying to get it clear. So will this, if it was adopted by the Parliament, the idea that you reduce the discount or you cut it, will it drive supply?
I feel like I think, again, I'm really sorry, but I'm going to have to go back to my original statement. We have looked at the literature, and from what we can see, that the changes in the capital gains tax arrangements would have a minimal impact a very small impact on the. Their estimates suggest that the impacts on the housing market would be pretty small.
They wouldn't build more houses.
The research doesn't suggest that.
Well,
Thank you.
I think asked and answered, Senator Bragg.
Thank you.
All right, thank you, Senator Pocock.
Thank you, Chair. Thank you very much for your time this afternoon. I was wondering if you have the latest figures for the value of the CGT concession on investment properties.
So do you mean I just want to clarify the question. So you're after
the most recent
tax expenditure kind of calculation just for investment properties?
Yeah, sort of, I guess, revenue foregone.
Let me have a look. So what we do know is that around, I don't have the dollar figure, I don't think, but most of the benefit goes to housing. The reason for that is because housing assets are typically held on for longer, so the assets going to accumulate more, and so when they realise, so shares are often traded much more frequently. So you would expect more. Now, what I'll do is I'll take it on notice, but my recollection is it's somewhere around, and it's in the 90s. I'm pretty sure about 95% of the benefit will go to housing.
Go to housing.
Yeah.
And would you able on notice to give us a sort of a dollar figure on that?
If we can do it, we'll have a look. Yeah, these things are very hard to do, so if we're able to do it, I'm happy to take it on notice, and we'll have a look.
Okay.
Yeah.
One of the other things which has come up when it comes to CGT and housing is that the benefits sort of disproportionately accrue to wealthier Australians. And so I'm wondering, in that analysis, if you break it down to the number of investment properties held by individuals, and whether you can give us figures for people with one investment property, which I understand is about 70% of property investors only have one, but then the rest of people who have two or more, is it possible to segregate the data that you have? I understand you'll probably have to take it on notice.
So we may have to take it on notice again. I'm sorry about that. It may be possible that there are some. I have a feeling, and the tax office might be able to help, but I thought there might be some information in the tax expenditure statement on that. But we'll have a look and see if we can get something for you.
On this side.
Most of the data on capital gains is through the capital gains tax schedule, which doesn't break it up into the number of properties, but we do have some data from an individual's tax return, which gives a smaller slice of capital gains, which does break it into the number of properties. Okay. But we'll see what we can take
on notice. If you're happy to provide that would be great. Thank you. I'm wondering if you've modelled restricting the CGT concession on investment properties to only new supply.
So, Senator, as you're aware, I'm sure that the Treasurer has spoken about what he's doing in the lead up to budget. So, because of that, we're not at liberty to discuss kind of what we have and have not done in terms of specific policies.
Why is that?
Partly because we don't want to, I guess, prejudice the discussion. I think that was outlined by the Chair at the start.
Sure. Yeah, I'm allowed to ask questions, thanks.
Well, not deliberation of government policy.
What would be the pros and cons of entirely, and this has come up a number of times so far, entirely separating the taxation of capital gains on rental property assets from the income tax system, as happens in a bunch of countries?
So I won't answer that question directly, but I might provide some kind of context to help, and it kind of goes to what Mr Johnson had been talking about before. When we think about the taxation of savings, there are some arguments, including in the Henry Review or the Australia's Future Tax System Review, about it may be optimal to tax savings, which includes capital gains, at a lower headline rate than other income. There is also, though, if you think about the taxation of capital gains, some reasons why you might want to have a differential system for capital gains in and of itself. And really those arguments are because the capital gains is taxed on realisation. So because they're taxed on realisation, they're lumpy. So when Mr Johnson was talking about throwing people around the distribution because they realise these gains, what that means is actually that they pay often a higher rate of tax on those gains when they realise them than they would have had they kind of, earned that income kind of over a number of years, and that was treated on an accrual basis. Also, what Mr Johnson was talking about before about asset lock-in is something that, the academic literature really kind of focuses on as well here. And that's really that, there isn't, once you kind of have an asset and you've kind of earned some capital gains, there's an incentive for you to effectively to defer realising those gains so you don't have to, pay the tax. So that's another reason. And I guess the third is a little bit related to that, which is around because of the lumpiness of these gains, then there is an incentive for people to defer realisation until their other income is low. So there's a bit of a tax planning argument as well. So when thinking about kind of capital gains, the appropriateness of different capital gains tax regimes, there's actually a few different kind of considerations to think about, both in terms of kind of equity, but also the efficiency of the system, and they're kind of real trade-offs.
Have you looked at? Thank you. That's useful. Have you looked at the impact of the capital gains tax discount on intergenerational inequity, where we're seeing people who have wealth able to invest more in unproductive assets, essentially, and make pretty good money, while a whole bunch of other people are kind of locked out of owning that asset, which is actually just a home to live in?
Mr Johnson might have some numbers by age.
So not so much in terms of intergenerational equity. We have got breakdowns by age, so like the share of net capital gains by age. I'm happy to share those if that would be of interest.
Maybe on notice would be useful. Yeah. But I guess one of the things you probably don't have this, but I'd be interested if you do, is looking at, yes, there are a whole bunch of young people who are using this, but I'd be interested how many of them have wealthier parents, and we're essentially just seeing that wealth flow down.
So analysis looking at that's very difficult because you need to be able to have some linked relationship between the individual and, say, their parents, which that's much more difficult to do. So that's not something that I'm not sure if other researchers may have been able to do that. It's quite possible that others have, but we haven't looked at that. One thing I would note, when we're thinking about intergenerational equity, I think it's really important to think about people over their entire life cycle as well. So it's not just looking at the young versus someone who's older. It's actually looking at the tax treatment and the social security treatment, but it's important to look at both over their entire lifetime and how that will change. So I think when thinking about intergenerational equity, it's really important to think about people over their lifetime as opposed to discrete points in their life, because those will change. And I think the Productivity Commission do a little bit of work in that space. They had, I think it was in 2024, they had their inequality update, and it kind of went through some interesting analysis looking at wealth inequality and other things. And I think they talked about some of those issues. But,
thank you. Yeah. And does the ATO or Treasury have any way to track or keep a tabs on how many people are using the bank of mum and dad for deposits and getting into the housing market?
I'm not aware of. So
I guess essentially getting gifted.
I know it's like how much are you either being a guarantor of a loan or actually providing money for a deposit. I'm not aware. I largely deal on the tax side of things.
Yeah, sure.
I could take it on notice.
Maybe
we
just
could
on
see if there's
notice
anything
if
on
there's
that
a
for
way
the
to
housing.
actually have a look at that and the trend over time.
From an ATO perspective, no, we would not have access to that form of data. Obviously, it wouldn't be relevant to an income tax return, etc. It may come up, so we wouldn't collect it systemically. It may come up from time to time in a compliance or engagement activity. But generally, we wouldn't have that sort of information.
So, Senator, we do contribute to the ABS's PLIDA, personal longitudinal individual. Forget the rest. Database, which again, as Mr. Day said, we won't give them information like wealth, but they can match the individuals to wealth. And there's such a long period of time now that you can start seeing connections. But I doubt we'd have a gift of X, 100,000 for that kind of connection. But you can see the wealth of the parents to the children.
And so, Mr. Day, under our sort of current system, you're saying that if someone goes to buy a house and their parents give them $100,000 for the deposit, that's not taxable income?
Difficult to give tax advice on the fly, but generally I think that would be right.
Yeah, that would just be for the house. So okay, thank you.
Generally, a gift is not taxable. That's right.
Thank you, Chair.
Thanks, Senator Pocock, and thanks to officials of Treasury and the ATO for taking the time to come in today. The committee really appreciates it. If you have taken questions on notice, it would be appreciated if you could forward responses to the Secretariat by close of business on Thursday, the 5th of March. Thanks again for coming in.
Thank you.
I now welcome representatives from Master Builders Australia, the Housing Industry Association, and Associate Professor Mark Humphrey-Jenner. Just while we're engaging in the swap over, apologies to the next batch of witnesses for the fact that the committee is running slightly late, and I'll just indicate to my colleagues that I suspect it's likely we'll go a little bit longer than the scheduled commencement of the lunch break, but we'll do our best to keep to time as much as we can. I understand, folks, that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please state your full names and the capacities in which you appear today? And we might start at this end of the table and run along, and we'll come to Mr Humphrey-Jenner at the end.
Tim Reardon, Chief Economist, Housing Industry Association.
Thank you, Mr Reardon.
Jocelyn Martin, Managing Director, Housing Industry Association.
Thanks, Mrs Martin.
Danita Warren, CEO, Master Builders Australia.
Thanks, Mrs Warren.
Shane Garrett, Chief Economist, Master Builders Australia.
Thanks, Mr Garrett. And Mr Humphrey-Jenner.
Yeah, Mark Humphrey-Jenner, Associate Professor of Finance at UNSW, and I run Oxford Capital, a fund manager.
Thank you all very much. Does anyone wish to give a short opening statement to the committee? Okay, we'll start with you, Mrs Martin.
Okay, thank you. Chair, Senators, I want to thank you for the opportunity to appear today. I want to begin with a simple proposition. Australia does not have a tax concession problem. Australia has a housing supply problem. And unless this committee is prepared to confront that reality directly, this inquiry risks becoming a distraction from the structural causes of the crisis. The submission provided by the Housing Industry Association sets out in detail the modelling evidence, removing or restricting negative gearing or the capital gains tax discount reduces dwelling starts, reduces GDP, reduces construction employment and increases rents over time. That is not conjecture, it's consistent with economic theory, historical experience and economy-wide modelling. But today I do not want to summarise our submission. Instead, I want to ask a more fundamental question. Why are we here debating the taxation of investors when governments are extracting close to $200,000 in taxes and statutory charges from every new home built in this country? The GST alone adds roughly $100,000 to the cost of a new house and land package, and it applies to new homes, and it does not apply to established homes. If the concern is truly housing affordability, why is the tax system penalising housing? Why is new housing treated as a revenue base? If this committee is serious about intergenerational equity, then it should begin by examining the taxes embedded in the cost of construction, not by examining long-standing principles of tax neutrality. Negative gearing is not a concession. It reflects the basic definition of net income, allowing legitimate costs to be deducted. The Henry Tax Review made that clear and recommended against removing until the supply problem is fixed. The capital gains tax discount replaced indexation, and without some mechanism to account for inflation, you tax nominal gains, not real gains. There may be legitimate debate about the rate, but there is not legitimate debate about the principle. More importantly, the focus on investor taxation assumes that investors are the cause of the shortage, and they are not. Investors build approximately 1/3 to 40% of new homes in Australia and in recent years. Remove them and you remove supply. If the objective is to encourage investors to build new housing, there are constructive levers available, for example, depreciation schedules. Currently, investors can depreciate new construction over decades. If the policy goal is to increase new supply, then accelerate depreciation, compress it for 40 years to 5. That does not reduce lifetime revenue to the government. It brings revenue forward because more homes are built sooner. Every additional home built generates tax revenue across GST, payroll tax, stamp duties, income tax from workers, company tax from suppliers. If you want more revenue from housing, build more homes. More homes means more revenue. More homes means slower home price growth. More homes means fewer investors in the market as they leave in an orderly fashion for other investment opportunities. Fewer homes mean fewer jobs, fewer taxpayers, higher rents, and more investors in the housing market. If the government were to build 1.2 million homes, they would raise an additional $50 billion in tax revenues, enabling them to invest in infrastructure to build even more homes, solving the affordability problem, and investors could leave the housing market. There is a tendency in the public debate to assume that raising taxes on investors will rebalance the system in favour of younger Australians. In reality, restricting supply locks in capital gains for existing owners and constrains entry for those who come later. It would embed the inequity that exists now for decades to come. If we build 800,000 net additional dwellings over 5 years as we forecast, but household formation exceeds 1 million, prices rise regardless of the CGT rate. Investors will make even more profits. That's not arithmetic. That is arithmetic, not ideology. Demand is driven by population growth and household formation. Supply is constrained by land release, infrastructure charging, regulatory delays and tax layering. And the result is scarcity. And scarcity always capitalises into higher prices. So I respectfully suggest that this committee asks itself a harder question. If the objective is affordability, why is the inquiry framed around penalising investment rather than expanding supply? Why are we debating how to tax housing more heavily when government's already deeply embedded in the cost base of every new home? If you want lower prices, you need more homes. If you want lower rents, you need more rental stock. If you want stronger public finances, you need more construction activity. The path to all three runs through supply, not through higher taxes on the private capital that funds it. Thank you.
Thank you. Mrs. Warren.
Thank you, Chair, and I commend and concur with the comments from the HIA. Every Australian deserves to live in a home they can afford, whether that is through renting or owner-occupier. Moreover, we should all share the goal of making the great Australian dream of owning your own home a reality for more Australians. But these goals are unattainable for many because we have a housing crisis in this country. Why? Because there are simply not enough homes. We have not been building enough homes for over 30 years. This is why home ownership is harder than ever before, and it is why rents are high. There is simply not enough to go around. So we need to increase supply to improve affordability for owner-occupiers and renters alike. We need to grow the number of homes available rather than just simply changing the relativities between owner-occupiers and renters from existing supply. This supply problem has been recognised by the Albanese government since its election in 2022 and pursued through the Housing Accord established by the federal government in 2023. We are a signatory to that accord and commend the government for this critically important initiative. The importance of fixing supply and how best to fix it was clearly articulated by the Prime Minister on 5 of May of last year, a few days after the 2025 election, as he outlined his priorities for a second term. And I quote, "And I say this message to the Senate and to the members of the House of Representatives, that you know we have a clear mandate to build more housing. The key is supply, the key is supply. You know, get out of the way and let the private sector build it. This is going to be one of my priorities." Master Builders wholeheartedly concurs with the Prime Minister when he rightly points out that the focus should be on supply and let the private sector build it. Why is it so important that the private sector is the key to supply? Because we know from experience that the private sector can deliver more efficient construction than private sector demand. 97% of new home starts are in the private sector. 87% of the rental market is provided by private landlords. So we've set an ambitious target to bridge the supply gap, to build 1.2 million homes over a 5-year period, but we are already behind. While difficult to achieve, we believe it is achievable, but only if the following things happen. There need to be ongoing new policies and new funding to turbocharge housing supply. Supply levers, not demand levers. That policies and funding decisions are made to remove the barriers to enabling housing supply, particularly when it comes to increasing the number of people working in the industry to meet that target. And that there cannot be any policies that reduce supply. Our housing market is complex and multifaceted, so there is an absolute risk that pulling one policy lever will adversely impact our capacity to deliver, which is why Master Builders does not support any reduction or abolition to the capital gains tax discount, because a reduction in a tax incentive for the private market to invest in housing will lead to a reduction in supply. A reduction in the CGT discount may reduce property investment in the short term to free up properties for owner-occupiers, but in the long term we know it will reduce supply, reduce the availability of the private rental accommodation, and will drive up rental prices for those remaining in the rental market. And contrary to assertions by some to this committee, a decrease in supply from the reduction in the capital gains tax discount can be offset by a more demand-driven public sector funding into housing is wrong. Why? Because it will create market distortions and inefficiencies that lead to greater stress in an already stressed system that is challenged by significant supply chain constraints. So in conclusion, we have a housing supply challenge that we are all working towards to resolve, governments and industry. Any policy change must lead to more supply that is particularly driven by the private sector that is best placed to do so. From our view, the proposals put to this committee to date as to a reduction or abolition of the CGT discount only lead to a reduction in supply and should therefore not be considered. Thank you.
All right, thanks very much for your opening statements. You've both focused on the supply side of the equation and without disputing the importance of supply. I mean, basic economics says that prices are set by an interrelationship between supply and demand, doesn't it? No one's going to dispute that, right?
Yep, absolutely.
Right. So is it your proposition that government just should forget about the demand side entirely?
No.
Because that's what it sounds like from your opening statements, to be honest.
No, the demand side is very important, and housing demand comes about as a product of population divided by the average number of people per home. We have 27 million people and 10 million homes. That math doesn't add up. And how you stack those 10 million homes, whether they're all owner-occupiers or all investors or all owned by government, that's not enough homes for that population.
Is it your proposition that the capital gains tax discount plays no role at all on the demand side of the equation?
Capital gains tax does not change the population of Australia.
No, that wasn't my question, Mr. Reardon. My question is it your proposition that the capital gains tax discount plays no role at all on the demand side of the housing equation? Is that your proposition or not?
Because demand is only a product of population and average number of people per home, how does it impact on demand for housing? You're suggesting that...
This is where I get to ask you your questions, not the other way around, Mr. Reardon. My question again for the third time is it your proposition that the capital gains tax discount plays no role at all on the demand side of the housing equation?
I might have a bit of a partial answer to that. What we know is that a lot of the reason why we're falling short and the 1.2 million homes target is because we are not building enough in the multi-unit sector. And one of the ingredients to kickstart the multi-unit sector is demand and to assess feasibility. And feasibility is done at the very, very early stages before they even dig a hole. And so all those things go into the mix at that point there. And, including future capital gains and including what an investor is likely to pay or an owner-occupier is likely to pay for that apartment. And at the moment, feasibility doesn't stack up. So anything that might influence that level of demand for that multi-unit sector is going to actually be a factor.
I don't think anyone on this committee is going to dispute that we need to build more housing in Australia. Mm-hmm. That's the view of my party, very confident it's the view of the Labor Party, believe it's the view of the Liberal Party as well. So I think we can all just agree that we need more housing in Australia. I think, Mrs Martin, you did accept that the capital gains tax discount plays a role in increasing demand, did you?
The capital gains tax discount plays a role in ascertaining demand. So when you're looking at a feasibility for a large apartment block in Sydney, you haven't even built it yet. So you are actually kind of looking at the numbers there and seeing if they stack up. It's part of the equation.
Is it the view of the HIA that the capital gains tax discount adds to demand or not?
Do you want to answer?
Yeah, capital gains tax does not add to demand because it doesn't change the population of the country. The number of people looking to live in a house does not impact demand.
Wow. Okay. Does the master builders have a view on whether the capital gains tax discount adds to demand?
I think, Chair, it's about actually the impact on price, not the impact on demand.
Well, we've all just agreed, I think, that prices are set under basic economic theory. Prices are set by an interrelationship between supply and demand, right? I think we all agree with that proposition when I put it to you a moment ago. Mm-hmm. So again, I'm simply trying to sort of, I guess, try and find a foundation for a conversation here. The HIA said that they don't believe that the capital gains tax discount increases demand for the housing stock. Does the master builders agree or disagree with that?
I'll put it this way. I think if the capital gains tax discount didn't exist, the pool of viable new home building projects would be smaller than it is now. So in other words, when homes get built by private developers, they do it. They look at the costs, they look at the prospective selling price, they look at how long it's going to build, and they put them all together and they decide to proceed on that basis. I think the number of projects that could proceed if the capital gains discount didn't exist would be smaller. I think there'd be a smaller set of homes that would get the green light.
New South Wales Treasury says that the capital gains tax discount contributes materially to demand. They got that wrong, did they?
Yes, they did, and we've responded to that publicly. Oh. So capital gains tax and investors do add to demand at weekend auctions. There's no doubt about that. And increasing the taxes on investors may see fewer people bidding at an auction at the weekend. But the consequences of that are, with sufficient time, that supply is constrained as a consequence of the increase in tax, and the underlying shortfall of supply and demand, supply being the number of homes, demand being the population, isn't affected by capital gains tax. Investors don't live in the houses they make available to rent.
Over the last 5 years, we've had hundreds of billions of dollars of credit going to property investors. Only 8% of that has gone into new homes. 92% has gone into inflating existing housing. I reckon that's great for the banks. It's great for the property sector, but wouldn't you agree it's been an absolute disaster for young people who are trying to get into the housing market and for renters who have sat there and watched their rents go through the roof, particularly in the last few years? I mean, haven't we got our policy settings very
We have our
wrong
policy
here?
settings disastrously wrong, and constraints on the supply of housing are what have led to the problem that you've just outlined. We're not here to defend investors. In fact, if you increase supply, investors will exit the market in an orderly fashion. The number you've just quoted there of investors buying, I think you said 94%, but 92%. I think the correct figure is 85% of investment for investors has gone into established. Now, we have that data going back for 6 years, and context is really important. For that period of time, investor investment in established housing is identical to investment from owner-occupiers in established housing. And the pivot points occur at the same time too. So it turns out investors and owner-occupiers make the same decision. They look at the cost of a new home and decide if the cost of an established home is more or less, and they make the decision to invest in the two of them depending on which one provides the better value. So if you, as politicians, lower the cost of new housing, more investors and more owner-occupiers will make the decision to build new. The second point to make about that piece of data is that in proportion the new housing market is 200,000 homes per year on average, the established market is 10 million homes. You are always going to have the proportionality there. The established market is 50 times larger. That's why owner-occupiers and investors are buying more established homes than new homes.
Thanks, Senator Dowling.
Could I just add something?
Oh, yes, of course.
Sorry,
you can,
I don't
Mr.
mean
Garrett.
to cut across.
Yep.
Last year, 2025, there were 38,200 loans made to investors which were used to either construct a new dwelling or to buy one that had been built already. And that's about 42% of all of the loans for those purposes. So the actual amount of new homes that are driven by investor demand is quite substantial.
All right.
Thank you.
Thanks very much. And I'll just indicate to Mr. Humphrey-Jenner, I do have a couple of questions for you, but I'm just going to throw to Senator Dowling.
Look, quickly, just in the interest of time, I think the opening statements speak for themselves. So I think if we look at that investor class that everyone likes to focus on, some of the submissions have said, well, maybe you just change the capital gains discount and reduce it for established investment versus keep it for new dwellings. Do you think is there a case for trying to incentivise the investor to look more by changing the cost structure for the two investments more at new housing versus existing housing?
I think, Senator, in response to that question, there was some good intent by the ALP coming up to the 2019 election that focused on new builds as opposed to existing. The modelling showed that it still had a significant detrimental impact on supply because a new home then becomes an existing home. And so it has a significant behavioural impact on how you look at investment in the long term. So, as I said in our statement, there's been nothing about any of the modelling that's been put to this committee that we see at this stage actually increases supply from property investment. Rather, it shows a decline.
Okay.
I'd add as well that if you did that, So if the discount applied to new homes and not to existing homes, the problem is that once a new home is sold, it's instantly an existing home. And the selling price that the investor would get when they're looking to sell it further down the track will be adversely affected by that change in the policy. So they're looking at how much is going to be made over the term for which they hold the home. And the fact is that it'll be much harder for them to sell it, given that it's now an established home, when they want to sell it. And that's probably the tricky part of it.
So that's a factor, but relative to investing, all other things being equal, established versus new, if there was a different discount, even though it does become an established dwelling down the track, it would still change the incentives, wouldn't it?
Well, I think, Senator, the problem is it may change the incentives but actually have an adverse impact on supply ultimately.
Right.
I think you cannot assume that a benefit to new homes will suddenly result in an increase in supply, and all the work that we've done historically shows that you still have an adverse impact on supply.
Okay. So I think per the government's agenda of building 1.2 million new homes and freezing the National Construction Code and obviously intense focus on supplies is the trajectory that you're recommending.
Certainly, Senator, we are totally supportive of the 1.2 million. We also say that there are multiple facets of policies that impact our capacity to deliver. We say that there have been some things that have been determined, put in place by the Housing Accord that are useful in enabling us to achieve that. There are still significant barriers, particularly when it comes to not having enough people to build in the first place. But also all of those tax and costs that HIA outlined in their commencing statement. But I think it's also important to note that when we are trying very hard to increase supply, it would be counterproductive to making a change to a policy that reduces supply.
Okay, thank you.
All right, thanks, Senator Dowling. Senator Bragg.
Well, thanks very much for being there. I guess my main question is, if we were to go ahead with some of the ideas that have been proposed, such as cutting the discount in its entirety or reducing it, how many more houses do you think would be built in Australia as a result?
Zero, Senator Bragg, and in fact it would be fewer than what we are otherwise trying to achieve to build.
So, I mean, the Treasury have given evidence that supply is the main game here in the housing policy zone. You would agree with that?
Yes, Senator Bragg, and as I reiterated in our statement, the Prime Minister immediately after the election reiterated it was a priority policy of the second term of his government. Okay, so, I mean, the Treasury gave evidence before you that effectively, I don't want to be careful with how I say this, but I think effectively their evidence was, look, CGT would be not a particularly material thing when it comes to the overall housing system in terms of pricing, in terms of supply, based on their research. So, I mean, is there any way that you could conjure a tax change here that would actually result in more houses? I mean, is there any way to reduce the concession and get more houses?
I think the focus on tax should be elsewhere. I think, making changes to CG discount isn't the way to increase new home building, but I think other tax changes, especially ones at the state and territory level, probably could make a big difference.
Housing is not a magical unicorn good where you can increase the taxes on it and expect to get more homes built. That just defies logic.
Yeah, so a lot of the submissions to this inquiry have dealt with the CGT issue in isolation from the supply question. I mean, that seemed, I mean, I understand that's the terms of reference, but it seems to me to be a pretty hard undertaking to look at something like a tax input into something, but then not consider what would happen to the overall market. I mean, so it's pretty hard to take this narrow view and get a comprehensive, understanding of the problem, isn't it?
I would concur, Senator Bragg. The economics of housing are complex. The policy levers that you pull are multiple, and the narrowness upon which we are debating this without looking at the holistic approach to what is in the best interests of the Australian community by increasing supply is frustrating.
Yeah, so effectively we have a country where a lot of Australians do supply rental stock to other Australians, don't we? I mean, we do have that model. So if there were increases in tax or reduction in tax concessions, I imagine your modelling shows that of those 2.2 million people, that they will do something else with their money, right?
Well, yes. I mean, it's assumed that if they have choices, they will seek out other asset classes that actually provide those a better investment decision.
Okay, and look, finally, I thought it was a bit tone deaf for the OECD and the trade unions yesterday to describe investment in housing as not productive. I mean, I thought we were living in Australia, which has a massive housing crisis, and therefore investing in housing would actually be good for the country because then we have more houses for people to live in, and therefore that would be, by definition, a productive thing to do. So, I mean, what do you say to the many, many witnesses to this committee who say that investing in housing is not productive?
I think we can just say that if we build more houses, it'll produce better living standards for people. I think that's the response to that.
The shortage of housing stock is a major macroeconomic constraint, and it is a constraint on productivity. The inability for the labour force to relocate around the country is one of those barriers to improving productivity. And if over the course of the next 3 years we see an increase in the population by around 3 million people, which is what we expect, and we expect to add about 800,000 new homes, that's not enough new homes. And in that context, the existence of capital gains tax or the capital gains tax discount has no impact on the creation of demand as a consequence of growth in population.
The final question, Chair.
Sorry, Senator Bragg, Mrs Warren was just going to respond, I think, briefly to that question.
Sorry. Thank you.
Senator Bragg, I think it's really important from a master builder's perspective is that the industry stands ready to build as many homes as possible to meet the 1.2 million homes that we need for our community. We want to see policies holistically that enable us to build those homes. And so any debate around this issue must be addressed in a holistic approach as opposed to a piecemeal approach that is being put to this committee. And coming to productivity, there are a whole range of productivity sapping measures that impact our capacity to deliver. But I think it's really important to note that our contribution to the economy is every dollar spent in construction, $3 is returned to the community, and we are one of the biggest multipliers of any industry in the country. So if you curtail the investment in our industry, then you put the handbrake on the Australian economy.
Look, I mean, I'm conscious of time, and the Chair's done a great job in allowing us all to ask some questions. So maybe you take this one on notice, but my last question is, how do you justify in the case that people have argued that investing in housing is not productive, how do you argue the economic case that it is productive?
1 in 10 employed Australians are employed in building and construction sector. It is one of our major sources of revenue, and it leads to the mobility necessary to allow a skilled workforce to engage around other industry sectors.
Thank you.
All right, thanks, Senator Bragg. Mr Humphrey-Jenner, it was remiss of me not to give you an opportunity to make an opening statement, so belatedly I'm going to do that if there's anything you'd like to speak about in relation to your submission to the committee. Thank you.
Thanks so much, everyone, and thanks so much, Senator McKim, for inviting me to the committee. The crux of this submission is that Australia has one of the highest capital gains tax rates in the world. Australia's top marginal tax rate is 47%, and that applies to short-term capital gains. By contrast, capital gains tax rates in New Zealand, UAE, Singapore, Hong Kong, they're all 0%. Vietnam in 2025 cut its capital gains tax rate to 0%. China, run by the Communist Party, has a capital gains tax rate of 20%. In the United States, the capital gains tax rate caps out at 39% at the federal level, and they also have that 50% long-term capital gains tax discount. So Australia already has an uncompetitively high capital gains tax rate. Now, at the beginning of this inquiry, the capital gains tax discount was being talked about in relation to all assets. However, it's now focused a bit more on housing. Hiking capital gains tax rates for all assets is a particular problem because it would render Australia uncompetitive relative to the myriad other economies where one could invest in. But also, when it relates to housing, it also creates a problem. And there's a few aspects of this. First, if you hike capital gains tax rates, it's implausible that supply would improve. There's simply no universe in which hiking capital gains tax rates would increase supply through new construction. However, in fact, it could get worse. And that's because anyone who is looking to buy a particular property, well, they're going to look at the after-tax cash flows they might generate from it. What this means is that new builds are going to become relatively less attractive. And this is the case even if the CGT discount only applies to new builds, because they're going to consider what the buyer of their property is going to pay for it. Not only that, holders of property, they're not necessarily going to exit the market. What they're going to do is they're going to hold onto the property for longer, and then they'll get their gains out by borrowing against that property. So, for example, they buy a property and they realize its equity is increased. But because the capital gains tax rate is high, they'll go to the bank and they'll borrow money mortgaged against that property. And that would enable them to get some cash out and liquidity without having to incur the capital gains tax rate. And this is the problem that is going to be exacerbated if we hike capital gains taxes. And both of these factors would reduce the amount of supply available to potential owner-occupiers. It would also deter turnover, like I've indicated, thereby potentially reducing capital gains tax revenue due to the behavioural impact. But also, and this is something that hasn't been discussed so much, is going to impact stamp duty, because state governments rely on stamp duty for a good portion of their revenue. So if you get less turnover, you get less stamp duty, and state governments need to work out how to balance their books. Ultimately, hiking capital gains tax rates would make Australia a less competitive and less attractive place for capital. It would not improve supply, and potentially is going to worsen liquidity in the market. So in fact, I would encourage the committee to look at reducing capital gains tax, or alternatively increasing the capital gains tax discount, although my preference would be for reducing capital gains tax across the board.
Thanks, Mr. Humphrey-Jenner. Could I ask you whether you think reducing the capital gains tax discount would change the percentage of the housing stock owned by owner-occupiers as opposed to investors?
There are multiple levers involved in this, and we're sort of looking at how to model this. So in many ways, there is, I guess, a degree of ambiguity about it. The reason I say that is we've got two countervailing factors. Firstly, if you increase capital gains tax rates, it would potentially make property incrementally less attractive to investors, right? Secondly, on the other hand, those investors are going to be less likely to sell. And we need to consider when modelling this, the ability of those investors to just hold onto the property forever and then just borrow money to get liquidity. Because if your equities increase, you go to the bank, you get a mortgage, and you say, well, I want to borrow 80% of my property, which is now increased in value. You get the money out, and you do that instead of selling. So it's not as simple as just saying, well, it's less attractive, therefore you get fewer investors. Likely it probably would create a bit of a shift, maybe a minor shift toward owner-occupiers. But like I've said, you've got the supply issues and you've also got the behavioural impacts on investors.
All right, thanks. That's helpful. Mr. Reardon, you spoke about, in one of your earlier answers, the people who build the houses. Just let me ask you this. How is it fair that we've got a tax system in Australia where the people who actually do build houses, like the carpenters, the bricklayers, the plumbers, the electricians, the labourers, how is it fair that they're going to pay about twice the tax compared to someone who earns or makes the same amount of money sitting on the couch flipping investment properties. How's that fair?
Sorry, I'm not following your question there. You mean if an owner-occupier buys a house and doesn't pay capital gains tax?
I mean that someone who goes to work for a living in this country doesn't get a 50% discount on their tax. They pay
so they don't pay
tax.
any capital gains tax?
No. Well, that would depend on their circumstances, obviously.
Well, no, if you're an owner-occupier, you don't pay any capital gains tax.
I'm talking about people who go to work.
People that go to work.
And that's,
So an owner-occupier doesn't pay capital gains tax? Investors
I'll run
do.
through the question for you again to try and make it clear for you. The people that build the housing stock in this country, the plumbers, the carpenters, the bricklayers, the electricians, they go to work every day to earn a living.
Yes.
And if that's their only form of income, they pay about twice the tax than someone who makes the same amount on their income as someone who makes the same amount of money flipping investment properties. So how is that fair?
Just so I understand your question, you're saying income tax is higher than the capital gains tax?
Well, because of the capital gains tax discount, yes, it is.
Okay. Senator, we're not here to defend investors. Our goal is to increase housing supply, to keep rental prices down, to keep house prices down. What we don't want to have happen out of this is to get more taxes on housing, which, as everybody else has here explained, you can't raise more revenue from housing and get more homes built. That just does not make sense. So, I think your question is coming at what is the relative merit of capital gains tax versus income tax. Is that correct?
Yes, I'm asking simply, I mean, you're here defending the current capital gains tax concessions and the current arrangements. That's very obvious.
So I think
you've been very clear about that, and thank you for being so clear. So you're here defending the current capital gains tax discount. I'm making the point that people who go to work to earn a living in this country are paying twice the tax on their income than someone who is making the same amount of money flipping investment properties. That is patently unfair, is it not? And you're defending that because you're defending the concession that allows that situation to exist.
I think we've just heard our colleague here, Mark Humphrey Jenner, explain that capital gains tax in Australia is significantly higher than it is elsewhere in the world. Previously, we heard Treasury say that you need to compare capital gains tax to other taxes on savings. Our context here is don't increase the taxes on housing.
All right. Mr Humphrey Jenner, did you have a reflection on my question?
So you're quite right that generally someone who's working as a PAYG employee, they'll typically be paying a much higher tax rate, right? Like in my work at UNSW, I'm on a much higher tax rate than the long-term capital gains tax discount. Now, I have two components to my answer to this. Firstly, I generally agree with Paul Keating, who inflected that an income tax rate, in his case, he said above 39% is confiscatory. So I would actually argue the income tax rate is too high, and that is a problem there. But also the second aspect of it is that I'd actually argue that the investment, whether it's in an investment property or in shares, is a way for that carpenter, that plumber, that electrician to get ahead. So they might be working themselves potentially to death, depending on the industry. Silicosis, for example, is a thing. The way to be able to achieve a semblance of freedom is to not have to do that work. So the carpenter might be working maybe 10, 12 hours a day, but then they can put some money aside so they don't have to do that. And I'd actually argue the investment is how they achieve a degree of freedom rather than having to work themselves to death, either for the government or for their employer. And hence why the CGT is in fact beneficial to many of those individuals if they invest the money appropriately.
Thank you. I think Mrs Warren, you indicated you had a response.
Thank you. I just don't want to be in a situation in which Master Builders is potentially being verbaled. We are here to suggest that a narrow approach in taking a consideration of reducing the discount is going to have an adverse impact on supply, which is one of the biggest priorities this country is facing. We have always said that if you take a holistic approach to taxation arrangements in this country to ensure that we get the best possible outcome for all Australians, including to own or rent a home, then we are up for that challenge. But that is not what is before this committee at the moment. This is a narrow focus committee specifically focused on reducing or abolishing a tax that will mean a reduction in supply of housing. Our focus and defence is about the reduction of supply in housing, not a specific tax arrangement.
All right, thank you for that, and thank you very much for the witnesses who are here. We appreciate you coming in and sharing your expertise with the committee today. We will suspend until 2:30.
Thank you.
Call the committee back into session. And we will recommence this afternoon with Mr David Montani. Mr Montani, I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please state your full name and the capacity in which you appear?
I'm David Montani, a Chartered Tax Advisor.
Thank you. I invite you, if you wish, to make a short opening statement, following which we'll have some questions for you.
Thank you, Chair, and thank you for the opportunity to appear. Yes, I would like to make an opening statement. Australia is in a tax reform gridlock, but it's not due to any lack of broad consensus amongst experts. It's a political impasse, and so breaking the gridlock requires a political solution. In my book, Tax Wars, I do recommend reducing the 50% discount, but I do so merely as one component of a holistic and coherent reform package. That is why my recommended change works with no grandfathering and no asset class differentiation. And that comes into play when considering item H in the committee's terms of reference. And so in the course of considering the operation of the CGT discount, I urge the committee not to underrate the importance of item H in the terms of reference, any other related matters. Thank you.
Well, thank you. It's refreshing to have such a brief and on-point opening statement, Mr Montani. Thank you very much for your attendance here today. Your book, Tax Wars, charts the history of tax reform to an extent in Australia and, as you've alluded to, discusses why no major reform has occurred in recent decades. I've got some questions about what you call the political impasse, so I will come to that. But just on the policy first, and specifically in relation to the CGT discount, noting your reference in your opening statement to a more broadly based approach. But specifically on the CGT discount, could you just firstly say whether you think that that has contributed to contributed to housing unaffordability and economic inequality in Australia?
So housing unaffordability, economic inequality. I mean, I'm not an economist, so I'm sort of giving a view more so from from an amateur economist. If I say anything out of turn, I'm sure Senator Dowling, the resident experienced economist, might pull me up.
He might.
But I mean, I think what you're talking about is, does the discount produce behaviour that results in those outcomes?
That's right.
And look, I believe there's been evidence and research to show that, of course, it motivates behaviour, but and of course, what you're talking about, well, it doesn't motivate behaviour for people to invest in unproductive assets like established residential rental properties and so forth. Look, as far as I know, look, I believe it does contribute. As to how much on its own is a separate matter. On that subject, I mean, I think it's that and a combination of other factors that do contribute to what we regard as an overinvestment in unproductive assets. So it probably does, yes, make a contribution, but if you extract that in isolation, it may well be relatively small, but in combination with other factors, I think you get a synergy effect that produces these undesirable outcomes.
And in terms of inequality more broadly, have you got a view on that? Whether the CGT discount contributes to that?
Well, I mean, inequality is a very broad subject, and I'm conscious of not confusing correlation with causality in any outcomes. I mean, it's been mentioned before by previous witnesses that you tend to see sort of wealthier and certainly older people who get more of a benefit from the CGT discount, but you might expect that because you would think older, wealthier people, of course, have accumulated more wealth. So, whether it then causes a barrier for other people to share in that those opportunities, very fair question. So again, we're talking about like inequalities is an outcome from other things. Does it contribute to that? Again, well, quite possibly yes, but in isolation, again, different question as to what extent. Again, I think it's back to it and a combination of other factors. If you're looking at the subject holistically, you've got to consider a variety of contributing factors rather than any one in isolation.
All right, thanks. We've heard a few arguments during the last couple of days and in some submissions that removing or reducing the capital gains tax ironically, these arguments are often put forward by those who represent property investors, but the argument that they put forward, some of them, is that removing or reducing the CGT discount would cause rents to rise. Do you have a view on that?
There seems to be a bit of a... the whole idea of if you reduce the discount or, for example, the paired subject of negative gearing, if you restrict that in some way, will it cause rents to rise? And I do sort of wonder if people have that sense from perhaps a mythologised version of what happened in the mid-80s, where there was about a 2-year period from 85 to 87 where negative gearing deductions were restricted. Now this was, existing properties were grandfathered, and this was just about the time when CGT came in, but of course we're talking about assets that were acquired pre-CGT, so CGT just wasn't a factor. The evidence showed from that period of time that, look, in some cities, a couple of cities, yes, rents went up, and a couple of cities, rents went down, and another one, it was even. And from what I understand, that was more just a reflective of the general cycle in rents. So, I mean, if you are again talking about an isolated change, such as the 50, paring back or replacing the 50% discount with something less generous, again, when you're talking about an isolated change, there's pressure to grandfather. So if you made this type of change in whatever form, but you grandfathered existing assets, and of course, anyone who, say, acquires a property, for example, after the change, they're subject to this change, that's going to cost me more, because we're talking down the track, we're talking about the realisation end of the scale here. If anyone thought, well, I need to raise my rents to cover that, but you're competing in a market with everyone else who's grandfathered, who isn't troubled by this issue, you're not going to be able to compete rent-wise. So again, I'm sceptical for a variety of reasons of a change like this leading directly to rent rises. So again, I'm just going off the evidence that I have seen over the years.
Thanks, that's helpful for us. A couple more on the policy and then I'll come to the politics, which you've referenced. Would you agree with the proposition that reining in the CGT discount in some fashion, whether that be a reduction or a full elimination, would increase owner-occupiers' share of the housing stock and decrease the share of the stock held by property investors?
So we're talking about the motivation of buyers. We've got buyers to live, buyers as an investment property. So, and because that's the distinction. If you say to all asset classes we're going to pare back the CGT, then residential property, commercial property shares, well, they're all in the same boat. So relative, you haven't actually shifted any motivation between asset classes. So if you're talking about wanting to shift behaviour, then you would need to differentiate in some way. So if, again, for example, I know this isn't talked about before, there's nothing new here. If you make some change, but you say, well, that change applies to if you're purchasing, say, an established residential rental property. If you purchase a property for rent, if you build a new build for a property to rent, will treat you more favourably, then of course you're creating an incentive for people to say, okay, I want to buy or invest in a residential property. Because of this, I'm going to now go buy new residential or new build, rather than going looking at an established to buy an established property. So of course that shifts demand to we want more new houses. The supply being able to meet that is something else entirely. But I take your point in terms of if you differentiate in some way, again, an economist will tell you, look, show me the incentives and I'll show you the outcomes. But again, you can make a change like this, and yes, it's clearly designed to nudge behaviour. How effective it would be is then, of course, a completely different question.
All right, thank you. And finally, on the policy, your recommendation is a reduction in the discount, but no grandfathering arrangements. Could you just talk specifically about your view that there should be no grandfathering for existing properties and why that's important?
My proposal is achievable without grandfathering and without asset class differentiation, because it's just one component of a coherent, holistic package. You don't need to shield existing asset owners because of other changes as well that form part of the package. Now, I had 11 items in my package, and they were just what I call the big rocks, the big important things. You get those sorted, that's what enables you to then work on sort of second order issues. But it works because of other changes. So, for example, yes, I say, look, reduce the CGT discount, but not in isolation. That is paired with, for example, a reduction in income tax rates. So, okay, look, I'm taking away your discount, but I'm also reducing your income tax rates. I do also include, yes, curb or delay negative gearing deductions for established residential property. Allow it only for new builds. So the two of those combined. But I also have of course, the classic dream of every tax expert is the tax mix reform, where we do shift from our over-reliance on income tax and more to consumption taxes, our GST. Of course, as always, accompanied with the appropriate shielding measures for low-income people.
Thank you. So I'm just going to come to the politics now, and I think you've heard versions of this question already today when you've been in the room, but like we're in a parliament now where Labor has a comfortable majority in the lower house, and Labor plus the Greens is the numbers in the Senate. The right of politics is kind of, I will say this, I'm not asking you for a view, but I would say they're in disarray at the moment. My view is if we can't get progressive tax reform done now, when could we ever get it done? Would you agree, though, with the proposition that this is actually a moment in time where the opportunity is before us collectively as a parliament, potentially to a degree that it hasn't been open to us for some time? And would you like us to seize that opportunity for some significant tax reform that is of high ambition?
I would love to see tax reform of high ambition. We've only been waiting 20, 25 years for a bit of that. Look, you're right. You've got the parliament is in place, but I would say the planets aren't in alignment. And the holy grail of tax reform is tax mix reform, shifting from our over-reliance on income tax to consumption taxes with appropriate shielding measures. That is what enables you room to do so much more. Without that, then you are more limited. But again, now we're talking about the politics. I think the planets aren't in alignment. That's a story 3 decades plus in the making. I know you said you've read bits of my book. What's happened over 30 plus years is that both sides of politics have essentially painted themselves into their respective corners. And so you're stuck because of their predecessors. And they're stuck in these entrenched positions, either supporting or opposing certain tax ideas. And because because you're so stuck in those corners, you can't step out without losing face. And as a result, people like me, we berate the politicians over lack of reform. We mock the tinkering that gets put up. Sure, that can be a lot of fun, but it's unhelpful. And I do think that we can be more helpful to help both sides step out from their painted-in corners while saving face. But I don't think that's going to happen. Well, in fact, I'm virtually certain that won't happen just under the current political leadership, irrespective of the makeup of the parliament, because of just being so entrenched in those painted-in corners over a long period of time.
Thanks, Mr Montani. I'm compelled to make the observation that over time there is an emergence of more than two sides in Australian politics, but I'll just leave that as a statement, not a question, and I'll offer the call to Senator Dowling.
Thank you, Chair. Thanks, Mr Montani. I think now I know you're trying to present a holistic approach of the tax landscape, and if we just think of this inquiry in the CGT discount, it's had a whole bunch of sort of value-based lenses put on it, intergenerational equity, housing affordability. What is the right way to actually be thinking about what, if any, an appropriate discount should be in the tax system?
So what an appropriate discount should be? I mean, that implies that it's appropriate to have some discount. And again, the economists have come before me. Look, they pretty much all say, look, there are good reasons for not taxing capital gains fully like we do income. And look, they've been like, there are good reasons for doing so. Totally different question is, well, okay, if there are good reasons to not tax capital gains fully, separate question, how far back do you pull back on that? And I mean, there's a general consensus that what we have presently, the 50% discount, is too generous. And the thing is that if you are going from a situation of widely acknowledged overgenerous, and you want to change that, but you put up that change in isolation, I think you are more limited in what you can achieve, both from a technical policy point of view and politically. And we've seen in recent years when you put up an isolated change that's really trying to address a fundamental issue, the history is not good. In fact, they've mostly all politically gone down in flames when you're trying to address a fundamental issue by addressing something in isolation. But I mean, back to the point of, well, you know, what might be a fair paring back? If you say 50% is too generous, if you say, well, what if we were to, just looking at the discount, not say replacing it with something else entirely, just sticking with the discount, I mean, if you pared it back a little bit, you might say you went from, look, let's go from 50% to 40%. I mean, that was actually the recommendation in the Henry review, but as part of other recommendations as well. You might say, look, we're just going from over-generous to generous. And you might say, well, I would expect the behavioural outcome from that to be more limited. But it's as far as I can go, because every percentage point you reduce the discount, double it, and that's how much you're increasing capital gains tax. So you go from 50% to 40%, that's a 10 percentage point reduction. The maths is very simple. That's a 20% increase in capital gains tax for everybody. So again, you put that up as an isolated proposal. I don't mean to put ideas in anyone's heads, but it's very easy to say you're increasing a tax 20%. But that's the optics of an isolated proposal.
Yeah, and is it not the case that even if you're changing one part of the tax system, you're effectively changing the whole tax system because it's all relative? So one thing might appear more attractive relative to other parts of the tax system, just by changing that one item of tax code.
Well, true. I mean, you can change one item and you are addressing whatever the subject is you are addressing. But if we're looking at this subject in isolation, it's tinkering. Yes. I go back to the original comments, that word ambition. I mean, we want to see just a bit more ambition here.
And reflecting on that wider tax system, to what level do you think complexity plays a deadweight loss through that whole approach to tax in Australia? Because we have a significant amount of productive energy going into tax planning, tax minimisation, tax avoidance, and we have quite a comprehensive system of deductions as well. Certainly, the government has made some good moves to simplify it with things like $1,000 automatic deduction, which actually probably suits a lot of people who didn't really understand how the deductions work. Do you think there's an opportunity in terms of simplification, so we're not expending so much productive labour and capital on people doing tax planning activity?
Senator, there is so much we could unpack from that. In fact, I do. It just took me a whole book, but I don't think we quite have that much time. You're right. We've always got mostly a tension between, complexity and simplicity. So, simplicity and equity. The two, efficiency, simplicity, equity. They're sort of the three, key tenets of a good tax system. Simplicity and equity are the ones that are typically the most in tension. Yes, of course, we'd like things to be simple. But bottom line, look, if the rules are simple, people will comply. But that, of course, can lead to more inequitable outcomes. Now, if you want to shift along the spectrum towards equity, you have to have greater complexity. That then results in, yes, you get more greater resource consumption just in terms of compliance, let alone anything else. You mentioned things like more effort gets put into planning, both legitimate and perhaps inappropriate tax behaviour. Again, a key motivating factor behind that for some is that our widely regarded over-reliance on income tax. Now, the thing about, of course, capital gains tax is that capital gains tax is not a separate tax. It's just income tax. The tax legislation does not say capital gains tax. It's just simply a part of income. So, if we say the discount is too generous, but you've got to say, well, that's reflective of we have relatively high income tax rates. So again, look, going back to my holistic reform proposal in my book, shifting our emphasis away from our over-reliance on income tax over to GST with the appropriate shielding measures. Income tax you can think of, and that includes capital gains tax, you can think of as being a bit more fluid, whereas GST is fixed. No one can escape bearing the GST. So if you're shifting our burden from income tax over to GST, your overall tax burden might be the same, but you can't escape the GST. And so the income tax pool to play with is now much diminished. And so things like planning and so forth do become less of an issue because the income tax pool is just a smaller pool to play with. And that can lead to a simpler tax system and an more easily administered one. You mentioned also, for example, like the $1,000 deduction. Now, you might think, oh, that's simplifying things. I actually think it's not really, because that's actually reducing the income tax base. So we're giving people a $1,000 deduction even if you incurred no expenses related to your work. Okay, look, we're decreasing the tax base, the income tax base. If anything, we want a broader income tax base. Something like that I would put more in a second order issue, where I would say, and many other countries do this, just get rid of work-related deductions completely. No deductions against employment income, perhaps bar certain exceptions. But when you do that, you're widening the income tax base, we can lower the tax rates. So it kind of works out in the end about the same. Okay, you're not getting any deduction anymore, but your rates or your thresholds are adjusted. You're still paying basically the same amount of tax, but it's a hell of a lot simpler when you just don't have to bother with this standard deduction. So I just raised that because, like, you mentioned that, and that to me is the example of it actually kind of adds complexity and narrows the income tax base. This is the opposite of what we want to see.
Have you considered some of the evidence we've heard? It talks about international competitiveness being one of the other things we should be thinking about in this space, and I guess effectively, given it's 50%, that the top tax on capital discount is 23 or 24% if you pay the Medicare levy. Is that internationally competitive, uncompetitive? Because I've heard very extreme evidence of both in so far.
Well, it's a function of differences in our tax system. We have typically higher income tax rates. I know it's a bit of an oversimplification in terms of what do you define as a tax or not, but if you just look at income tax, look, we rank highly amongst the OECD. Look, I know when you throw in things like social security contributions in other countries and so forth, it does even out a bit more. But it doesn't change the fact we are over-reliant on income taxes, and that's reflected in typically higher rates. But if you compare to, I know it's been mentioned before, like other countries have a dual tax system where savings is taxed at a standard rate. So whether it's capital gains, investment income, everyone pays the same rate, and that might be lower than our, if you say 23.5%, which is just half of 47% for people on the top rate. That lower standard tax rate might be reflective of the fact that, look, they just have a lower reliance on income tax. So it's comparable in that way. And of course, accompanied with that, they're all paying 20-25% GST. So again, you have to take into account those differences in systems in tax systems between the different countries to really get a fair comparison. But still, the bottom line is widespread agreement. We are over-reliant on income tax. If we were less reliant on income tax, you don't need as big a CGT discount. The capital gains tax still being paid could be, in my book, I work out the numbers and I say, well, based on my changes, people on the top rate will actually pay a little bit more capital gains tax than they are paying now. So I'm saying pay more capital gains tax. But I couple that with a bunch of other changes where I make the point that, look, if out of 11 things on the list, if there's 1 or 2 things you're not overly happy with, but you're fine with the other 9 or 10, no rational person would knock back the package. You can do that with packages.
So I guess back to the very first question, that the terms of reference for this committee and a lot of the evidence has all been about housing, but you're sort of saying, actually, think about it in terms of the tax mix, and potentially you'd look to reform this space so you could actually take a burden off another part of the tax system, like income, rather than capital.
That's right. That is the essence of tax mix reform. We want to have fewer taxes that do a lot of damage. Economic damage. Income tax does a lot of economic damage. Company tax does a lot of economic damage. GST, for example, does much less economic damage. And so, really, you think, what's the purpose of all of this? Especially when I have my big picture, big rocks tax reform. It's all about what are the outcomes. And that's what the real reform is. It's not the changes themselves. That's just the means. The real reform is the outcome from those changes. And what I want to see, and what I firmly believe we would get from those changes, is that, look, we would get a wealthier, happier, more compassionate country.
Thank you.
All right, thanks very much, Mr Montani. We really appreciate you coming in and giving evidence to the committee today. There are no other senators that have questions for you, so you go with our thanks.
Thank you very much.
Your time. Thank you. I now invite to the table Associate Professor Sonali Walpola. Good afternoon, Professor. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please state your full name and the capacity in which you appear today?
Thank you, Senator. My name is Sonali Walpola. I'm a tax academic at the ANU. I appear in my individual capacity as a scholar.
Thank you very much. I invite you, if you wish, to make a short opening statement to the committee, following which we'll have some questions for you.
Sure, thank you. My opening statement may be a bit more than a couple of minutes, but I'm happy to stop at any point.
No, that's fine. You take your time and tell us what you think we need to hear.
Thank you. So thank you very much again for the opportunity to appear before this committee. I will be referring to my joint submission with Dr. John Minnis, which specifically addresses the role of trusts. Firstly, to state our position on the discount, like many submissions to this inquiry, our position is that the CGT discount severely undermines equity in the Australian tax system and that it has no sound policy justification. The stated rationale for the discount in the Ralph report of invigorating equities markets has been undermined in the literature, and the Ralph review did not provide any separate justification why the 50% discount should be extended to trusts. In Australia, trusts provide opportunities for aggressive tax minimisation, and this is because of the fundamental basis upon which trusts are taxed in the income tax legislation. I note that, well, very relevantly, I think, both sides of government have acknowledged that the trust tax rules operate unfairly, and this has been acknowledged from time to time over 30 years. There have been a few unsuccessful attempts at trust tax reform. As detailed in our submission, the tax advantages afforded to trusts, including the 50% CGT discount, contribute to tax inequity, wealth inequality, and intergenerational inequity. The extent of revenue foregone through the tax-motivated use of trusts is shrouded in mystery, but it is likely to be very substantial. We argue that there is a compelling case for the complete elimination of the 50% CGT discount in the trust setting. In the trust's context, the discount, the fact that trusts can claim it, represents an aggravated case of unfairness. And this is because trusts have at their disposal a suite of tax minimisation strategies which undermine equity even before we consider the CGT discount. So trusts provide a vehicle for alienating investment and business income to associates, that is, family members, related entities. Of course, the income will be allocated opportunistically to take account of the favourable tax profiles of beneficiaries. Income splitting has been known, at least its prevalence and the fact that it exists in Australia has been known for at least 50 years, since the groundbreaking Asprey Review of 1975. The injustice of income splitting, and in practice it is only available to wealthy and high income earners, it was highlighted in 2017 by the Australian Labor Party at a time when they proposed reform for discretionary trusts, the way they're taxed. And in the Labor policy document, there's a neat example, which I would call plain vanilla tax minimisation or avoidance, where a surgeon earning $500,000 from their salary income uses a trust to alienate investment income amongst their non-working spouse and adult non-working children, $54,000 divided equally amongst the three family members. No tax at all is paid because it's below the tax-free threshold. It is because of trusts that the highest tax rate for wealthy taxpayers can be described as the corporate tax rate, not the highest personal rate, because it's standard practice in a trust to include a bucket company beneficiary. A bucket company beneficiary does not serve any other purpose but capping trust income at the corporate tax rate, which could be 25% or 30% today. The prevalence of bucket company beneficiaries was noted more than 10 years ago in a Board of Taxation report. And in practice, and indicative of how unfair the tax benefits are through trusts, unpaid present entitlements are extremely common. So in order for the tax liability to crystallise at the beneficiaries' rates, all that needs to be done is that the trustee declares that a portion of trust income is for a particular beneficiary. This is the concept of present entitlement in the law. It is very common that no cash is actually transferred. There may be no intention in the foreseeable future to pay the beneficiary anything, and the tax liability is settled directly by the trustee. So 2 recent cases that we've had, one in the Federal Court and Bendell, presently before the High Court, we are awaiting judgment, concern unpaid present entitlements. Further, there are substantial tax benefits that are possible through trusts because trusts, unlike companies, are treated as flow-through vehicles in the law. This means that tax-preferred income, capital gains, franked dividends can be streamed to particular beneficiaries who can take advantage of that tax-preferred income. So, for example, in the context of a trust with capital gains can be allocated to a beneficiary with capital losses to offset the gain. Capital gains can be distributed to individuals who can take advantage of the CGT discount. These tax minimisation strategies, they are inherently unfair. They could be described as loopholes. They make a mockery of the tax law. To compound the inequity, these benefits are only enjoyed by economically privileged taxpayers. Data published by the Australian Bureau of Statistics gives some indication of the nexus between wealth and trusts. The data is extremely imperfect, and better data would be wonderful. The data that we do have show that for Australians in the top quintile of wealth, where the average net worth is 3.267 million, they own 94% of the value of financial assets held by trusts. It would be good to have data for the top 5% and top 1%, for example, and to know what proportion of the value in trusts they control when total assets is what we look at, and that would include land. The fact that trusts mainly benefit wealthy taxpayers was acknowledged by the Coalition nearly 30 years ago in 1998 when it proposed that trusts, later changed to discretionary trusts, be taxed like companies. And in its 1998 white paper, specifically in the context of trusts, there's a statement that the rest of the community subsidises the wealthy investor. This statement, acknowledging the inherent unfairness in trust tax rules, was made before the introduction of the 50% CGT discount. The introduction of the discount amplified the already tax-advantaged position of trusts. Yep. So our position is that the removal of the CGT discount, especially for trusts and completely, that's what it should be, is very strongly justified on equity grounds, and there's no trade-off with the other tax policy criteria of simplicity and efficiency. Thank you.
Well, thanks, Professor Walpoler. That's a very comprehensive opening statement and very, very helpful for the committee, particularly in the area of trust where we haven't had a lot of evidence so far. So committee thanks you for that. Can I just pick up on a couple of points that you mentioned there? Firstly, why are trusts so shrouded in mystery, and particularly around sort of trust-held assets and the income distribution of trusts? I mean, is this a data collection issue, or is there something sort of more broad happening here?
It is definitely a data collection issue. It doesn't have to be like this. And in fact, on the trust transparency, Australia does very badly. There was a report published by the Tax Justice Network, and other countries, United Kingdom, I think New Zealand, I can send you further information to confirm that, have established trust registries. They have taken moves to increase transparency. So we can require trusts to provide detailed data. So shrouded in mystery, it's really a regulatory deficiency.
Yeah, I was going to pick up on that. So is the problem the lack of a legislative framework, or is it sort of further down the chain at the ATO or the ABS? I mean, do we lack the head of power to require trusts to be more transparent, or does that exist and it's just a lack of implementation?
We have the legislative power. It is simply that we have not required trusts to provide details. The ATO does provide some information in their tax statistics, so we get some indicator that there could be a very serious problem in terms of, it's not, it's virtually a euphemism to say it's tax minimisation. Very likely there's large-scale tax avoidance. In Australia, the fact that about 80% of trusts are discretionary trusts, and that data is in the ATO trust tax statistics, that is explained by tax advantages. Because in a discretionary trust, the trustee can dynamically each year allocate income any way they see fit, and they will make tax optimal allocations. So by contrast, in a fixed trust, the entitlements to income and capital are predetermined by the terms of the trust.
Thank you. You've referred to the fact that both Labor and Liberal governments have, I mean, my words, not yours, but flirted with the idea of reform around how trusts work, and then they've kind of balked and done nothing or done very little. Why does that keep happening?
Yeah, okay, so just on that, in the late 90s we came very close, and that's the proposal that it reached a very advanced stage, entity tax, the proposal that discretionary trusts in the end would be taxed like companies. For a couple of years we thought it would happen. So the proposal was announced in 1998 and abandoned in 2001, and that was after exposure draft legislation had been produced. That draft legislation was very unpopular. The perception in the community was that it actually disadvantaged trusts compared to other entities, companies. So perhaps if that feedback was taken on board and we might have had entity tax. It possibly could have been done. Labor in opposition proposed reform for discretionary trusts. So if they got into power at that time, maybe we would have had some trust tax reform. It is considered extremely difficult.
Sorry, do you mean politically difficult or sort of complicated?
Complicated, complex. Yeah. I don't know whether it needs to be at all because, and we go through this a little bit in our paper, with trusts you have the interaction of general law concepts, a construct, the trust, that was developed 700 years ago in England, general rules which are still relevant for the tax rules, and it is considered a very complex area of law. But to undertake trust tax reform, especially if the goal is increasing equity in the tax system, it is something achievable. And in our paper, we suggest entity tax for trusts, that trusts be taxed like companies, and with further measures to really address the tax minimisation problems that we've seen in trusts.
Thank you. Could I ask, would you, and I'll be very happy if you would take this on notice, I mean, feel free to offer anything here, but I'm interested, I think the committee would be interested in recommendations we could make around how we could actually collect better data on trusts, and potentially based on some of the better examples internationally.
That would be excellent. Yeah. So, look, that would be great if I could take that on notice and then get back to you.
Yeah, thanks. I'll run through at the end the on-notice process for you, but in the interim I'll throw to Senator Whittaker.
Thank you. I just have some really kind of brief questions. I know that your submission and your evidence is largely focused around trust, and so I'm interested in why that's been your focus as opposed to the CGT discount as it applies more broadly.
Yeah. So very kindly, this committee also attached our published article as well as our submission, and our article covers the discount in some detail, and as I indicated at the beginning of my opening statement, we are strongly of the view that the discount undermines, tax equity, that it contributes to wealth inequality, intergenerational inequity. I heard the testimony of Bernie Fraser this morning, and he was of the view that we completely abolish the discount. I would be of that view as well. I have listened to a number of the sessions, and Senator McKim, I've heard you state that more than 50% of the benefit of the CGT discount goes to the top 1%. And Dr. Minnis's research, extensive research on the CGT discount is aligned with what you have stated, and shows that it's highly skewed towards high income and wealthy taxpayers.
Mm-hmm. So, to clarify, you're of the view that the discount should be considered more broadly than just trusts?
Oh, definitely. So that's why we described the case of trusts as an aggravated case of unfairness. Mm-hmm. Say if it was considered that, say politically, that you could only achieve a mere reduction of the discount rate, what we would argue is the situation with trusts is so unfair that, at least in the trust setting, abolish the discount completely. And in terms of why the submission focuses on trusts, we were specifically invited to comment on that.
Sure, thank you. Are there other elements of the tax system that feed this kind of inequity that you're talking about, in your view?
The regime for taxing trusts. And so I understand that the impetus for this committee, the rationale is concerns about intergenerational inequity, wealth inequality. Absolutely. Reforming the whole regime, an overhaul, And that's really our article is about CGT reform and reform of the trust tax regime.
Mm-hmm. In your view, what would be a better way to manage these kinds of capital gains in the tax system? Particularly, one of the things that I think we've talked about quite a bit over the last couple of days is, how to manage gains that are made through inflation over the period of holding an asset, and clearly that's something to consider in these kinds of discussions. So I'm interested in your view on how that might be managed.
Yeah, so pre the discount, we had indexation of the cost base, and I'm not opposed to that. We could go back to that, and no discount at all. I'm not for a reduction of the discount. I think it should be completely abolished. Bernie Fraser didn't even want indexation, and I think Oxfam maybe yesterday didn't want it either. And they suggested, I thought this was quite useful, this phrasing that then it would operate perhaps more like something de facto wealth tax. I would be fine with not even indexation of the cost base. We don't index the personal tax rate scales.
Mm-hmm. Okay, thank you. That's it from me, Chair.
Thanks, Senator Whittaker. Professor Walpole, if I could just finish up your time here with a couple of further questions. Your submission says that trusts, and you've gone through this today, shouldn't be eligible to claim and pass through the capital gains tax discount in the same way that companies can't. Could I ask you, though, are there any policy or technical challenges that you can think of that would prevent such a fundamental change being implemented?
For trusts? Not at all. Actually, it would simplify the taxation, how to compute it in a trust setting. Briefly, even in the submission, I have a few lines of how the mechanics actually work. And because of the existence of the discount, there's this sort of further couple of steps with first the trust claims the discount at the trust level. Then when the trust income is allocated to beneficiaries, if it's an individual, they gross up that amount, they add back the discount, and that's for the purpose of claiming personal capital losses. And after that step, then they discount. It would be simpler, actually. And so it's no trade-off. It would, in fact, be simpler, and it's absolutely justified on equity grounds.
Thank you. And just to be clear, in your opening statement, you said, I'm paraphrasing you, but you said that, in your view, trusts were used as an aggressive tax minimisation vehicle or part of an aggressive tax minimisation strategy. Is that fair?
Absolutely.
Yeah.
And that's really putting it lightly.
And to be clear, your evidence is that the capital gains tax discount is one of the mechanisms that trusts use to engage in that aggressive tax minimisation or even tax avoidance.
Definitely. The discount amplifies an already unfair situation. And I have some extracts from advisor websites, including an extract where the 50% CGT discount is marketed as one of the benefits of using a trust to invest.
So people are marketing the capital gains tax discount as one of the ways that trusts can be used to minimise tax. Is that your evidence?
Absolutely. Yeah. And so there's some quotes in our submission, and Alex Evans, in a 2019 Sydney Law Review article, made a comment to that effect as well, that definitely the 50% CGT discount is considered it's a significant benefit of using a trust generally.
All right, thank you, Professor Wappler. On behalf of the committee and the Senate, thank you very much for taking the time to make a submission and to come in and give your evidence today. You've kindly offered to respond to a couple of questions on notice, and we do appreciate that. And if possible, could you please forward your responses to the Secretariat by the close of business on Thursday, the 5th of March?
Thank you very much, Senators, and thank you for the opportunity to contribute further.
Thanks very much. The committee will now suspend until 3:45. Actually, we might make it 3:40. in session for the committee, and I invite a representative of the Australia Institute. Good afternoon. Thanks for joining us today. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please state your full name and the capacity in which you appear today?
My name's Matt Grudnoff and I'm the Senior Economist at the Australia Institute.
Thanks, Mr Grudnoff. Do you have an opening statement for the committee?
I do, thank you.
Please go ahead, and at the conclusion we'll have some questions for you.
Well, firstly, thank you for inviting me to speak to you today about the capital gains tax discount. Over the last 10 years, the number of homes has been increasing faster than the population. Let me say that again. Over the last 10 years, the number of homes has been increasing faster than the population. Over those 10 years, the population has increased by 16%, while the number of homes has increased by more, 19%. The housing crisis has not been a housing construction crisis. Instead, it has been caused by an explosion in demand for investment properties. People buying their second, third and 10th home have rushed into the market, outbidding those who are trying to buy a home to live in. This has been set off by the introduction of the capital gains tax discount. The CGT discount has turned the housing market into a casino. The Australian dream once saw housing as a safe and secure place to live. Now, housing is an asset to speculate on, a way to make money, to build a financial nest egg. Housing is being increasingly concentrated into the hands of fewer and fewer people, as the discount, combined with negative gearing, is helping investors outbid first home buyers at auctions across the country. Every time a property investor buys a house to rent out, they just reduce the supply of housing for a family looking to buy a home of their own. We can increase housing supply for first home buyers by building more homes, or we can increase supply by scrapping the discount. Scrapping the discount will push out speculators, increase the supply of housing for those who want to live in them, including first home buyers. We know this will work because we have examples of where this has happened. In Victoria, they announced increases in land tax more than 2 years ago. Data shows that since then, property investors have been exiting the market. The result, over more than 2 years, house prices have increased by just 2% in Victoria, compared with 17% for the rest of Australia. At the same time, rents have increased at about the same rate as the rest of the country. Rents were unaffected. If we scrap the discount, we could see the same result across the country. More homes for those who want to live in them, higher home ownership rates. Beyond making housing more expensive, the capital gains tax discount is distorting the economy in other ways. The discount is increasing inequality. It overwhelmingly goes to high income earners, older people and men. The capital gains tax discount has distorted bank lending. Since the introduction, banks have a much larger proportion of their funds going to mortgages at the expense of lending to businesses. Loans are an important way that businesses invest in productivity enhancing capital. The lack of lending has the consequence of for both businesses, investment and productivity. The capital gains tax discount also has been changing how those on very high incomes are choosing to earn their money. These people have much more control over how they earn their income. Tax data shows that over 11 years, they have almost doubled the proportion of their income coming from capital gains. This is likely because the discount makes capital gains a very tax-effective way of earning income. We recommend scrapping the capital gains tax discount. This will push out speculators, increase the supply of housing for those who want to own their own home and live in it, including first home buyers. I'm very happy to answer any of your questions.
Thanks very much, Mr Grudnoff. I'll kick off, but I'm sure my colleagues will have some questions for you. Look, firstly, What would you say to the argument, which is ironically often put forward by people who represent landlords, that scrapping the capital gains tax discount will cause rents to rise?
Well, it won't cause rents to rise because all it is changing ownership. So imagine that a renter is looking around to buy a house. So most people, before they buy a house, rent. And it just so happens that the house they're renting at the moment comes onto the market. If they buy that house, then there is one less rental property out there. So you would expect perhaps rent would rise because the supply of rental properties has gone down by one. But at the same time, the number of people wanting to rent has also gone down by one because they're no longer renting. They go from being a renter to a first home buyer. So every time a property gets transferred from being a rental property to being bought by a first home buyer or owner occupier, the number of rental properties does go down by one, but the number of renters also goes down by one. So it shouldn't have any impact or very, very little impact on the rental prices. And in Victoria, as I said, over those 2.5, almost 3 years, rents on average across Australia went up by 16% and rents in Victoria went up by 15%. So about the average, what we would expect. It's had very little impact, if any, on rental prices.
Thank you. And to be clear, it is your evidence that if the CGT discount were scrapped as you're proposing, or even simply reined in and made less generous, that would increase the proportion of Australia's housing stock that is owned by owner-occupiers and decrease the proportion that is owned by investors. Is that right?
Yes, exactly right. So most or a large proportion of investors are negatively geared. That simply means that they're losing month to month. So let's say they're losing $20,000 a year running their investment property. What they're hoping is that the capital gain each year will be more than $20,000. If it isn't, then this is a loss-making investment for them. And so they're counting on the price going up. If they have to pay more tax when they finally sell on that capital gain, then they're going to be less inclined to buy houses at the high price that they're currently buying them at. If they're unwilling to bid the price even higher, that will give first home buyers a chance in the market.
And just stepping back and perhaps taking a more sort of helicopter view of Australia's tax system, how do you view the fairness or otherwise of a tax system that taxes someone who flips burgers for a living significantly more than someone who flips investment properties for a living and earns the same amount?
Yeah, look, as an economist, you want to encourage the kind of incomes that create things, whether that's running a business, whether that's working, as you say, flipping burgers, whatever it happens to be. The burger flipper is creating burgers. They're creating stuff that other people then consume. If you're earning your money through capital gains, all you're doing is selling an asset that already exists for more than you bought it for. You're not actually adding to the amount of production in the economy. When you bought it, that house could house one family. When you sold it for more, that house could still house one family. You haven't, over that period, added anything to the productive capacity of the economy. So we should be encouraging the kinds of people to earn income in a way that creates things rather than just sits on assets and watches them go up in value.
Thank you. Just a couple of final ones from me. Despite our efforts, none of the banks nor the ABA were willing to come in either to submit or appear at hearings before this inquiry. Could you just talk us through how banks profit from the CGT discount, if in fact you think they do, and the housing crisis more broadly?
Yeah, so the larger the mortgage, the more a bank gets in interest, and it basically makes a rate of return between what it borrows money for and what it lends it out. So the more money it lends out, the bigger its profit is. In fact, we know that on average, over the life of a mortgage, the average of the big four banks make $200,000 profit. That's profit. So that's their profit after all their costs, make $200,000 profit on those mortgages. And that's been going up over time. And the reason it's been going up is because loans have been going up. So the capital gains tax discount pushes up house prices. Those higher house prices mean that banks need to lend out larger and larger sums of money, so they make larger and larger profits.
Yeah, thanks. That's really clear. I might just throw to my Labor colleagues first, Senator Dowling, and I'll probably have a couple more for you as we go through. Senator Dowling.
Thanks, Chair. Thanks, Mr Goodenough. Is it right that you're asserting that population growth and housing supply neither have contributed at all to the current housing affordability situation?
Well, I mean, it can't be a supply problem because, as I said, the supply of housing, the number of houses we have, homes, has been increasing faster over the last 10 years. We don't have good quality quarterly data going back further than about 10 years from the Australian Bureau of Statistics. But if we look at the census has an excellent data set on the number of houses and the population. They literally go to every single one of them to count them all. If we look at the 2001 census, which is the census closest to when the capital gains tax discount first came in 1999, and we look at the most recent census in 2021, so that 20-year period, the population has increased by 34%, but the number of dwellings has increased by 39%. So even over that longer period, we know that the number of houses has been increasing faster than the population.
And that's sufficient for you to conclude that supply has nothing to do with the house price?
Well, I mean, no, yes, I think that it's unlikely that supply has had any major role. That's not to say that increasing supply won't help solve the problem. If we were to build more houses more rapidly, absolutely that would help with housing affordability. I'm not saying that an increase in supply won't help. What I'm saying is this crisis hasn't come about because of a shortage of supply. It's come about because of a big increase in demand, investor demand for housing. Investors have come in, outbid owner-occupiers and particularly first home buyers, and that's what's locking them out of the housing market. And if we get rid of the capital gains tax discount, we can effectively increase the supply to first home buyers by because as those investors sell those property, that supply will then be bought by owner-occupiers, first home buyers.
Okay, so you're quite confident that there's a causal link between the introduction of the capital gains tax discount in 1999 and the accelerating trend of house prices?
Yeah, I think that there's very good evidence for that. If you look at negative gearing, before the capital gains tax discount came in, the net rental position of the entire economy of all of Australia was sometimes positive and sometimes negative, and it was quite small. So really they were kind of net rental neutral. After the introduction of the capital gains tax discount, negative gearing exploded. And that was basically because investors worked out that they could pay higher and higher prices and suffer those losses because they didn't have to pay as much tax when they finally sold the property. They could rely on that capital gain. And of course, as that capital gain grew, as the prices went up, those capital gains grew, and that attracted even more investors.
So if it was causal, then how do we explain that similar trend in prices globally in similar advanced economies, New Zealand, UK, Canada, United States? They all seem to accelerate in that chart that Alan Kohler referred to. And if you look at similar economies, they all go up and to the right from about the year 2000. So, and those other economies didn't have significant tax changes at that time. So
yeah, look, I don't know what the tax and what was going on in those economies. I've been looking at the Australian market, the Australian housing market. I'm not sure what was going on at the same time in each of those economies.
Well, I guess I'm putting it that perhaps there was other factors like global credit conditions that could also play into this rather than just a discrete tax issue.
It's possible, but as I said, just the way that people have reacted, talked about and thought about how they've invested in residential property, it's been very clear that after 1999 there was a clear change in where they were investing and why they were investing. And it seems very obvious that it was that capital gain was the way in which they now wanted to earn income because it was so tax effective. They paid so much less tax, they could afford to pay higher prices.
Okay. So naturally follows that you conclude that scrapping the CGT discount will reduce investor demand and improve affordability and ownership. Do you have any sort of view as to the quantum of that and any sort of evidence to where that would result over a period of time?
Yeah, so I mean, we have two examples. We have the Victorian example, which I talked about in my opening statement, but we also have another example in about 2015 to 2019, or 2016, I should say, to 2019. There was a change in the macroprudential regulations. Basically, the regulator was worried that the financial market was becoming unstable, that there was too much risky lending in mortgages, in investment mortgages, and so they directed the banks to reduce the amount of lending that they were making to investors, which did eventually happen in 2017. Now, from 2017 to 2019, we saw a 9% fall in property prices. It's the largest fall we've seen over the last 30 to 35 years. And at the same time, we saw investors getting out of the market. That is, the amount of investment loans went down. So again, it's along with the Victorian example, shows that when you disincentivise or make it difficult for investors to get in the market, what we see is house prices tend to stabilise. I wouldn't expect a large decrease in prices, a kind of modest flattening out, and basically home ownership or first home buyers are able to get in the market because investors aren't out competing them.
So would you concur with the general literature that we've seen that between 1% and 3% impact on prices I think that's of removing the discount altogether?
Yeah, no, I don't think that economic modelling in this particular case, like economic modelling has a role to play, but in this particular case, I don't think economic models are very good. And the reason why is economic models assume perfect information. They have to. So they assume that all investors know what the future house price is going to be. So what they effectively can't do is account for speculators. And so all the model is doing is looking at the future return to the investor, which they know in advance, and working out, well, because they're going to pay a bit more capital gains tax, they're not going to buy or demand quite as many houses. But I think what will actually happen in the market is that investors will stop seeing house prices rise rapidly. They'll see them flatten out. They'll realise that they can't sustain the losses with these higher and larger mortgages, and so they will withdraw from the market, and we will see less speculators and less investors in the market. The modelling can't possibly capture that. So economic modelling is good for some things. I think in this particular case it's a very poor tool in order to predict what's going to happen to future house prices because of this policy change.
Okay. It just seems that your evidence, and you... this is just an observation, that it does seem quite an outlier with everything else we've heard that sort of suggested that the capital gains tax discount is really a small component in terms of the overall housing supply challenge, housing affordability challenge, but you're sort of saying it's the main game.
Yeah, absolutely. I think that it is the main game. I think it's the easiest, simplest way that will have the biggest impact on making housing more affordable. Additional supply will also help. There are other things we can do that will help with housing affordability, building more public and social and affordable housing. But I think the biggest single thing that the government could do, any government could do, is to scrap the capital gains tax discount.
Across all assets?
Sorry, are we just talking about housing?
No, I'm asking you, yeah. You just said scrap it, and are you talking about housing specifically?
I'm talking about housing specifically,
okay,
sorry.
Specifically, and you just leave it as it is for the rest,
I would happily see it scrapped across the board for all assets. I don't think it has done very much at all to encourage investment, particularly investment in the economic sense. I think what it encourages is for people to sit on assets and try and earn more of their income as capital gains, which, as I said earlier, is not a particularly productive way to earn an income. So I would be happy to see it scrapped for all assets, but absolutely I think the most important asset to scrap it from would absolutely be housing, because that's where we see the biggest economic challenges. The housing affordability crisis is probably one of the biggest challenges that Australia currently faces.
Okay. And you've linked the CGT discount to a long-term shift in credit from business lending to housing lending. So just interested to unpick what evidence is there actually that isolates the CGT discount from other drivers of housing credit growth, and what specific mechanism would cause credit to shift back to business lending if the discount was reduced?
Yeah, so at the moment, as far as banks are concerned, housing is a great bet. They tend to always go up in price. They're reasonably liquid assets, not like stocks or bonds or cash or anything like that, but there is a strong market to sell back into. And if they're only selling at 80% of the value, it's highly unlikely that we'll ever lose money on it. Lending to a business, on the other hand, is far more risky. And the other advantage of housing is the valuing of housing is pretty robust. We can understand what they're worth fairly easily by looking at housing around. Businesses tend to be quite different, and so therefore there is more risk in lending to businesses. So what banks have worked out over the last quarter of a century is that mortgages will keep going up and keep getting large. They're extremely profitable, and they're almost risk-free. They're not risk-free, but they're not very risky. And so it's not surprising, as banks that are trying to maximise their profits have shifted their focus away from businesses and to housing. If, on the other hand, we were to slow and stop house prices from increasing, then bank lending into property becomes less profitable for banks, and that they will need to then look at other people to lend money to. Business is the other large class of lending that they can get into. And so I'm suggesting that it is likely that that banks will shift from lending as much to mortgages because there won't be as much demand, because house prices won't be as high, and they will instead lend to other people, including businesses.
Okay. That's your hypothesis? It's not something you've modelled specifically or anything?
No.
Okay.
It's a hypothesis.
Okay, thank you.
Good, thank you. Senator Pocock.
Thank you very much for your time this afternoon. One of the things I was interested to asking you about is, I've heard a lot of economists talk about different asset classes and how you have different tax treatments and you essentially want a uniform tax treatment. I guess sitting here listening to people talk about housing as just another asset class, I have serious concern about that. I'm interested in your view about whether we should just be treating housing as an asset class, or is there something else we should be treating housing as, given how important it is to human flourishing?
Yeah, absolutely. I think one of the big problems and changes that's happened in Australia over the last quarter of a century is we've stopped viewing housing as a safe and secure place to live, and we've started to turn it into a financial asset, a way to make money. If we go back in time a long way to Menzies, the founder of the Liberal Party, he was very interested. We saw home ownership rates massively increase under Menzies in the 50s, and that was a deliberate policy choice. What he was worried about was communism at the time, and he thought that if people owned a part of their neighbourhood, they were less likely to riot and try and burn it down. He wanted people to feel connected to their neighbourhoods, and he thought home ownership was a way of doing that. If we fast forward to the sort of Howard years when the capital gains tax discount came in, what we saw is a changing in the idea of what housing was for. Housing now became an asset, something to earn money from, something to speculate in, something to build a nest egg. And lots of Australians have treated it like that. And to be honest, I don't think that I don't particularly dislike or think it's bad that Australians have done that. What they've done is they've followed the incentives of the policies that were in place. And look, what I'm proposing is if they scrap the capital gains tax discount, I'm assuming that a lot of those investors will get out of the market. They will take their very big capital gains that they've probably accrued over many years, and they will go and invest in other things. There are lots of things people can invest in. There are lots of things people can make money from, but investing in housing is having a negative impact on people. If everybody invests in the share market and the share market, there's a bubble in the share market and it goes up, then people aren't homeless, people don't struggle to pay their mortgages and feed their kids. Investing in residential property is having that impact. So absolutely, I think it's the wrong kind of asset to focus on as something that we should make money out of. We should instead see it as a place to live.
Thank you. One of the things we've heard from people who say that we shouldn't be tinkering at all with the CGT discount on investment properties is that this is actually just all about supply. And I'm interested what you think about leaving the CGT concessions for new supply as a way of actually incentivising new supply rather than people turning up in established suburbs and being outbid by a property investor.
Yeah, look, I think absolutely there should definitely be no capital gains tax discount at all for second-hand property. As far as new property goes, I also don't think that we necessarily need a capital gains tax discount for even for new property. There is plenty of demand for housing. As I said, housing construction is leading the growth in housing is leading population growth. I don't think that if we get rid of the capital gains tax discount, we're necessarily going to see we're not going to see builders suddenly stop building houses. Why don't I think that? Well, because in Victoria, when investors were getting out of the market, we haven't seen a drop-off at all in housing construction. I think that what we'll do is instead we will see housing being bought by owner-occupiers, in particular first home buyers, rather than bought by investors. But, you know, there may be a slightly better argument for keeping it for new properties. I think absolutely there is no argument for keeping it for second-hand properties. But on balance, I think you should scrap it for all housing.
And given the above average rates of investment property ownership amongst federal parliamentarians, do you think there's an inherent and potentially insurmountable vested interest conflict in achieving reform in this space? Do you think that's part of why we've been so stuck?
I'm an optimistic person, and I actually think that we're heading towards change. I hope we are. And the reason I think we're heading towards change is because there is a bigger and bigger cohort of people who are locked out of the housing market and are very angry about it. And ultimately, politicians, as you pointed out, follow their vested interests, and one of their biggest interests is getting re-elected. And also, it's not just people locked out of the market. I know when I talk to people, we talk to people about how they're worried that their kids or their grandkids, they own their own home, but they're worried that their kids and their grandkids can't get into the market as well. So I think that the conversation around housing has changed quite dramatically in recent years. And I think that politicians, we saw at the last election, housing affordability was one of the biggest election issues. If we continue to go to the next election and housing affordability hasn't gotten better, it hasn't stayed the same, but it's actually gotten worse, which it has since the election, I think that politicians are going to face pain and questions from the public about the kind of policies they have, whether they're actually working. And so I think that there is a big incentive for politicians to make housing more affordable.
There's lots of recognition and talk about growing wealth inequality in Australia and the way that we tax work rather than wealth. And I'm interested how you think these potential CGT changes on investment properties factor into trying to turn that ship around and actually tax wealth a bit more, reduce some of the wealth inequality in this country.
Yeah, I think it will have a big impact. The Australia Institute did some research using HILDA data and looked at 2002 versus 2022, so a 20-year period, and they looked at the kind of asset classes that were growing the fastest and who they were growing for. And the asset class that was growing the fastest was other property, that is not the family home. So that included almost all of it was investment properties, but it would also include things like holiday homes as a smaller subset. And that rapidly growing asset class is one of the reasons that wealth inequality has gotten worse over that period of time. Basically Australians have three large assets, or the average Australian household has three large assets. The home they own, if they do, their superannuation and other property. They were the three big asset classes. And what was surprising was the most rapidly growing of those three was other property, and also that other property was the most concentrated. It was not all Australians own other property. It was concentrated just in the top 10 and the top 5% of wealth holders.
I guess a related part of the CGT discount is negative gearing. I don't know if you've seen Everybody's Home's proposal to at least say that you can't negatively gear an Airbnb as a way of trying to add more long-term rentals to the market. Their analysis shows that would probably save us $100 to $500 million per year, and I was wondering if you had a view on tweaks to that and how that interacts with the CGT discount.
Yeah, absolutely. Investors are really sensitive to changes in policy like that because they're not buying the house because they necessarily have an emotional attachment to them. I mean, people buy a home that they live in and they become emotionally attached to it. And investment property is not usually seen in that same way. So it's usually based on the numbers. And if you change things like negative gearing, if you make it more expensive and less profitable to hold on to a particular asset, then they're more likely to get out of it. So absolutely, changes to negative gearing. Changes to negative gearing more broadly, I don't have any problem with changing negative gearing. I think if you were to scrap the capital gains tax discount completely, then negative gearing would no longer be a problem. Negative gearing has existed before the capital gains tax discount. It exploded because people worked out, well, I'm willing to be negatively geared, I'm willing to make a loss, and look, the taxpayer is going to pick up some of that loss, but not all of it, if I can make that capital gain in the end. If you get rid of that discount and property prices stop rapidly increasing, negative gearing will probably solve itself. But if people wanted to do like a half measure, then like reducing the capital gains tax discount, which we don't recommend, but not getting rid of it completely, then also you could look at changes to negative gearing to increase that impact.
And what proportion of professional economists do you think have changed thinking on the CGT discount? Where's the consensus at now?
I think it is shifting. I think if you'd asked me that question 5 or 10 years ago, they probably wouldn't have thought that it was necessarily as big a problem as it is. I think that the consensus on this is shifting. I talk to economists fairly regularly who are now talking about how that the capital gains tax discount shouldn't just be modified, but it should be completely scrapped.
And then just finally, and I asked a similar question to Mr. Fraser earlier, how do we start getting Australian governments to treat housing more as a human right than another asset class, an investment vehicle? Is that just through the tax system, or is there a broader cultural thing happening here, or does the culture just kind of change to what?
I think the cultural change. I think it was a change to the tax system that brought about the idea that residential property was an asset to invest in, a way of making money. I think if you took away that same change, that capital gains tax discount, then you would change that culture over time. People wouldn't view it that way anymore. That's not to say everybody will get out of investing in property. And look, we don't want everybody to get out. There are some people who rent for a period of time or want to rent. for all sorts of reasons. So we need some property in the residential market. The problem is that private rentals have been exploding over the last 20 to 25 years. And we now, have basically got a whole heap of people who can't get into the market who are forced to continue to rent when they would much rather be homeowners.
Thank you very much. Thanks, Chair.
David. Mr Grudnoff, I just have a couple of further questions. Firstly, you've recommended scrapping the CGT discount right across the full range, not just for housing. Would your advice be to put in place any transitional arrangements such as grandfathering? And if so, or if not, could you explain the rationale behind it?
Yeah, I think that there should be some period of grandfathering. I think people make investment decisions and they don't want to be completely caught out. That said, I wouldn't suggest permanent grandfathering. So if you were going to introduce grandfathering provisions, you might keep them in place for 3 to 5 years, for example, and then have them end. The problem with grandfathering is it's just another age inequality issue, right? What we're saying is older people who got into the market a long time ago, you have a separate set of rules than younger people who are getting into the market now. And so consequently, all you're doing is discriminating against young people. And look, that kind of inequality is something that we've all acknowledged we need to reduce, that the young people have got it quite difficult, particularly in housing. Look, what people need is a few years in order to decide whether or not they want to stay in the market or whether or not they want to get out. And if they want to get out, then they can get out under the old arrangements, they can make the profit that they were expecting to make, and then they can go and invest their money somewhere else. And they're no worse off then. But if you kept it forever, then all you're doing is telling investors that currently have investment properties, just hang on to them. Just hang on to them for as long as you want, because you're going to get this capital gains tax discount. So I would, if there was any grandfathering, I would certainly put a time limit on it.
All right, thanks. That's helpful. Your evidence today sort of ranged us back to the Menzies days, so you've taken us a fair way back. I'm not going to try and take you that far back, but look, there is, or at least was, an economic orthodoxy that investments or capital gains should be taxed at a lighter rate or a more generous rate than money or income earned by working. Tell me if you disagree with that. But when that economic orthodoxy was in place, there was a policy imperative, or at least policy makers were trying to boost national savings. It was one of the aims that they were trying to achieve. Do you think, would you agree with that proposition firstly? If you do you think times have changed in terms of a need to boost national saving? And if you agree with that, do you think the economic orthodoxy needs to change as well? And we need to start ensuring that income derived from capital gains is taxed at a more similar rate to income derived from working?
Yeah, I think it should be taxed at least at the same rate. As I said earlier, we want to encourage people to earn an income that creates things, that adds to the total amount of stuff that we can all consume. As an economist, that's what I want to see happen. Capital gains doesn't do that. And so what we're seeing over time is people trying to find ways to earn income as capital gains. And that is not going to be as economically good for Australia than other ways. So, why are they trying to earn it as capital gains? Well, because it's tax effective to do so. So, absolutely. If we actually go back even slightly before the Menzies years, if we go back to the 1940s, back then they did actually tax what they called unearned income from, or passive income, I should say. They taxed passive income at a higher rate than active income. So passive income was income earned from things that you weren't directly involved in making or doing. And look, they did that because, that was, economists thought that was, you tax those things more in order to, or more accurately, you tax active income less in order to encourage people to engage in that kind of active earning of active income. So I think that there's no economic argument for why capital gains shouldn't be taxed like other income.
Yep. All right, thanks, Mr. Grudnoff. That's very helpful, Senator Whittaker, just checking that you're good. In that case, Mr Grudnoff, thank you very much for your submission and for appearing before the committee today. On behalf of the committee and the Senate, we thank you. And that concludes today's hearing. Thanks to all the witnesses who appeared and to Hansard and Broadcasting and the Secretariat for their assistance. I advise witnesses that responses to any questions taken on notice should be provided to the Secretariat by Thursday, the 5th of March 2026, and the committee stands adjourned.